They said it was a fad. They called it a bubble. It's crap.
They doubted. We built. Long before the hype, while they talked about innovation, we became it. This is more than a conference. It's where the builders meet the believers. This is the front line of the future. And now, you're here. Every step you took led you to this moment. Welcome. Today, the future speaks.
Good morning, everybody. Thank you so much for coming. It was a pretty wild, crazy cocktail hour last night. We're going to be joined on stage today by my colleague and friend over here, Nova Lorraine, award-winning fashion designer, futurist, and founder of the House of Lorraine. Thank you so much for joining us today. We've got another amazing day of content ahead for us. Yesterday we had Newsbreak on stage. Barry Silbert launched a digital asset management company for institutional investors that wanted to get involved with the alpha token on Bitensor. Nova, tell us a little bit about what you did yesterday and what we have in store today.
Yeah, happy to. And good morning, everyone. Good morning.
Morning.
Good morning. I'm going to help you wake up this morning. Welcome to day 2 of the Proof of Talk. I'm Nova Lorraine. As my lovely colleague here, Michael, mentioned, I am the founder of the House of Nova. And I was really excited yesterday because we not only talked about the momentum in the space, but we touched on real use cases. And I think we're all ready for that, right? And we went beyond the surface, as we usually do here at the Proof of Talk, and we looked at what projects are actually making impact. And so some of the conversations we had were from Bitcoin layer 2s to decentralized science, super excited about that, to emerging markets. I'm from Jamaica, so I was really interested in hearing what they were doing in the emerging market space, as well as aligning sustainability with compute. How do we do this in this new era where energy is such a big topic and interest, especially around blockchain and AI? And then, of course, today, we're going to be covering everything from subnets to stable coins. We'll be hearing from global leaders and regulators, DeFis, and crypto natives. So we have a full schedule today as well.
It's going to be a wild, crazy one. Great line of content here. We're going to get things started off right now. We've got an amazing panel coming up. Why don't we welcome to the stage right now?
All right. You guys ready for your set of speakers? Yes, yes, yes. OK, we're going to play a game. If you ever come to my stage in there, you know I like playing games. So for each speaker, we're just announcing their first name per their request. But I want you to give each of them a really warm welcome as they come onto the stage. They came from far and wide, and we want them to know that we're here to listen, and we're really happy that they're here. Okay, we're good? We're good with that?
Let's do it.
All right, amazing. All right, without further ado, let's get this party started. This panel is going to be Roadmap for the Tokenization of Financial Assets. And I would like to first welcome to the stage Doughton, please come to the stage. Woo woo!
Doughton!
Doughton is a director of emerging technology for LSEG. We have Elliot following close behind.
Elliot!
He's the head of macro policy research at State Street. Welcome, Elliot. Raj B is up next. Let's go, Raj. He's a co-founder and CEO of Blockridge. And Lloyd W., you're up next.
Lloyd!
Founder and CEO of Members Cap and Mana Group. And last but certainly not least, we have our moderator, Young Sun, come on stage. He's the head of product at
Thank
Flipster.
you all. Have a great day.
Enjoy, everyone.
Bonjour, Paris. Good morning, Paris. How are you guys? For today, we have a wonderful lineup of panels coming from various industries, representing each sides of like financial market to talk about the roadmap for the tokenization of financial assets. We're going to go through an introduction of our wonderful speakers first, and then head on to our topic first. But I do want to give one starting question to the audience, just for the speakers to have a better understanding of where we lie. Who here is familiar and you think you know the concept of tokenization of financial assets? Just honestly speaking. We have half. So we have half of people who are more aware. I guess we have half people. We want to educate and have a better sense of it after this session. So now with that said, we'd like to start with Lloyd. Just a quick, brief intro about yourself and what you do, and then we can go to our topics straight on.
Thank you. Lloyd Warhead, CEO, founder of the Mana Group. We're an investment platform in financial technology. From that business, you might know Searching for Mana. It's a podcast I host where we've had Kathy Wood, Jeremy Allaire, Anatoly, and we're really trying to put a spotlight on the leaders in innovation in the digital asset space. And then a few years ago, I founded MembersCap, and we are tokenizing an asset manager, and particularly the asset class is reinsurance. And we're doing that because we believe that the space needs a safe haven, less volatile, risk remote way to manage their capital.
Rush?
Hey, my name is Raj Brahabat. I'm the co-founder and CEO of Blockridge. Our main mission is to make privately held assets programmable. The purpose behind doing so is to, number one, automate compliance processes. Number two, enable wider distribution. And number three, most importantly, increase the amount of things you can do with your assets within the existing financial markets.
Elliot Hentove. I run macro policy research for a large asset manager, State Street. The reason I'm here, because it's very much a TradFi role, is that a few years ago we developed a new research stream called macro digital research, where we think about how is blockchain finance and innovation actually changing the financial architecture? How does it change capital markets overall? Does it change how global allocators put their money? Where does capital flow? And trying to think through these issues. And most recently, we really spent time thinking about mapping out asset tokenization across all asset classes in capital markets, the timing, the impact, and some of that is what I'm hoping to share today.
Brilliant. Great to meet you all. So I'm Dotan Ramini. I'm the Director of Emerging Technology at the London Stock Exchange Group. My focus has been, at least over the last sort of 6 years, leading digital assets technology strategy at the group. We have built, over the last 3 years, a new digital assets business that we call DMI, Digital Market Infrastructure. So we're sort of a 100-person organization, largely focused on tokenization of existing financial instruments, where we provide services front to back around lifecycle management of those assets on a multi-asset class basis and on a multi-chain basis too. Great to meet you all.
All right. Now, that said, I do want to start off with asking a simple and easy question. Maybe I can start with Elliot on, where do we think the current tokenization of financial assets lie? As in, we have some progress. Some of the stablecoin sectors or some other sectors are showing progress of tokenizing financial assets. We have some challenges. So where do you think we are at, if you have to choose from like 1 to 10 as a stage of progression? And what do you think lies ahead, just as a starter?
I know it's early morning, and I promise I'll keep it to a minute, but a tiny bit of theory here. When you have, typically technologies are agnostic. They just make whatever you're doing better and more efficient. Tokenization is slightly different because it requires the whole network to change. The big change here is it's about the supply side, meaning it helps the issuers more than anything else deliver their products, their funds, their instruments more easily to the market. So it expands supply, it makes it cheaper. Raj will talk a lot about that. That's the innovation for financial assets above all. And there's a little bit of a demand function for those parts that you get tokenized that you couldn't have access before, but now because they're tokenized, it's getting easier. The ticket size gets smaller, or the barriers to entry are easier. And so that's really how you have to think about it. And so when you think about capital markets broadly, which part of the market's not working well, that's where you're going to have the biggest impact. So the parts that are hard to get to, the ones that are expensive to run, that's where tokenization is going to have the biggest impact. And obviously, Raj, I think, will talk a lot about that in the private space.
Yeah, absolutely. I mean, look, firstly, I believe tokenization is truly a blue ocean opportunity. I foresee a future where the entire capital markets will transition to blockchain technology in one way, shape, or form. In the short term, where I see a lot of utility being derived is within DeFi. And speaking of DeFi, what has worked really well till date, it's lending borrowing, right? You look at Aave, Compound, Curve, Finance, etc. So today you can see looping strategies already active with Apollo and Securitize, right? You can take really safe TradFi assets and augment the yields all the way from 8% to 13%. So I see in the short term that being a very useful way to optimize tokenization and its utilization. And additionally, real world assets are better collateral than most things because they have inherent value. So over time, I foresee people keeping more and more of their idle capital within tokenized private equity and private credit because they'll have hyper availability to be able to borrow capital against it whenever needed. So that's kind of the short-term targets.
Doten, I do want to ask from a service provider perspective, like what are some opportunities does the tokenization provide within this environment?
Yeah, it's a great question. So we would sort of bucket up the value proposition of tokenization into three sort of core areas, and many have sort of been touched on already in the panel. So certainly accessibility of financial instruments is a big one. I mean, we look at some of the use cases in and around, for example, take real estate funds, which have fairly high value assets, very, very large ticket sizes, typically require very specialized investors who have the competence to do the relevant due diligence to make these investments. Now, with this technology, you could take some of these investments, look at fractionalizing, some of those holdings, and then redistributing to provide access for smaller investors. And so that's sort of an interesting opportunity. Equally, on the other side, we see there's a lot of value in scaling efficiency. So it has already been mentioned around, how do we do things faster? Can we take settlement times for private and illiquid funds down from 45 days or 30 days to a couple of minutes? And in doing so, suddenly this asset class is more interesting to investors that today need to manage and hedge their risk on an intraday basis and therefore couldn't accept a fund that it would take 30 days to offload from their portfolio, whereas now this is a much more interesting asset class. And then on the final piece, it's sort of going into how do we think about market structure as it exists today, the types of activities that are conducted in and around some of these assets, and how that could evolve. So thinking about business model evolution and innovation. And certainly, some of the comments mentioned by Raj around, can we bring some of the benefits of pledging and collateralization and collateral financing to the private assets world, leveraging these technologies to unlock the accessibility of the assets, provide better mobility of the instruments, and therefore make them accessible to some of these liquidity pools for financing.
Yeah, I mean, I think we can imagine basically people having access to stable coins has really increased accessibility for people to have an opportunity to trade your currency to a dollar pegged, whatever financial asset it is. And those platforms that are serving that trading pair probably earn a lot of money off from it, right? So now that said, I think moving straight on to some of the drivers that are driving this interest, right? I want to put it to you, Lloyd. What do you think are some of the institutional drivers that are actually pushing this interest forward? And after that, I want to get straight to, if there's interest, why do you think there's an interest, and why does tokenization matter?
Yeah, so we think there's 3 phases on the roadmap to 11 out of 10. And today is, quite frankly, remarkable, the engagement from institutions in tokenizing assets. So I mean, it's still a good 8 or 9 for me. But there's obviously a lot to do. But yeah, the question why, perhaps Members Cap is a good example of. hopefully. So if you think of reinsurance, maybe you'd be familiar with a Berkshire Hathaway or a pension or endowment fund investing into this for a very risk-remote, uncorrelated return. These environments are marvelously walled gardens that exist in Lloyd's of London or Bermuda, where you have a lot of intermediaries, brokers, administrators. So I think the natural thing that space has done, builders, developers, programmers, has come after trying to disintermediate. It's a generically good narrative. However, to answer your question, if you go to any trading partner, it's not enough to make progress. Those downstream efficiencies are awesome, but to get there, what you need to do is come with risk capital. So we found that out the hard way, and it sounds so obvious now. But if you go to the reinsurance world, if you have a professionally managed investment office, and if you take new risk capital, then you can trade with them. And so this is the approach that we've taken. And so why tokenization is so that then we can take what would normally be a 100 million plus ticket to come into our portfolio all the way down to $50. So we are looking at the distribution side, smart contracts, an exchange of equity, and being able to bring in, to start with, high net worth individuals, family offices and so forth, who just haven't had access to this awesome asset class. And by doing that, the engagement is extreme, back to the point. So for us, really, it was to start with accessibility, and then our roadmap in phase 2 becomes about frequency of liquidity, and then in phase 3, it becomes about all the amazing network effects when you have a platform. And if you think of even the insurance policies, they're on chain as well, better provenance, a lot more programmability, and all the network effects of that.
Yeah, I mean, I was going to just move on to Raj, because you did mention about, before our discussion, you did mention that you were focusing specifically on, like, private side of the things. And I think that puts you on the spot to discuss why. Why are you, like, focusing on that specific area from Blockridge?
Well, the core thesis is that on-chain capital markets infrastructure can significantly reduce cost of settlement and time to settlement. And the parallel side effect becomes that liquidity and accessibility to securities and assets goes up significantly for the end retail investor, and hence more liquidity can be influxed within the private markets. And I believe this is the primary driver for institutions today, such as asset managers, to categorically go out of their way to tokenize their existing funds, simply to be able to acquire more and more liquidity into those funds and assets in the short term. Now, over time, the primary driver will actually become global distribution and almost a democracy in capital markets, wherein people that have either high amounts of retained earnings by proportion in their checking and savings accounts, simply because they do not want correlated returns, will now have access to uncorrelated assets, and hence be able to build portfolios that are hedged against the current public markets.
So it seems like there's more efficiency building up, better distribution, better accessibility. It seems like a dream come true. Like, I don't want to get too Elliot. You're touching upon some policy aspect of it. What are some of the risks, or what are some of the concerns in this space with regards to current progression?
Yeah, just to recap, if you think about, Raj is in the space where it's probably most exciting. It's private credit, private equity, real estate funds. Dotun mentioned it as well. That's where we have these inefficiencies today, so the problem solving is greatest. But there's one or two other parts of the market too. A market that we use, that we all rely on every day, that's still relatively inefficient, is the bond market. And it's less sexy, but in many ways that's where we're seeing the biggest revolutions happening today, and particularly around very technical features around collateralization options and so forth. That is obviously going to spread. The problem we've had, and I say that as one that, member of an organization that's a global systemic institution, it's been very hard to get policymakers and regulators to come along for this. So even Raj's example of like, well, hey, the technology, we've made it easier. It's accessible. The costs are down. Now we can do low ticket sizes. Yeah, but you still cannot sell it to average retail investors. You're still not allowed to distribute it in conventional channels. You're still restricted on the old rails. And the problem really is to get policymakers on board, even those who embrace it. There's so much that needs to happen because every node in the system has to be re-regulated and reset. And so the technology is moving, like always, well ahead of where policy is.
I mean, in that regards, I think usually if we see the history of like technological revolution paired with policy changes, I think it's usually the service providers or the platforms that have really driven the boundaries, right? Dotun, I do want to ask you, like, what are some of the challenges you're facing while building this? And what do you think is kind of like the pathway forward to get those policymakers at least to like listen or, you know, get on board?
Yeah, no, I would certainly echo some of Elliot's concerns around just the pace of evolution of sort of policy change. I mean, I will say we have seen some big strides in certain regions, both in the UK with the sort of DSS and some of the regulatory sandboxes, in Europe as well with the sort of the pilot regime. Obviously, Abu Dhabi, the UAE, they've been focused on building specific and established frameworks to support this type of innovation. The Monetary Authority of Singapore has been very amenable to a fairly dynamic approach to supporting innovation in this space. But ultimately, change is hard. I mean, we run similar to State Street. We're, in the institutional space, we're a 300-plus-year-old organization that provides systemically important market infrastructure. We're probably some of the most risk-averse organizations in the world. And that's not just sort of market risks. We're looking at operational risks. And so there are lots of considerations here around how do we bring this technology to bear, how do we define the right risk control frameworks around these assets to protect our investment community, where if someone is making an investment in a $1 billion bond or $1 billion money market fund, they don't have to be concerned around a third-party wallet hack undermining that investment or potentially sending a transfer to a zero address. So it's these types of concerns that we want to bring together. They're not bearer instruments. Financial instruments today are largely non-bearer in nature, and therefore we want to sort of respect that through the right risk control frameworks and models for defining the assets. And I think the other consideration, and probably more of a structural one when we think about go-to-market, as this space is evolving, as many institutions like us and some of our largest clients today have been making significant investments in scaling out products and services, it's really, how do we think about interoperability? We're not all building on the same rails right now. So how do we get assets mobilized and sort of moving seamlessly and fluidly across different ledgers and different infrastructures? That's a hard problem. We today are thinking about private networks. Tomorrow we want to get to public networks. Obviously that's a journey, and how do we sort of bring that together? I like to use the sort of contrast with investment today in private assets is largely a conversation and some paper-based administration. You don't have a technology or infrastructure barrier to making an investment. Whereas when assets are digitized, suddenly that's created. So we need to sort of solve that emergent problem before we get going. Otherwise, we risk eroding a lot of the value that I think this technology brings into the space.
Yeah, I mean, I think it's a great point in addressing, the issuer side of things as well, like private versus public, even on chain, but also from a financial perspective. So I want to ask you, Lloyd, there are definitely cases where a tokenization kind of brings more accessibility, but also kind of puts people a little bit away from the central product. I'll give an example of this. Basically, if you buy an NFT, the initial purchaser would probably know the art's concept more because they were kind of closer. But as it goes to the market and gets, let's say, fragmented, people might not have the same understanding. Because you mentioned about like reinsurance products or insurance products getting more like tokenized, when you're thinking of like creating like these type of financial assets to tokenize, what are some of the things that you consider with that in mind?
Yeah, and I think it probably answers how we look at the cadence of policy here too. I think you have DeFi, which you can almost think of it operating in its own sandbox. Mm-hmm. And so I think it's about the education of risk that people are taking. And so our approach, because we're facing the reinsurance world and the credit rating agencies and the regulators have, the highest bar as they should, we have to take a very cautious approach. So if we look at stable coins, we would take USDC, and at the moment we wouldn't take other stable coins, just because having conversations with the regulator, they like the way that Circle has behaved. They're looking at others over time. And so, really our responsibility is making sure that people are aware that this is something that fits into their portfolio, making them more aware of the risks. We've taken a very risk-remote approach because we think that's how reinsurance should sit in a portfolio. But if I look more broadly across the space to answer the overall question, I think overall the industry will innovate. So are there threats, are bad things happening right now? Yes. When technology comes into any market, you typically get, nefarious uses of it. We've seen a lot of that. We'll carry on seeing a lot of that. Overall, assets being tokenized, to Raj's point, I think is a wonderful thing for global distribution, for access, for many other reasons. So I think it's about, the good side of the space, educating, being very respectful of when they go to retail, not having bad blow-ups like we've had previously. And of course, the policy plays a pivotal role there. And I'm based in the UK, and I think they're taking a healthy approach. We work with, the key people there. And I don't know if it needs to move much quicker. I think currently right now, like I said, 8 or 9 out of 10, the way this space is getting looked at. But of course, there's still massive risks for people.
So the reason I asked was because of the fact that I wanted to ask a follow-up question to you and move on, was do you think that having a restriction or a regulation around issuer is necessary in this space? Or do you think that you should allow everyone to potentially just tokenize on top of a collateral asset? What's your view? Do you think everyone should be able to do it?
My personal view is no.
Okay. Would you agree, Elliot or Raj?
Yeah, for the most part, I do agree. Now, one thing to note is that what we have seen within the financial markets over time is dematerialization in one way, shape, or form, which is what happened back in the 80s when the stock market got digitized and paper stock wasn't necessarily being traded at the same scale anymore. And that is effectively the same trajectory we're heading into right now. And I believe that will continue to be the primary use case of tokenization, which is effectively how the assets are traded, how they're structured, and how they're distributed. Issuers, for the foreseeable future, will need to be within the existing regulatory framework. But to your point, that could change, right?
Look, regulation has a point. We've smoothened out big boom and bust cycles, and the problem is if you do just open the gates, you'll get another boom and bust cycle that can be very systemically risky. So the guardrails have to be in place, they just need to be modernized. The problem is that the modernization in this case is not just, hey, we're doing equities differently. No, this is about everything. This is about the custody, the collateralization, the whole distribution. Everything is changing. It's a network shift. And that requires I don't envy the policymakers.
Yeah, no, when I think about sort of policy generally, I sort of look to the stereotypical sort of jurisprudence of sort of financial markets regulation. Typically regulators have a few core mandates, and it's all about solving for investor protection, market stability, and then sort of increasing and sort of cultivating competition in the space to sort of mitigate monopoly risk. And they do that through a number of different ways, but largely, the lens by which they think about the evolution of policy is this lens of, if it's the same activity, it carries the same risk, we should apply the same rules. And certainly as you've seen sort of the evolution of regulation with respect to digital assets and sort of, Web3, crypto assets, etc., they've tried to steer through that lens. I think where we've seen the most challenges, specifically on the tokenization side, it's not that the rules that we have aren't adequate in some cases, It's that there are existing rules that are predicated on certain assumptions that you need intermediaries to solve for managing risk and specifically market and systemic risk in certain contexts. And so these assumptions layer in the expectation that intermediaries will carry the function of being responsible for certain activities. And now we know through the digitization lens that through blockchain technology, we can actually disintermediate some of these activities through automation and mitigate the risks associated with the lack of trust. And so I think the consideration there is, and I think where we're seeing the big push with working closely with regulators is around how do we evolve some of these aspects of the rules to ensure that we can smooth those out, streamline, and provide bifurcation of the policy expectations to allow for the emergence and the innovation of these technologies to really bring that value.
Yeah. So it seems like the consensus is like we do need some level of guardrails within the panel. I want to move on to probably one of our interesting topics. Tokenization also comes with some centralization aspect to it because it allows liquidity to flow into certain directions. For example, like a USDT sucks up liquidity from other types of currency markets, potentially, especially in the crypto space. A lot of pairs are all USDT. With that said, what I want to hear from all the panels what the takes are in terms of that liquidity issue for the tokenization of specific underlying assets that you guys are dealing with. Maybe starting from Lloyd?
Yeah, so I think at the moment, distribution basically doesn't exist. It's been our experience of the platforms. However, it needs to start somewhere. So you've put think of it as rails down. And then if I look at our or other funds, we're capital market raising in a traditional way. We're having to get tickets over the line, and then we're introducing them to our partners, and there's many, as mentioned, kind of disintermediation isn't going to happen for a long time, which I think's good for now. And so, the holy grail is true liquid secondaries, which in different asset classes today is incredibly exciting. But if you start looking at others, it's 10 years down the path. So the question we're asking ourselves is, if we think of our customer, should we really provide high frequency liquidity? Is that the best thing? And really the answer would be no overall, because the compound interest of staying in an asset class like this over time. So that's why we have somebody who firstly looks at it from a wealth management perspective, looks at the portfolio, and then for this slice that they're putting into their portfolio, takes a view on that. So phase one for us, again, in our 3 phases, is the access coming down and taking what is normally, if you think of, say, PE, a 10-year lockup, all the way down to 3 months, which has not happened in the space apart from when cat bonds came in. So we're happy with that. Do we think people should be trading on an hourly basis? In our instance, no, unless we built out further assets. And really for us, the big unlock here is if we can start getting to use the collateral that are tokens to generate the yield. So you see a lot of stablecoin plays here where they're providing a portfolio approach with that. So if you think of one of our customers who might be the treasury of a foundation of a protocol, they have a massive issue with over-concentration of their token and quite frankly very little else, let's say some Bitcoin, and then whatever keeps the lights on from an OPEX perspective. And these foundations might have very large market caps, but more often than not much liquidity. And so the massive unlock here is if we can start moving over to that high concentration of token, and if we can start generating yield here for the OPEX, and then the innovation happens. So it's something we're working on with a bunch of partners. So we're more thinking, like I said, from a risk capital to us, unlock some of the treasury's assets, and then downstream to the customer over 3 phases, providing more liquidity, but not all at once. And I'm still not convinced that we should.
Yeah, I think it's a great point because a lot of people are fatigued when you get exposed like 24/7 and high frequency at just like one shot. So I think there's a great point in having that phases and trying to find the sweet balance to it. Raj?
You actually bring up a couple of good points, especially in regards to distribution and whether or not markets should transition towards high-frequency trading for traditionally illiquid assets. The primary problem that I foresee with doing the latter is that there's a lot of downsides to existing, black box, T+2 trade settlement infrastructure. But the one thing that really, really works is netting, right? 98% of public market trades are netted off, and hence infrastructure is actually able to enable markets in a fluid manner. Blockchain technology and on-chain capital markets products are not necessarily built to do that today. So an emerging technology could be something like an accounting chain that actually does reconciliation throughout the day and accordingly nets off trades on-chain. Maybe when that's possible, at least at the infrastructure level, high-frequency trading is a viable option. The financial repercussions of that are, effectively a different topic. We could go on and on about that. But as far as distribution goes, in the first phase, I really see that happening through existing distribution channels. So wealth managers, advisors, registered investment advisors, all of these entities, bodies, and individuals are effectively the filtering mechanism for the investor out there that doesn't necessarily know where to allocate. Now, through tokenization, what you can truly do for all of these distributors is lower investment minimums because each and every asset can have wider distribution.
Yeah. It seems like there are some aspects of like centralization, distribution, all kind of mixed together. Elliot, we were talking before the session around like the future outlooks or the roadmap that we have to kind of head towards. Could you kind of give the audience a little bit of like a, enlightenment along like where the tokenization is kind of like going and should be going?
Well, just to recap, it's happening today in bonds, starting with money market funds, bond funds, and then regular bond trading, because that's still a market that's being disrupted. The up and coming one is, of course, the private fund industry. And your question with liquidity is eventually there's demand for private assets that's not met today. I mean, actually, I guess that makes two of you who are catering to that marketplace. But that money means you're going to reallocate out of other asset classes. So there is disruption and instability that comes. So you may think, oh, it's all great, there's just more liquidity over here. Yes, that's true, but that means also other markets or other institutions, particularly banks and insurance and other asset companies, may actually struggle with keeping and holding on to those assets.
Yeah, I just want to touch on the sort of liquidity points in addition. So, I mean, I think about liquidity in a couple of ways. Sometimes I think we run the risk in the sort of digital asset space, and largely given what we see around Web3 and crypto assets, we sort of run this assumption that when you digitize something, it automatically creates or provisions the means by which liquidity can then emerge. And I think it is a bit of a fallacy. I mean, ultimately, liquidity is a function of economic supply and demand. Demand for a lot of existing assets is fairly well served. I mean, public markets, if you want to invest and trade equities, they're probably one of the most liquid asset classes next to FX in the world. You can get access to these things. So, but there are private assets on the other side, some of which are relatively well served and others less so. And so really, I think the question is, where is there latent demand? Whether that be in getting access to investing and holding these instruments. Why do they want to hold those instruments? Do they want to treasury them, to gain access to the returns? If so, is secondary liquidity really a value proposition? If they want to incorporate them into managed portfolios where they want to actively manage risk, therefore getting access to secondary liquidity to be able to offload these assets as part of that risk management becomes very important. But do you need a multilateral exchange? And I think the consideration there really starts to come into, it's not the should or would, it's the can. Because ultimately, when we look at the principles of financial markets infrastructure, when you're making an asset available in a public offering, there are considerations around market fairness, price discovery, information symmetry that need to be borne out. This introduces market abuse regulations and disclosure requirements on these instruments, which largely just isn't sort of principally aligned to the principles of private assets, right? You want to be able to manage your valuation, you want to be able to control your price, you want to be able to drive visibility of your sort of activities around transactions in some form. And I think ultimately, the more you bring assets into public markets worlds and sort of multilateral infrastructure, where you are effectively providing that price discovery, it starts to really erode the sort of sell-side premiums on these assets. And so you will start to see friction for incumbents who actually want to engage on this. I know we're slightly over, but I will make one point. We are seeing some interesting evolutions, though, around provisioning access to new assets for or existing assets into sort of new markets. I think some of the work that BlackRock and others have done in the money market fund space has been really, really interesting, where you're taking existing assets that are relatively stable, providing them as a replacement for traders and investors in the crypto space, as a replacement for their stable coins, as a safe harbor instrument to be able to hedge their trading strategies, whilst at the same time getting access to the yields on those assets. And ultimately, you're dealing with the issuer risk, not against a private entity like Tether, who is relatively stable, but not all of them are. But your sort of issuer risk is against BlackRock, which we can talk about their stability, right? So,
Got it. I mean, any 30-second final words from any of you, if you have any?
The future is unlocked on-chain capital markets.
All right, so we had Dotun, Elliot, Raj, and Lloyd from respective industries and expert areas. Please give a round of applause to all these wonderful speakers that have created a great discussion. And also make sure to reach out to them if you have any questions. We did want to take questions on stage, but the time is already over with extensive discussions. So do reach out to them, say hi, and ask questions if necessary. Thank you all, speakers.
Thank you so much for that. That was a mind-blowing panel. I really enjoyed it. It's crazy to hear the leaders of such globally important financial institutions talk about doing this work on public blockchains after all these years. Just mind-boggling to see the growth of the industry since they were talking about DLT just a little while ago. We've got an amazing panel coming up next. Is the current VC model in Web3 still sustainable? Please help me welcome to the stage Rob Haddock, General Partner, Dragonfly, Lior Groen, Managing Director of Spartan, Danish Chowdhury, Co-founder and General Partner of Paper VC, Matthias Weisel, Co-founder and General Partner of WTG Ventures, and Xiaoxiao Zhu, Digital Operating Partner at KKR. Thank you so much for joining us at the stage, gentlemen. A round of applause, please.
All right, welcome. Really excited to be here. Quick intro about this round. We have an exciting panel coming up about the sustainability of Web3 VCs. My name is Xiaoxiao. I'm an operating partner at KKR, 600 billion AUM, one of the largest private asset managers in the space, and we are also invested into crypto VCs, some of the leading investors here. Yeah, maybe a quick round of intros. Matthias?
Sounds good. Happy to be here and happy to be the smallest fish on this panel. Matthias, we are a venture firm out of Zurich, Switzerland, and we apply private equity principles in the space. 3 partners, prop capital only, and we focus on early stage, but also on late stage ventures actually. And yeah, that's exactly what we're doing.
Hey guys, great to be here. I guess it's like smaller fish to biggest fish sort of thing. I'm Danish Chowdhury.
You have a nicer beard though.
Thank you. I'm Danish Chaudhary, founding partner of Paper Ventures, pre-seed seed stage fund. It's about 1.5 years old. We're very founder focused, first check in, and help founders from company formation all the way to cap table to take them to market to Series A and B sort of thing. So.
Hi everyone, my name is Lior. I'm a managing director at Spartan Group. Spartan's based out of Asia with offices in Singapore and Hong Kong, and I have the privilege of working outside of those markets, covering Europe and North America. We started with a hedge fund, actually, so different approach to VC, and eventually went downstream to doing early stage venture. So today we run a liquid strategy as well as 2 venture funds, one focused on DeFi, one focused on gaming. Our model is similar from first check-in through to exit, covering the lifespan and life cycle of the best entrepreneurs in this space and working with the industry as and where needed. So great to be here and look forward to the discussion.
So I guess I'm the biggest fish, but my name is Rob Haddock, GP at a fund called Dragonfly. If you don't know us, we're about $4 billion under management, seed through Series B, checks from $3 to $30 million. Glad to be here.
Great. I think it would be interesting to get a little bit into evaluation of the current state, but just to get us a lay of the land, right? The state of the crypto VC market, right? If you believe sort of the latest estimates, 2024, we had roughly 13 billion of VC crypto funding deployed, which is about a 30% increase from 2023, right? So good, but it's about 60-70% down from the peak in 2021, right? So that's where we are probably in this sort of life cycle. If you then look at the AUM, right? Total, we're looking at about probably 60-70 billion of AUM in crypto VCs. However, most of that was raised in 21-22, right? 23-24 and 25 was really difficult for a lot of crypto VCs to kind of raise to a similar sort of scale. But at the same time, if you compare the 70 billion, right, of AUM, it's actually quite different to TradFi, where in TradFi you have most of the AUM, right, institutional AUM goes into liquid hedge funds, right? And which is actually like about 80-20 compared to sort of VC or private equity in TradFi. In crypto it's the reverse, right? So we have 80% of the total AUM, much smaller amount, probably like 10 to 20 billion only in directional or market neutral sort of liquid funds. So it's a very different picture, right? So that's sort of where we are in the sector. Now, my question is a little bit, as an investor, right? Whether you're institutional or a retail investor, you want to have crypto exposure. You have 4 choices, right? You can go public tokens, buy Bitcoin. You can now go public equity, Circle. You can do private equity. You can even invest in Dragonfly, right? But you need to have a couple $1 million. Or you can do liquid funds, but that's also like high threshold. You need to be an accredited investor, etc. Maybe the first question is like, just to get us kicked off, what should be the role of crypto VC, right, in a portfolio of an investor, whether it's institutional, right? Like, do we have like a portfolio allocation theory? Like, what is the optimal allocation? Maybe we can start with the more sort of Danish and Matthias, because you guys are not, you guys have, prop capital as well, so you must think about these things as well. What's the optimal allocation?
I think, so I'm an LP in about 18 funds. With 2 of my partners, we're LPs in about 25 funds. And we've been LPing for the past like 5 years. And we have seen 0 DPI and 0 returns. You name it, whichever fund we're a part of. So I think the number one, if I'm looking at it as an institution into a venture fund, I think the number one thing I want to look at is like, are they returning money for investors? Is there DPI? Like, what's the MOIC? Like, am I going to see my money back? Because most of the funds, maybe I've picked the bad ones, but like, of the 18, none have returned any money or been any collaborative or like actually shared deal flow or any of that sort of thing. So I think as an LP, that's the number one criteria I would kind of have.
This is 21 vintage or 22 or 21, 22 vintage or
21 vintage, 22 vintage, yeah. 22 vintage was the worst actually. It's not return.
So maybe I'll add a little bit to that, right? And in Web 2 VC, We're 3 years into the 22 vintage, right? In Web 2 VC, I would never have had an LP asking me, why don't you have DPI yet? DPI in 3 years is not common, right? If you look at the history of returns, you look at the math, the expectation is that DPI maybe starts around year 4 or 5, and that most of the returns come in the latter half of a 10-year fund life, right? And so there's this idea that like if you started a fund in 22, you should have DPI now, is completely related to the perverse incentives of early liquidity of tokens that have not allowed people to have a good perspective on where we're going in this industry and like how to actually invest for the long term. And so my general thought here is that like we tell the founders we're long-term investors. We have liquid tokens that are significantly marked up, that are worth hundreds of millions of dollars that we're not selling because it is still early in the life cycle of that protocol, of that business, and where they're trying to go. And as long as we still have a thesis on where they're trying to go, we should continue to invest alongside them like a venture partner and not a trader. And whereas a lot of these funds that I've been talking about being venture capital firms are really just trading firms in disguise and are kind of trading out of things that they don't have a thesis on really quickly. And that is not good for the space, and it's not the way that at least we try to partner with portfolio companies.
I think the scary number is not the 2021 vintage number, it's the 2017 vintage number. Only 25% of all funds have actually returned any DPI from 2017. And in 2017, you could literally invest in anything and you could make some money. That's the real scary thing. Another scary fact is that 70% of all investments go straight into infrastructure. And when we look at these infrastructure players launching a TGE, only, I think, 12% have actually more than 5,000 daily active users, which shows there's like zero to no utility in the space, and there's like a significant trend right now that private liquidity deals that's where people make money. So a lot of VCs, they go to private liquidity deals, they provide capital 6 to 8 months, they will be the first one in, first one out as well, basically zero vesting, it's a liquid asset already, you lock in the valuation already, and if the valuation doesn't hit the threshold that you're arguing for, you get an extra on top. So, and then you have BTC treasury deals that are coming. So I think that's kind of an issue right now that VCs need to even talk about BTC treasury deals.
Look, I think we were already jumping ahead, right? Going into sort of, I mean, the title of the panel is like, is this current model sustainable? But I guess for sure there is a role of top crypto VCs, right? Adding value to projects and founders, right? There's a reason why venture capital exists, right? They have a critical function. The question is a little bit like, are we oversized, right? In a crypto cycle, and where's the sort of natural, or what would we need to change for the sort of status quo to be more sustainable? But let's go maybe a little bit into the key challenges. You mentioned already a few of them. I would say, if you think about the key stakeholders, right? You have the investors, which are LPs, right? And the challenges there, from my side, obviously we heard DPI exit, but also the other challenge I think is we are inherently in a very liquid asset class, right? Like majority is a 3 trillion sort of market cap in the liquid public tokens. VC is tiny compared to that, but you're always comparing whatever you invest in VC against, well, I could have bought Bitcoin or Ethereum or Solana, right? Like, and I could have exited at any time and probably performed well in that short amount of time. So that sort of benchmark is a big question. DPI is the other question. Now, from a founder perspective, right, Rob, Leo, like you deal every day with founders. While there was a super critical role in 21, 22, now there are emerging alternatives for successful founders to kind of like really scale companies. We have Hyperliquid. We have, obviously Pump.fund, kicked off the whole meme coin. Some founders go down that route to fundraise directly from retail. We have Echo, platforms like Echo, right, where you sort of crowdfunding, etc. And then the third stakeholder, probably retail markets, public markets, right? There's this increasing perception that VCs are sort of, or retail is being treated as exit liquidity, right, for VC backs, and that they're trying to a little bit play a different game by avoiding VC-backed tokens. Now, how do you sort of maybe can you just add to that before we sort of respond to what we could do to change?
Yeah, so let me just quickly weigh in here, I think, on the market structure and the dynamics that exist. And I think that this has been a very, especially for those of us who've been around in the space since 2017, 18 with active pools of capital. I mean, we started as a hedge fund and an organization. As you mentioned, there are, pseudo VCs, so trading firms that act like VCs. And for us, our DNA as an organization started as a liquid manager. In those early days, the first things that started happening were opportunities like Chainlink, Synthetics, MakerDAO. The original DeFi projects came out and said, we're going to do something differently, and we wanted to support them. But these things weren't liquid or trading in the same way, so we weren't able to actually participate in these opportunities in size and scale that we'd like, because you weren't hitting liquidity thresholds against your top assets, which is, again, a fundamentally different thing which liquid managers have to deal with, which typical venture investors don't and shouldn't, for the reasons Rob pointed out, focus on, certainly not in the first 3 years. So the fact that we've shifted from being a liquid manager going to VC, and I think that is the structure of people today, is the VC in this industry is expected to do everything. You're expected to be able to provide TVL, which is, if you were looking at fintech players or like, let's say, other types of growth equity players, you'd be fulfilling the kind of private debt, venture debt functions of actually creating and providing capital pools in non-equity financing forms and dilutive forms. You're basically putting all of that into one single vehicle, which is incredibly difficult to manage, exactly for your point, Rob, because some of the token liquidity horizons are within 6 months to 6 years, whereas some of the equity horizons, as we all know, can take decades to build some of the long-term category-defining winners. Everyone is out here chasing those opportunities, but within a single pool of capital, it becomes very difficult. So VCs have had to become effectively some form of treasury managers in their own right, and the fact that you've taken the views that you have, that you're not selling anything, even if there is a liquid token, I think is very respectable and certainly something that stands out. But not everyone is in the position to be able to do that, just given the way in which their portfolios are constructed. So I think ultimately what it's coming to, though, just to round that out, is the current model has certainly evolved, because whether we chose to or not, if you're investing in this space, you have some belief in decentralized networks and ecosystems. That presents itself often in token forms as well. Not only there are equity opportunities, there are many of them, but there is a role that token ecosystems and networks and protocols are playing. And if you haven't been investing in that, you likely aren't here, still in the industry today, talking about being successful in this industry. And I think that that's where we need to be honest, that there is this inherent challenge that VCs are dealing with in terms of how do you put that into one vehicle and manage it.
Maybe I'll comment on one thing there, which is that it's not that we never sell. It's just that we don't see the liquidity event or the token going live as the time to sell, right? Like the time to sell is when the thesis has been realized, right? If you look at actually, Sequoia did some interesting data around this. They made a lot more money when they actually held, like if you looked at the returns of Square, for instance, like the returns of Square primarily happened after it was already public. If they had just decided to sell everything at the $3 billion IPO, like, would have been a good investment, but then it ran up to a $100 billion company, right? And we're starting to see this with tokens as well, where, things that are back from the dead, like Maple or Euler or others, like there is room for protocols to build product market fit and to build sustainable, long-lasting companies. And the perspective of a lot of crypto venture capitalists has been, okay, you launch a token, that's the product, I dump it on retail, and now we've all made money, and let's go be rich in Switzerland or somewhere, right? Like that is the problem that we have in the space, and why we have these things that or this like retail Twitter phenomenon where people think VCs are the bad guys, because there's just so much short-termism in the space. Like if we try to self-regulate in a way that is saying, like, listen, like we can have longer lockups, we can be more thoughtful about what those vesting schedules look like. We can maybe have milestone-based payments for teams and et cetera, right? Like now all of a sudden it becomes okay, like we're all aligned to building a better future, right? And protocols that make sense. And so our perspective, or at least my perspective, has been that things like Echo, Echo's great, right? Like it's, crowdfunding's been around since 1995 or a little bit earlier. It's been around for a long time. Like it's a good way to get, retail capital and do capital formation and as part of, the structure of private capital, but it's not going to replace venture. Venture still needs to exist. We just need to do a better job of defining like what is venture, what is liquid, what are we trying to get out of this pool of capital, and that opacity is more of the issue today and the lack of transparency than anything else.
So, yeah, I agree with Lior that structures like between liquid and venture. I think more funds are now going towards liquid because venture returns aren't there. And like as Rob kind of alluded to it, I think in my personal opinion, the venture structure is completely broken, and it's changed over the last 2-3 years. Where like as a venture fund, I feel like I'm at the bottom of the stack. The founder sells their shares even before their token's launched, OTC it out. KOLs make the money, and as a venture fund, I'm expected to hold when there is no bid for my tokens in 3 years by the time I get unlocked, right? So I think over the last 2-3 years, bad actors have gotten rewarded. I think bad governance has happened. There is no board, there's no accountability for founders, and I think as a venture fund, we should be enforcing that. Like in Web 2, like a founder can't fart without the board knowing, basically. Whereas in Web3, I know founders who've exited their bags before they've even listed on the exchange sort of thing, right? So I think the structure needs to change where, as a venture fund, we need to enforce more accountability, more granular detail from the founders, and have them, answer to questions and like work alongside us rather than like just exiting first.
Well, I think like this is a good point, right? Because it's a governance point, right? And like governance exists in a very like known and well-trodden way in Web 2 and in traditional equity companies, even in Web 3, but in traditional equity companies. Most of the reason there hasn't been board and like real governance today is one, because the VCs haven't wanted to actually like do the work. Like it takes time, right? Like I spend a lot of time on the boards that I sit on. But two, because there's a lot of regulatory concern around like how you might be sued if you're on a board and what the situation might look like in the US. That's changing now, right? And at least from my perspective is like it is up to us to do the work to make sure that there is real governance, so you don't have like move type situations where like everybody is trying to like sell before they're supposed to be able to. There's a lot of opacity, and it's essentially a Ponzi scheme, right? Like, and that is what happened in Move because the venture capitalists didn't do the work, right? And so it is up to us to enforce the world we want to see, in my mind.
I think I agree with you, Rob, that a lot of VCs don't want to put in the work, but also I think we shouldn't forget a lot of these VCs are not VCs. They are random traders that trade on the back of the future of the founder and extracting value from retail. That's really what they do. They made a little bit of money in 17 and 21, had a few friends and family, gave them a little bit of cash. That's basically what, so 90% I would say of VCs right now, they call themselves VCs, do. And I think that's a huge problem because what happens, these are bad actors. And they want, in order to raise a fund with having no DPI, they need to create artificial DPI. And how do you do this? You force a founder to spend all of his cash for vanity metrics so they could list it on a somewhat okayish exchange that gets enough volume so this VC can actually extract the money back out immediately. No wonder vesting periods have been cut down to 12 months. No wonder OTC deals, it's basically founder versus VC OTC deals. Who is going to sell it first on second lane or some other exchanges. And no wonder exchanges, lawyers, service providers, agencies are the only ones that are actually benefiting. They all make a lot of money, and we are now at a point where there's no real utility in the space, or barely, and you have cases where really fundamental businesses are struggling, that create real revenue from the Web 2 world, that are struggling to be listed on any proper exchange. Even though they have a fundamental business model. But the net new users for the exchange might be better if they have a meme coin. That's
I mean, it sounds like there's a bit of a structural challenge. If you look at the numbers, right, there is a relative abundance of total venture capital markets, which drives the fact that founders just have an oversupply, probably, of like available venture funding, so they can just pick whoever has the weakest governance requirements, right? And get away with it. So is this sort of a reckoning for the industry, right? Like we see like, venture capital, it's much harder to fundraise right now. Maybe it's a good thing, right? That means that the bad VCs just cannot fundraise and only the good ones can. But I doubt that LPs are that sort of advanced to be able to fulfill that selection function that's required for the industry. But maybe let's move forward the next step. Like, what, as leaders, right, leading investors in this space, what have you done, or what are you planning to do to kind of like change some of this like unsustainable parts of the industry, right? Who wants to start? Yeah.
Sure, happy to take it briefly. So we take a complete different approach. We're not a fund, we're not a GPLP structure, we're a Swiss holding company, because what Lior said actually, you cannot fulfill all of these things, liquidity, TVL, all of this. And we are 3 founders. We have exited multiple companies, we've crashed multiple companies, we've gone bankrupt together 10 years ago, all of this. And I think we have founder empathy. We know, we bring the DNA, and thankfully we have 3 partners, where one is really built cryptography solution for NATO frontline soldiers, another one's designed cities in Asia, and so on. So we have really 3 different perspectives. And we realize how difficult it is to found. We see first-time founders, what do they want? They want cash. Nothing else, shut up, leave me alone. Second-time founders, what do they want? They really want to be picky. They want to like, okay, who's the right sparring partner for me? And I also need you to provide TVL and so on. So what we did, we became a venture partner in another fund where we can provide up to 30 million in TVL on top. We also became a venture partner in a fund with the largest Ethereum validator. We can provide 30,000 nodes with the investment. And we are very hands-on, and that's why we call ourselves private equity for permissionless tech. This has nothing to do with leverage buyouts, has nothing to do with control. Forget everything you've learned about PE. All it is, it means founder DNA, it means real unit economics. Like, how many founders do I ask, okay, how much money do you make per TVL, or how much money do you make per volume, and they don't know. It's really scary. They all think last round was at 60, next round's at 120. Well, I don't care what valuation. I need to know what your unit economics and growth are. And I'm really surprised how founders, the lack of understanding of founders are. So basically what we tell ourselves, we put KPIs to ourselves. We need to be able to support founders in critical inflection points, and that can be liquidity, launch, listing, and growth. These are the 4 points founders are struggling daily, and that's why we work with founders on a daily basis, no excuses. Every day we speak to our founders, and we try to really make their lives easier and focus on the product. So that's why we are focusing more on the PE side and providing additional TVL, providing additional infrastructure, and so on. I think that was at least our only way of getting into these rounds as a small fish. Like a Dragonfly, a Paradigm, an A16Z, and so on. Ideally, they come after us. But yeah, that's our only way how to get in there.
Can I address a point that you made earlier, just very quickly? The average rate of return, or the median rate of return in Web 2 venture is 17%, an IRR, right? Like, people in venture, whether it's crypto or not, this is not specific to us, like, they're not making good returns at a medium level, right? The best, all the returns are basically in the top quartile, right? That's true, I think, in crypto venture. It's definitely true in Web 2 venture. We have the data that shows that. And we've started to see a right sizing of funds. If you look at the amount of capital raised from LPGP capital last year, like 85% of it went into only funds over $500 million in Web 2. And then there's a few like niche emerging managers who are able to raise capital as well. We're seeing essentially a hollowing out of the quote unquote middle class of venture. That is not a crypto specific point. It is a point that's happening across all of venture, because there has been too much capital into private venture capital broadly. And that's true in crypto, and it's true of non-crypto. And so, like, I do actually think the LPs are sophisticated enough, and you don't give yourself enough credit, Xiao, to be able to figure out, like, who is good and who's not. Like, where am I supposed to be putting my capital? Because they understand this perspective, and this is why this is happening. And so, I think the fact that, like, there's no longer $2.5 billion, Paradigm raised a $2.5 billion fund in 21. Great fund. They raised 850 last year, right? Like, this right sizing is happening across the whole industry. The amount of funds that I've seen who raised, $300, $400, $500, $600 million in 21 and 22, who are raising 200 today or 100 today, or struggling to raise, it's endemic. There's so many of them happening, and that is a good thing. That right sizing is happening, and I think the LPs are causing that, right? I think then to your point, well, like, how do we solve some of these structural problems? Well, like, again, it is up to us. Like, for us, like, we've taken the perspective that we don't co-invest with certain people. There's certain people on the cap table that we think are people who try to formulate or facilitate pump and dumps, we won't invest in them. And we have a list of people that we think try to do that, right? We are a lot more thoughtful around governance than some people are. And like, we don't negotiate on that. If a founder wants to pick another fund because they have light governance and won't pick us because we have actual governance, well, like, that's not a founder that I want to back, right? And that is fine, right? And so I think there's just we just have to understand that the market is going to only change if we change it, right? And then we have to collectively work together as good actors to be able to do that. We've been talking to, one of the things that I think is a problem in the space right now is there's not really a disclosure regime. And so I've had a lot of discussions over the last couple of months with exchanges and with other venture capitalists alike on like trying to put together a disclosure regime, because I don't think the government is going to do it for us, right? I don't think the SEC and the CFTC are going to do that. And so how can we help push that forward? And that's the only way it changes in the near term, in my mind.
Maybe specifically to the point, right? How do we prevent these kind of like founder OTC or like treasury like outs? Like you're one of the leading investors in the space. How do you address something like that? Like when you do DD, you may not know, right, that these kind of things happen, and then founders are incentivized. They're offered some of these deals. Like how do you prevent that?
I mean, I'll let these guys talk too, but like it is in the documentation that they cannot sell unless we are also selling, right? Like if they do that, it is illegal, and we can sue them, right?
So you sue them.
Yeah, I mean, we haven't, and God forbid we won't. And hopefully we partner with the right with the right entrepreneurs that like it doesn't get to that, and we try very hard to do deep diligence on, the people that we're partnering with. But like there is actual governance involved, that there is legal ramifications if they were to do that.
So, sorry. To Rob's point, I think like we're pre-seed seed, right? So sometimes we will just be co-investing alongside others. We're not at the level where we're lead or co-lead. And in that stage where a venture fund leads or co-leads, doesn't put governance in place, we're just along for the ride sort of thing. And that way we're kind of screwed because, one middle tier fund didn't put in governance, so now the founder's running amok doing their OTC sort of thing. And part of it's like a self-fulfilling like cycle where founders will only go to funds that will give them zero governance. And that fund will then, in turn, only fund founders that will help them exit and leave sort of thing. So I think there's like that cycle needs to be broken, because sometimes they get all the deal flow, and like if you call them out, you are shunned. Like for example, in the case of Movement, everybody knew crime was happening, like day one. Like all the funds on the cap table knew crime was happening, but nobody called it out. Because the moment you called it out, they'd be like, okay, don't send them deal flow and don't talk to them with that sort of thing. So that needs to be a little bit broken. But like, as the guy said, both Rob and Matthias is like, when we lead and we co-lead, we put it into terms that like, I need a monthly report. We're so early stage that we also help with the recruitment, so we know all the salaries that are getting paid. We know all the token allocations that are given, what the vesting is, and all that sort of stuff. So like, yeah, like that governance, I guess it needs, because more funds need to kind of see it the same way that we do. But like, there's a lot that are out there that just want to make a quick buck and fuck off, basically, sort of thing.
So I think the conversation's taking a little bit more of a founder versus VC approach here. And I don't think that's, I want to call that out and say that's certainly not how we think about it. The honest truth is, if you're having concerns about founders exiting OTC deals in a company, you as a VC have failed in your diligence process, assuming that we're all doing the things that we're saying here on the stage, which is backing entrepreneurs to make a real difference and not just make money quickly. So I do think that is a foundational quality that perhaps hasn't existed in the past. I think we can all acknowledge it hasn't happened, movement, a lot of things, and when you're in the middle of something, it's difficult to call it out as and when it's happening. But the basic principle that founders are selling against VCs in OTC deals in advance, that's a reflection on you, because when you as a VC are coming to the table, we are far less risk on than most of the founders are, right? I mean, we have eggs in multiple baskets, we construct portfolios, they build companies. It's a very different risk profile. What they're engaging in is a multi-year, often at least should be, multi-year commitment to build and scale a project, protocol, business, whatever it is that they're going after to make a meaningful development in the industry. And if it wasn't an exciting idea or big enough opportunity, it wouldn't be venture capital backable. And if it wasn't someone that you would trust to deliver that return and value back to investors as well as to themselves and to the community. And we all understand how important community is in Web3. It's a foundational piece and tenet of what drives success in this industry. If that doesn't exist and you don't have the belief that those founders are going to do that with integrity, I think that that's really a reflection on us and to be honest, is where the industry has come from. Going forward, going to be very different. It already has been. Raising capital's become harder. VCs, there's less bad actors. There's less VCs out there with big checkbooks to deploy into God knows what. And now I think we're really at this point where there's an alignment and meeting of the minds between founders, and it's a win-win relationship. It cannot be us against them, and that will never succeed.
Fully agree. Now, coming back a little bit at, as an investor, an LP in crypto VCs, obviously we're in there to return money, create like financial return, right? And some of the tension, obviously, and I fully understand that. We're obviously also one of the biggest private investors in the world, so we're dealing with similar things on a day-to-day basis, but obviously much later stage. Let's talk about exit strategy, right? Like, because you're all in the business of returning money to your stakeholder. Like, even if you manage your own capital, but you still like have a duty to yourself to kind of like multiply that, right? Now you have that inherent tension, right? As Rob mentioned, we are in an industry in Web3 which is inherently super volatile. It goes up and down all the time. When it goes up, right, you don't know if it keeps going up or it will go down, right? So you have that fundamental choice at any time, right? Like, do you believe in your thesis that you had 3 years ago and just hold it, hope for the best? Or do you de-risk and hedge and take some money off the table, OTC, follow-on rounds? How do you deal with that, right? And then second question, target returns, but like, it's interlinked, right? Like, whatever is your goal, like, are you trying to hit an IRR target? Are you trying to hit a multiple money target? Actually, probably impacts your choice, right? When you're faced with that selection problem. Maybe Rob, let's start there. We have that conversation from time to time. But
I'll try to be quick. But listen, if you're trying to hit an IRR target or a multiple target on a single investment, like, it's not going to be good for the portfolio, right? Because the reality is in venture, and it's a little less true in crypto, but like, it is a power law game. Like, the best investments.
Venture, not private equity.
Right. It's different in private equity, but in venture, like, your best investments, they return the fund, and then you have a bunch of stuff that doesn't do particularly well. And like, so you have to be more thoughtful around, okay, like, what is the thesis? am I still constructive about where this business or this protocol is going? Do I think it's extremely overvalued, or do I think like they're going to continue to execute? And so for us, it's about a thesis specifically around that business, that protocol, and less around like a price target, because that is not, like, one, fundamental analysis in crypto doesn't really work, and two, like, that's just not what we are supposed to be good at, and we're not, price targets just don't really make a lot of sense. And so when something is liquid and it trades up, and we think that it's fulfilled the underwriting that we had, the thesis that we had, and we see it as like a mature company or a mature protocol, we'll monetize. And we do that all the time. We'll monetize in a way that we think is more appropriate or doesn't harm the protocol. And so sometimes there's low liquidity when we don't want to jam a market and kill a price. But that's how we decide to do it. I mean, and Shasha, as you know, right, like 35% of our portfolio is equity. We've also started to see a significant amount of equity exits recently. So we've sold 3 companies in the first quarter that we had relatively good returns on, and one really good returns on. And we're starting to see a lot of interest there as well. And so I think, from my perspective, it's all about re-underwriting that investment every week, every month, and making sure that like you still have a thesis. And if you don't, that's when it's time to get out.
I just weigh in on this because I think it's an important distinction of what is the role of good venture investors, and to Rob's point, re-underwriting theses is important. But let's take 2 of the most concrete examples that come to mind just based on what we've seen. Circle, which has just IPO'd, talk of the town, obviously, and glad to be on that journey. Circle was not a stablecoin company 5 years ago, right? Circle had raised hundreds of millions of dollars, had competed as an exchange, had acquired Poloniex, had done so many things over the years and reinvented itself so many times to get to a point where its capital markets debut in 2025 is as successful as it has been. That is incredible, and that shows you a lot of the resilience under the scene. But we were not underwriting that investment in the series A, B, C, Ds of that company's growth cycle. And you could say maybe that's the equity story. DeFi is different, on-chain activity is different because people have a clearer focus. Potentially, if you were to tell us, I mean, and we led the Solana private public sale back 2019, 2020, took them to market, helped with that, and Multicoin was the biggest investor. Regret we weren't a bigger part of that, but ultimately, if you told me today in 2025 DeFi was going to live on Solana, no one knew what DeFi was. They certainly weren't calling it DeFi, and that framework and understanding of where transactions were happening, what was living where, didn't even exist, which takes you back to the concept of what is the role of a VC? How is that different from PE and strategies there, where you're buying operating companies, achieving scale either through revenue growth or cost synergies? In VC, it's a fundamentally different business model. It's a fundamentally different product, which is working with and supporting the best founders and entrepreneurs to do, be resilient, adapt, and capture opportunities in the market, which is why, if they're selling against you in OTC deals, probably not the right founders to be backing in the first place. Always easier in hindsight, but the concept is people are adapting to the market opportunity, and it's the long-term winners that present themselves when they've shown they've been able to reinvent and capture opportunities and continue to dominate and own a vertical. And I think that's what separates the top end of town from everything in between.
Yeah, I think to your question, I don't think selling your tokens and monetizing your investment doesn't mean that you do not believe in your thesis, right? I think you straddle both. In the sense that we monetize in a constructive way, talk to the founder and say, hey, market's up, it's 5x, 4x, whatever. We'll work with market makers so that it's not destroying your token. But that's why we pay the premium in the beginning, right? That's why we wait for so long. That's why, obviously it's shorter in Web3, but that's why we pay the premium to monetize it, sort of thing. But also, we still, I've been in the game since 2010, 2011. I still speak to founders that I funded in 2016, 2017, even though I'm completely out of the token, for example, right? So selling and making a return doesn't mean that you abandon the project completely. I'm still helping founders on their third project or the fourth project that I've known for 10 years, sort of thing. So I think you can straddle both, but obviously doing it in more of a constructive and helpful kind of way.
Yeah, and I think from our side, we're looking at it completely different because obviously we have a different structure, no GPLP structure. We're looking very, very long term. And we need to have a sustainable model because there's no management fee, there's no performance fee, there's nothing. So basically, the way we structure it is basically time, money, and value add. Time, we believe the best investors over the history have been the one that didn't invest for very, very long periods, but then really doubled and tripled down when it mattered. So we never wanted to have a dependency on time. Oh, we got to deploy now. Oh, we got to do this now. So we want to decouple ourselves on time. Money, we want to decouple ourselves from external money sources, obviously for multiple reasons. Because also, let's say you have a closed fund and you need to deploy. And the third one is value add. Our goal is we never want to compromise on value add because our fund closes and we got to sell at times when it might not be the best time for founders. So those are kind of the three things that we're looking at. We don't do OTC deals. It's just not really what we're interested in. And we need to look very, very long term. And it needs to be a sustainable model. So when we create DPI, we put that into a hedge fund that creates monthly. So we're LPs in hedge funds, and they return monthly capital to us to make our entire model sustainable. That's our internal goal.
All right, we're closing statements. I would like to spice it up a little bit, and so I'm asking for a closing statement from each of you about something that you believe others on this panel might disagree with, but you have high conviction in related to crypto investing. Who wants to start?
All right, I guess I have to start. All right, I would say in the next 2 years, 90% of all venture capital firms will be bankrupt or will no longer deploy capital.
It's a shame. I kind of agree with that one too. No, I think on this panel we mostly agree with everything. I think from a specifically from a fundraising perspective, we're about to launch fund number 2. I think most VCs that I speak to think that if they've performed well on a $25 million fund, they're going to return the same on a $100 million fund. And this is more like a fallacy, I think, in most VCs that if you return well in a smaller fund, you're going to do the same DPI or MOIC or whatever it is in a bigger fund, and it's mostly never the case.
Yeah, nothing else revolutionary to add here. I think we're in too much of agreement, but the industry will fundamentally change. The market participants will be consolidated, and yeah, I think the idea of multi-billion-dollar venture funds, while possible in aggregate on single vintages, I think we'll see decline of, and the way in which people partner with ecosystems. You'll be able to build companies, AI-backed companies, enabled companies, will have 8 to 10 people managing trillions of dollars of TVL, and you don't need hundreds of millions of dollars of VC backing to scale operations. The industry is going to be completely transformed, and crypto is where it's going to happen first, and I'm incredibly excited about that.
Yeah, maybe we all agree with this point, but I think like Web3 VC is just going to look a lot more like Web2 VC in 5 years, and like people who hold for the long run, that are thoughtful about governance, that are going to try to figure out how to build sustainable businesses and protocols. Like eventually they are going to win. Like we have been rewarding bad actors because of the early liquidity and the regulatory arbitrage that has existed. That is going away, and this whole market is just going to change completely.
All right, I believe we are at time. Thanks all for your insights and discussion, and yeah.
Thank you.
Thank you so much for that. Very cool to see where some of the folks that helped get the industry where it is today see it going in the future. We've got an amazing panel coming, or fireside, I should say, coming up from none other than Stani Kulichov, the creator of Ava. Total value locked, I just checked, was $26 billion. He's going to be in conversation with Romain Dillet from TechCrunch. Can't wait to hear what they have next. Please help me welcome to the stage Romain and Stani.
Hello, everyone. Stani, it's great to have you here. I remember that we chatted on this very stage, which was actually over there last year. It's been 12 months, and a lot has happened in crypto, at your company, Avara, in US politics, everywhere. A lot of things happened, so it's great to be able to catch up. A few days ago, you posted on X that the liquidity of Aave was standing at $38 billion, the total value locked. Why do you think this number is so huge, and why do people choose Aave over something else?
Well, it's actually 43 billion.
Wow.
And net deposits. But I think there's multiple things that tie into that. So, I mean, we started with DeFi when it wasn't really a big thing, and it was a handful of...
when was that? 10 years ago, something like that?
Maybe like in 2017, 2016-17 was a time when we saw like first experimentations, and we saw Ether Delta. That was first kind of like implementation of a decentralized exchange. And I think now, over time, there's a lot of things that has made it easier to and reasons to use DeFi. So one big driver obviously has been stablecoins, and stablecoins has been a big driver, especially during 2020 when we had a lockdown and interest rates were down, and DeFi became kind of like a opportunity for those users that were already in the crypto space and understood how technically use decentralized finance.
Yeah, there was also the NFT craze, as I call it. Why do you think NFTs were so popular and not necessarily DeFi taking the center stage?
I mean, the thing about DeFi is that it's really true utility. So if you look at some of these bigger DeFi protocols, they actually have a good purpose. They have a product market fit. And they also are decentralized organizations that generate revenue as well. So if you look something like the Aave protocol and the Aave DAO and MakerDAO, these are actually very useful protocols, and they're generating revenue as a DAO. So really good kind of perspective is that when you start a company and you try to reach product market fit, that is extremely hard. Second thing is that making a company profitable is extremely hard. Doing that as a decentralized organization, that is extremely hard. So being able to be here after years and seeing some of these DAOs and protocols being actively used and having billions of dollars worth of liquidity is really astonishing accomplishment.
Okay, so before we talk Aave V4, bring us back to the days 2016, 2017. Because you said this was extremely hard to start this thing, to get adoption, to turn it into a profitable project. Why did you start in the first place? Was it because it was an engineering challenge? Because you really liked finance? Because you looked at blockchain and you were like, oh my God, this is going to be great?
I mean, the big driver was really Ethereum, in the sense that Ethereum enabled this programmable computer, and one of the early ideas that you could effectively do is financial applications, because Ethereum derives from the blockchain underlying technology of Bitcoin, and Bitcoin trying to solve a financial problem, transferring value between the people. And for me, what was interesting is that first time ever you could actually program a system, financial system that is permissionless, that anyone can access regardless of their backgrounds and social status or whatever they are across the planet, and guarantee the execution, so no one can actually come in between you and a DeFi protocol if it's like directly integrated, and actually change the way the transaction will behave, for example. So that was a big driver there. And I think when we started, we saw a lot of centralized lenders also launching at the same time and raising hundreds of millions worth of venture capital funding. And what we saw over the past years is that DeFi basically proved its resiliency. So a lot of these centralized lenders, they don't exist anymore in the crypto space, mainly because of the poor risk management that they had. And the only thing really stood up really well is the decentralized protocols like Aave, and proved the resiliency. So we liquidated a few months ago over 200 million worth of positions with just a few minutes without any issues across multiple networks. And that's a really big statement for resiliency. And virtually, if you look at today, the whole lending and borrowing space in crypto, it's moved fully on chain. And I think this technology is very agnostic, not just to crypto assets, but in the future also for RWAs and traditional assets that are coming on chain as well.
Okay, and so Aave V3, it's more than $40 billion in value locked.
And net deposits in total.
Yeah, net deposits. And so you're working hard on V4. Could you give us an update and the reason why you are upgrading Aave?
Yeah, one of the things what Aave is very known for is that it has extremely deep liquidity. And basically, whenever there's a new asset listed on Aave, it gets quite a lot of traction, whether it's like we had with the Pendle P tokens, PT tokens as an example, or staked ETH, or wrapped versions of, for example, Bitcoin. There's a lot of scaling that happens. But something we want to enable in the future is that how we can empower a lot of innovation and seed that innovation with liquidity. So, for example, if we have builders today in this room and they have some sort of an idea of creating a borrowing configuration or using RWAs as a collateral, or some sort of like a unique unique borrowing configuration that goes up on the risk curve. So how Aave could actually enable and empower that type of a use case. So we are introducing a new type of architecture with liquidity hubs and liquidity spokes. So liquidity hubs are where the liquidity is stored across the whole protocol, and spokes is basically a borrow configuration that every user always enters into the protocol, but the liquidity itself is stored in the liquidity hub. So what it means is that if you create some new type of innovation, you can request liquidity from the liquidity hub, and that's automatically funded that you can access, that your users can access into that. So what we're solving here is that any new type of innovation can get the direct flywheel effects from the Aave protocol and the deep liquidity that it has. And it also means that that liquidity doesn't need to be incentivized with rewards, because you get direct access to the whole pool. And what we want to actually see is different kinds of innovations, risk profiles being able to be utilized in Aave, segregating the risk, but without segregating the liquidity network effects. And I think that's a really unique value proposition and can fuel a lot of these upcoming use cases, whether it's RWAs or just moving further down the risk curve. And for the users, it means that users can actually first time position themselves across that risk curve. So you can actually supply liquidity or borrow based on what is your risk appetite as well. And I think that's a really good value proposition.
And previously you talked about resilience as well and security. With Aave v4, do you think it's going to be more secure, more resilient? And would you say it's more secure than Lehman Brothers, for instance?
Yeah, I mean, typically when you look at decentralized systems and traditional finance, you have various types of risk categories, and it can be the third-party risk, the custodian risk, and DeFi really by design eliminates a lot of these risks. So you virtually don't have, let's say, custody risk because you are self-custodying funds and interacting with Aave directly. But it introduces other types of risk, which can be, for example, your key management risk and how to deal with that as an alternative, smart contract risk or counterparty risk of the assets as well. So with this approach and the new design, we're able to segregate all these counterparty risks that comes from these assets that are listed in the protocol in a way that they create a siloed risk, but at the same time without limiting the liquidity network effects that comes from a global liquidity pool. And we want to build the system in a way where these liquidity hubs can be also completely permissionless. So if you want to run your own infrastructure, that's totally possible, or you can rely completely on the Aave DAO or Aave risk managers to basically manage the risk for you. Another interesting thing we're implementing is a feature called risk premiums. So typically when you go to these lending protocols and when you borrow funds, you're paying the same rate regardless of your collateral composition. So what we want to change is that if you produce more risk into the protocol, you're going to get charged less. So if you only borrow against ETH, you are going to pay a base rate on the USD.
Which makes
borrow.
sense, yeah.
And if you add more risk, then you're paying a premium for that. So this is kind of like a mechanism to price the risk and reward more accurately within DeFi.
And one thing you recently launched was Umbrella. Can you explain what it is?
Yeah, something that Aave has always had is this concept of protection of the users. And in the past, it has happened in a way where we had a safety module where you have certain amount of deposits in the safety module that covers any kind of excess debt or shortfall event, which can be based on smart contract risk, counterparty risk, or Fed liquidations, for example. And those reserves usually has been based on the Aave token. So Umbrella is changing this concept completely by not leaning into that Aave reserves, but instead introducing the ability to secure and protect and backstop the risk with the A tokens. So users who actually want to earn additional yield that are supplying, let's say, stablecoin liquidity or ETH into the Aave protocol, they can restake their tokens into Umbrella, get additional yield, but also take the first kind of like risk of the protocol. And what it means is that then we don't need to use the Aave token as a backstop mechanism, which is great for the token itself. But secondly is that you actually share the risk with the users that are willing to take that additional risk of the users that need that type of a protection. So it's a really great tool and kind of like a selling component for integrators and users that are less comfortable with DeFi, but will be more assured when there is this type of safety mechanism.
So if you're supplying tokens to these reserve funds in Umbrella, you're getting high yields, but at the same time, there is a risk that this money is going to be used in worst case scenario?
Yeah, and the risk is basically 20 days. So you lock up the funds for 20 days. And what I like about the system, it's basically, it backstops a particular reserve. So USDC Umbrella protects the USDC reserve, and it's very asset specific.
Okay, cool. And Aave V4, when do you think you're going to launch?
Well, we've been building it for quite a while, but we're in a place where we're comfortable with the technical implementation. So now it's more about optimizing the final implementation of Aave V4. It's a really exciting version because we remodeled the whole architecture that we had on the previous versions, and that's been a lot of work, but also different types of design and technical decisions of simplifying the protocol, making it more modular, but also making it very easy to maintain for the future and expand as well. And what's interesting about the whole V4 is that anyone can start then contributing directly into the Aave protocol, expanding it or improving certain modules or adding new modules into the protocol.
I'm sure everybody in the room has this idea that Aave is such a big team, they have massive resources, but actually, like, how many people are working on V4, and how do you make sure that it's going to be perfect when it launches?
We have roughly, I think, directly a dozen engineers, mostly on the smart contracts that are working. So it's very lean team. So I think Aave is going to be a technology that is going to be used by billions of people in the future. But it's such a kind of like a simple piece of infrastructure. If you compare it to the traditional banking and how many engineers you have in fintech or from that traditional financial infrastructure perspective, it's very small. Like our headcount is very lean and small in comparison. But also, we're trying to build something very powerful in a very simple way. But it is a technology that will scale in the future for also into the traditional finance.
Yeah, I wouldn't say it's very simple, but I hear you. Compared to finance in general, it's very small for sure. I want to switch gear. A topic you've been very vocal about is RWA, real-world assets. Why do you talk a lot about it? Why is it important in 2025?
One big thing about the DeFi is a lot of DeFi is powered by crypto assets. So a lot of the yield comes from crypto assets as well. And I think going down the line, to scale DeFi in overall, we have to use Aave and DeFi for agnostically to any asset that has some sort of economical value and could exist on chain. So what I think that stablecoins has been really great kind of like a benefit for DeFi, because stablecoins provide stability, but the biggest feature of stablecoins is that you can access DeFi yield, and you can't do it in any other way actually. To access DeFi yield, to consume DeFi liquidity as a borrower, and that creates the interest rate market. So stablecoins are probably outgrow the native crypto assets at some point, but then actually what's going to be even bigger is the RWAs. So bringing traditional assets into on-chain and then being able to use Aave agnostically for these assets. And the way we're approaching this field is with the Horizon deployment. So Horizon is a Aave market where you can use permissioned RWAs as a collateral to borrow a permissionless stablecoin liquidity like the Aave native Go stablecoin or USDC. And why is this important is that the more we get the value out of the traditional system on chain, the bigger the DeFi opportunity will grow. So for example, a lot of the economics of interest rate markets are driven today by central banks. So for example, we have a specific rate in Fed. European Central Bank has a rate which recently dropped a little bit down, and Bank of England has its own rate. So a lot of the yield in traditional finance is driven by central bank economical planning. Now, we know that at some point these rates are going to go down because you can't keep high rates for a long time because it stalls the economy. You get less, the participants in the economy, they move less funds, slowing down the economy, risking a stagflation. So when this opportunity goes down, the DeFi opportunity increases because DeFi is going to be the best place for all kinds of financial opportunities distributed globally and can be integrated from any part of the world, essentially. And RWAs is a way of expanding that opportunity. So there's so much of the crypto native yield that can be distributed. So to scale, let's say, billions of people, we have to have RWAs and create these financial opportunities by borrowing against RWAs, creating interest rate markets, and then allowing anyone to tap into that yield opportunity across globally, whether you are building a DeFi interface or a fintech or a traditional asset manager or a bank.
And do you have discussions with traditional financial institutions, with trading desks and things like that? And do you say, hey, maybe you should tokenize these assets and trade in a tokenized way to be more efficient and get more yields, better performance?
Yeah, and I think it's been always like an on and off discussion, except the past 12 months, I think, has been probably the most active time, at least for us. In the sense, I think that BlackRock coming with the Biddle Fund has been driving a lot of the excitement. There's a lot of asset managers also today here that are thinking about tokenization, or they have already live assets on chain. One of the biggest challenges always for tokenization is to understand what is the specific use case and what you should bring on chain and what could provide the value. And then how do you sell within your organization that value add? Because I think we have to think beyond the use cases of selling traditional financial assets to crypto audiences, because crypto audiences are more interested in crypto assets and that side of the risk curve. But there is a lot of value that you can have when you tokenize assets and create utility. And the utility comes from decentralized finance, and it comes from Aave. When you can actually collateralize your assets, borrow against them, creates interest rate markets and creates direct utility. And in DeFi, you can do things that you can't do in traditional finance. You can't go at, let's say, evening on a Saturday, borrow in one transaction against your assets and return them in an hour or, let's say, the next day. There's a lot of inefficiencies in traditional finance that DeFi fixes by just nature, how it's built by design.
Yeah, being able to work 24/7, basically. I want to switch gear and talk about stablecoins for a minute. I'm sure you've seen last week that Circle went public in the US. The market reaction was pretty insane. They raised quite a bit of money when going public. Do you think it's a win for the stablecoin ecosystem?
Yeah, definitely. I mean, I think any legit company that needs additional capital and choosing capital markets to do so is beneficial. They have better access to the liquidity, better opportunities, not just only funding their activities, but for M&A as well. Because something that Circle doesn't have is the distribution. They have the infrastructure. So I'm expecting actually focus also in obtaining distribution as well, whether it's an exchange or some sort of other form. And I think we're going to see a lot of stablecoins coming also from the fintech space, but also the kind of like a big tech as well. That is going to happen. And I think that...
Well, Facebook tried. They didn't really succeed with stablecoins.
Yeah, I think it was too early, too big and too early, and the structure wasn't necessarily the one that helped them to achieve this mission. But I think that will come again, and we'll see others doing the same. And there is a value, because if you have billions of users and you are able to settle transactions between those users and offer, for example, DeFi, that's going to be a big thing. So DeFi is going to be a really critical piece of infrastructure, not just for fintechs, but for big tech. And it boils down to ability to earn yield, but also down the line, extending credit. And that's going to be the really exciting opportunity to extend credit globally without basically banks and traditional finance, and providing the best opportunities there. So economics of scale probably will push these stablecoins to maybe we have like 3 or 4 or 5 big ones instead of 100 different ones. But they all will benefit from DeFi.
And you have your own stablecoin, Ghost. How is it doing?
So Go as a stablecoin is
Go, yeah.
Go, yeah. What we want to achieve is resiliency. So the same way as we started Aave in the first place, is that we wanted to build a resilient alternative of existing lending infrastructure and lending businesses. So we've done that with Aave, and we want to do with Go. So stablecoins are great, but they still have single point of failures, the centralized stablecoins. But with Go, we actually want to provide a resilient alternative. And also, what Go does for the users, it's effectively bringing them a predictable borrowing cost, because the rates in Aave are fluctuating based on the supply and demand. And for the Aave DAO, 100 million worth of Go is creating the same amount of revenue as 1 billion worth of USDC or other stablecoins. So it has a really big impact. And more recently, we launched SGO, which is a kind of like a savings product that you can earn 7% yield on Go without any cooldown and without any slashing risk. And it's purely redistributing the revenue that the Aave protocol is earning on Go lending on the Aave protocol back to the users that are using this savings module, essentially. And that's a really interesting opportunity to get risk-free yield in DeFi.
Yeah, it makes sense to have your native stablecoin, basically. One last question, because we're nearly out of time. I know you're a big Ethereum believer. Bitcoin has been rising like crazy. Other chains are sort of hip right now. Do you think it was the right bet to believe in Ethereum from day one until today?
Yeah, I think it's also like the only place where you can like build very kind of secure protocols, in the sense that there's EVM is well known, and also the tooling is in a really good place. If you go to other ecosystems, you can build DeFi, but you don't have the same tooling, and it's especially hard for new DeFi builders, because you want to build something really safely and securely, and if you don't have the ability to write fuzzy testing or have a proper test suite that is well integrated into the blockchain system, ability to simulate, fork the blockchain and simulate different transactions and states and play with the block time. If you don't have these tools in other networks, it's going to be hard to build very safe protocols and test them properly. So Ethereum is the only place that has this, obviously because there's been DeFi and there's been building on not just DeFi, but all kinds of applications for years now. And then the fact that Ethereum has a lot of liquidity, and those liquidity network effects are quite important. So Aave has grown most in mainnet and DeFi as well. So I think Aave is agnostic to technology as well. So we do have implementation in Move that we're launching on Aptos. So we don't purely build only on Ethereum, but that's where the most of activity and liquidity is at the moment.
All right, Stani, thank you very much. and have a good day in Paris. Thank you.
Thank you.
Amazing, amazing. Thank you so much, Stani. That was so cool to hear all the insight into what you have planned going forward. I know that this is a fireside that people have been looking forward to for quite some time. I personally have also been looking forward to it a lot. We've been following Goldman Sachs's movement into the tokenization space and other applications of blockchain for many years now. But we have an opportunity to hear from Matthew McDermott, Global Head of Digital Assets at Goldman Sachs, in conversation with Carl Rusch from right here, Head of Operations at Proof of Talk. Please help me welcome Matthew and Carl to the stage for a fireside inside Goldman's digital asset strategy.
Hello, hello. Welcome, everyone. Welcome, Matthew, with us. He's not the most often seen guy at any of the crypto conferences, so it's a pleasure to have you here with us today.
Thank you very much. I mean, what a setting. It's amazing.
For now, today, I think it's a topic that is not the traditional crypto conversations that we have, but I think it's something new and something very exciting coming up within the Goldman ecosystem and the whole traditional finance world. I think zooming out, giving the context here, Goldman Sachs announced the spin-off of the digital asset platform for next year. And I think for now, maybe you give us a background of the business for digital assets at Goldman so far.
Thank you. Well, thank you for having me. And I think I caught the first question with the noise. So what are we doing at Goldman in digital assets? So it's a journey we've been on now for 5 years. We've been pretty active and evolving the strategy, as you can imagine. But I'd say it kind of manifests itself in kind of 4 kind of key areas. One, very focused on the ability to trade the asset class. So we're very active, in different pockets of crypto trading where we have the permissibility and the regulatory approval to do so. So you could see that across ETFs or cash-settled instruments. Big focus of that part of the business is continuing to build out our geographic footprint, as well as our product suite pursuant to client demand. Second part of the business, which I think we'll talk a little bit about today, is around tokenization more broadly in the digital asset platform. But we also have a big emphasis on the use of the distributed ledger technology to transform the whole collateral kind of mobility, so the financial plumbing of the markets. And this is something, in our mind that's kind of ripe, just given the efficiencies that really can be born out of that. Third area is more, I would say, around the kind of classic part of the business. So when you think about investing, we've invested in a number of companies that are strategically aligned to what we're looking to do, and be that to kind of accelerate or to complement the strategy. And then probably a big kind of theme that we're seeing this year is in the classic kind of banking space as well, on the M&A side. So, I mean, anyone who's been following the market will see there's kind of more and more companies now looking to go to market, be it through IPO or thinking about kind of mergers and the like. So we've seen a lot more activity in that space. And then the last one, which is quite topical, just given SocGen's announcement, is on digital money. So really constantly kind of focusing on how we can get access to digital money in, I guess, the most expeditious but kind of risk-appropriate way. And obviously there's a lot of movement in the US at the moment on the regulatory side, so big focus on stablecoins.
Perfect, all right. So for me it was very surprising when I saw the news, industry owned and Goldman Sachs. I think that's something we know from crypto a lot, but from TradFi not too much yet. Can you give us more insights on the entity itself and then also the strategic thinking behind this?
So, yeah, on the digital asset platform. So I think, touching on the digital asset kind of platform. So So this is kind of a journey we embarked on in late 2020, 2021, where we were very interested to see the client demand to be kind of seeing how they can really start to operate in the tokenization space. I mean, this is like 4 years ago. And so as we kind of looked at the options across the market, we felt that, that journey was probably best suited with us looking to develop our own digital asset platform, to basically, have an appreciation of what was required, but also to kind of expedite our own expertise in that space. And as we, work closely with clients, deciding on the kind of architecture, the software we're looking to use, we built that out and launched it in 2022. I would say as a kind of key kind of focus of that kind of build out, we always recognize for the platform to be truly successful, it would need to be market neutral. So something that the market could use quite seamlessly, rather than it sit on Goldman's balance sheet. But the ability to really, I guess, kind of, like I say, develop the expertise, accelerate the development, it's probably suited us better to have that in-house. But now we're very focused on that neutralizing of the platform.
Excellent. You had some pilots already on the platform. What's the successes there, and in which direction do you think it's promising so far, and what do you expect in this direction?
Yeah, so I mean, the focus, thus far has been largely on securities, and so it's now an award-winning platform, which we're always pleased to say. But I mean, we've been focused on, I would say, kind of a small number of debt issuances, and there we've looked at both tokenized native issuances as well as tokenizing existing instruments onto the platform. I think as we've, kind of looked and thought about what's the best way to really kind of commercialize this space, for us, the last 12 plus months has been very much focused on scaling, and how we can kind of get broader scale across the market, deeper liquidity pools, being a real kind of focus, in that vein. So as we think about, the projects we're looking to launch over the next kind of 6+ months, we've got a big initiative in the US where we're working with many global asset managers on tokenizing a suite of funds. So that, the first phase of that should happen towards the end of this month, which we're very excited about. And that kind of plays into this whole focus in and around kind of collateral mobility. We're also looking at alternatives as well. So we've got an initiative there focused on a real world asset, and again, scale really at the heart of the focus there. And there's probably a number of other things, that are in the pipe as well, which we're excited about. But I think the fundamental point is, as we look to kind of spin the platform out, it's about getting kind of broader adoption and scale in everything that we're looking to do.
And when we talk about today, what does the platform offer at the moment? What can I do already?
So at the moment we've been, obviously focused on digitizing the whole life cycle of different asset classes, and I think, well, specifically, 1 or 2 asset classes. As we kind of think towards the kind of the spin out of the platform, I think really for us it's kind of broadening the kind of asset classes that the platform can kind of accommodate, which has obviously influenced, the projects that we've looked to focus on for our clients and who we're working with, in the context of strategic partners. And really building up the kind of resiliency with a real focus, kind of on security, privacy, and the like. But as we think about the platform, one of the things for US banks has always been this ability to settle only on private blockchain. So the way that the architecture of the platform's been built, we're excited to see, as the US regulations hopefully evolve in a way that we anticipate, the ability to have more flexibility on the underlying ledgers that we use.
And now, next year, the spin-out is happening. Until then, what are the challenges, key insights that you plan to provide? But then also, what's the big problems that you foresee at the moment to really go to market in this way?
Sorry, that last little bit of the last question?
Like the biggest challenges for you until the spin-out, and the key features that you plan to have until then in the direction of the challenges.
Challenges for the platform, for the business? Yeah. I think, I wouldn't say challenges. The excitement with kind of divesting the platform, I think, offers us, that ability to, kind of, like I say, properly scale it and work with strategic partners in the market. Excitement around the business more broadly. I think, some of the things we've not touched on. I think on the crypto side, as we see the regulations hopefully evolve, like I say, as we anticipate, that ability to build out our kind of crypto offering more so than we do today. We feel like we're very active. We've got a big geographic presence, as I mentioned, but continuing to focus on that and build that out, is very exciting for us. I think we talked a little bit about the M&A, and our classic bankers are naturally kind of leading on that, but we're working very closely with them. I think we continue to see a lot of opportunity there, kind of in terms of potential consolidation over the market, across the market, which I think many of you will have started to see already anyway, and much more kind of activity there, plus some of the activity we see with our portfolio companies.
I've seen you in the MENA region during Token 2049. In the US, you guys obviously have with Trump a new president and a lot of push, or maybe not. But in this direction, where do you see the biggest opportunity for you with the platform in the market? And is Europe a market at the moment, or was it something where it's struggling at the moment?
I think, and sorry, I'm really struggling to hear because of the noise, the question, but I think, in terms of the excitement in and around the US, I think we've seen a huge amount of kind of momentum because of what we're kind of starting to see from a regulatory perspective. And the way I think about it is, there's a lot of things that institutions want to do, but having the clarity has certainly kind of accelerated broader adoption. And that's both kind of on the buy side, the sell side, you're seeing a lot of kind of the US banks now become more actively involved. So that kind of accelerates the adoption. As you accelerate adoption, it means that you get a broader kind of participation, which increases liquidity and scale. And so that manifests itself across, kind of all parts of the digital asset business, which is from our perspective, pretty exciting. And then we are hosting our own conference, and probably like you're feeling, this week, there is a lot of excitement. And so we're going to our fifth one with a lot of tailwinds, and I think each part of the business will be very actively discussed in a positive way. So, we're pretty excited for that. But then, what do I think in terms of, the forward for the year? I do think consolidation is going to be a kind of one that we'll see more and more of as people look to pool resources and people look to expand, broaden their businesses in anticipation of going public.
Sounds good. For the rest of the year, is there in the broad digital asset space an outlook for us? What do you see? Where's the market heading? But also for the platform itself, what's the impact there on the current situation of?
Yeah, I just think that we'll continue to see broader kind of adoption across the market. I hope, as mentioned, that we see the positive development with the regulations. I think the US is really, kind of starting to kind of accelerate, and other regions now probably kind of are taking note of that and reacting. I mean, in Europe, they've been pretty forward-leaning in this space, which has been very positive. But when we start to see how the US is aggressively moving forward or looking to, I think it'd be good to see kind of a bit more kind of speed across the regulatory side, this side. And then I was in the Middle East recently, and it was fascinating to see the energy and focus in that region, and Asia, where I have a team. There's a lot of excitement there.
We had a quick chat before the call. In general, meme coins, do they help the industry or not too much? What's the perspective for meme coins? Do they help the industry or not too much?
I'll leave others to decide on that one, but yeah.
Nothing to this? No? All right. For the broad picture next year until the spin-off is taking place, what are the key partners that you guys need to bring on board? Who are the key players in the space that are contributing there? Anything in this direction for us?
Yeah, I mean, in the context of the spin-off, when we had made the announcement last November, we talked about Tradeweb being a strategic partner on the platform. One of the things that, as a team, we've been very focused on is aligning with the right strategic players. And again, it comes back to that point of trying to get the scale and really build out, kind of, I guess, the marketplace. So as we've kind of started to evolve that, there are additional strategic players we're working very closely with, and they kind of are foundational, ultimately to the kind of I would say, successful spin out of the platform.
Circling back to the beginning, when we said industry-owned, what does it really mean if a platform like this is industry-owned?
Yeah, I think there are a number of examples of kind of market-neutral type platforms. I mean, TradeWeb's, actually itself is a good example, Symphony and others. And I think, to me, actually kind of having the market have, a real kind of interest in the platform, skin in the game, if you will, I think is very important. But it also kind of accelerates, and this is the key thing, kind of that interoperability across the market. So really having that broad market adoption, is, and participation is key.
Is there any feature that Goldman Sachs still has control on the platform and it's been out over the years, so decentralization happens in a slower process? Or do we expect next year directly that it's completely independent, market neutral?
Yeah, I mean, when you're looking to develop a market neutral platform, the key thing is making it just truly that. So I think for us, once we actually do divest, it will be just that. We will be an investor like anyone else.
Then looking into the future, 5 years ahead, where do you see Goldman Sachs within the broad ecosystem of digital assets?
Look, I think, we're very excited about, the possibility in this space and the opportunities that it brings. So I think in 5 years' time, we'll see a very different marketplace. I think as we look at kind of the growth of tokenization, the transformation of the kind of collateral marketplace, leveraging distributed ledger technology more, I think we'll just see a very different market. And so as we evolve the digital asset business at Goldman, I expect it will be kind of with that in mind. As the market evolves, you'll kind of evolve the team appropriately. I also think that crypto as a trading asset class will naturally mature, will have more products and be just traded like any other asset class.
Anything where Goldman Sachs will not touch the crypto space? Anything besides the, obviously, platform, Bitcoin, Ethereum involvements, but where we see something new coming up in the next 6 months? Any news?
No, I think for us, I mean, a lot of it's, regulatory based in terms of what one is able to do and not to do. And so at the moment we can't trade or touch the underlier. Getting the permissibility to do that, which is something that's obviously kind of in flight, hopefully, will ultimately determine what we can do.
And where do you see the US compared to the MENA region in this speed setting to move ahead in this direction? Is it the US is back to the speed that we knew from the past?
I think the US is, I mean, a lot of it, as you know, and people here know, I mean, there's been a big change over the last 6+ months. And so I think there's now a lot more focus, kind of domestically. And that's galvanized, kind of the cross-section of the market, FMIs, buy side, sell side, which accelerates, creates enthusiasm, but also really touches the top levels of the institutions. So then you start to see kind of top-down, focus on this space.
Perfect. All right. I think we covered the digital asset space quite well. The platform launch, we see it next year coming. You guys have the conference in November, is correct?
That's right. It is it's actually in June, 25th of June.
In June?
Yeah, very close.
My news is wrong then. So in June, if anyone is interested to dive deeper into this, Matthew will be there, and then see you all at the conference again.
Thank you. Thank you very much. And sorry, I did struggle to hear quite a bit, actually.
Thank you so much for that, Matthew. Thank you, Carl. That was awesome. Always great to get insight into what some of the biggest financial institutions in the world are doing in this wild, wacky space. We've got another great fireside coming up for us. Thank you all so much. This one's called From Merger to Momentum, ASI and the Road to Decentralized AGI. This is going to be with Ben Goertzel, founder and CEO of SingularityNet, Humayun Sheikh, founder and CEO of Fetch AI, and moderated by Nicola Masella, partner of Storm Partners. Please help me welcome Nicola, Ben, and Humayun to the stage. Thank you so much.
So, thank you very much for being here with us. I would start from a very brief introduction about yourselves, just 30 seconds, who you are, and a bit about the project.
Yeah, Humayun Sheikh, CEO and founder, Fetch AI. We started Fetch in 2019, listed token, and we're building agentic framework for the next generation of AI.
Ben Goertzel, I'm a CEO of SingularityNet, and together with Humayun, lead the Artificial Superintelligence Alliance. I founded SingularityNet in 2017, but have been working on AI and decentralization in various forms for many, many decades before that.
So we are talking about quite a long-established project for the time span of the crypto space. Something very interesting that happened last year was the merger that created the ASI Alliance. It was the largest merger in terms of token mergers by market cap when the tokens were aggregated. And it was also a quite unique operation in the crypto space. Not many token mergers have been done before. So, of course, the question is, why to merge? What was the reason behind this aggregation of different projects? And I guess we can do one-on-one.
Yeah, I mean, the benefits of scale for AI are well known in this era and much discussed, and that is the essence of the reason for the merger with Fetch, SingularityNet, Ocean, and then Kudos has joined. I mean, all of the merging projects, Fetch, SNet, and Ocean, had broadly similar aspirations to use the power of decentralization to realize smarter and smarter systems, providing better and better services by letting decentralized AI agents collaborate together to do things. And we all viewed our main competitors as the centralized AI behemoths of the big tech world, right? So if we could join forces together, we don't come as big as Google or Microsoft, but we're getting better scale. So then putting slightly larger scale together with our better AI algorithms and the incentivization power of tokenomics, it seemed like we're getting closer to the scale that we need, to make our decentralized AI the dominant form of AI on the planet.
Yeah, if you think about building AI applications, you need the whole tech stack. And in crypto, what you see is a lot of projects building very siloed, small part of that technology stack. So if you look at all the merger participants, we bring different complementary technology which enables you to build a tech stack which is very comprehensive. So you can deploy a full solution and you don't have to worry too much about I'm going to get data from one project and I'm going to convert it into next project to train something, and then I'm going to do something else to put it on agents and use the LLM. So now we have a tech stack which is fully comprehensive, right from compute all the way up to the application layer and everything in between, which makes it a lot more efficient. And actually, as Ben was saying, we can actually compete with the Web 2 and the corporations which are out there building these solutions.
Thank you very much. Let's talk a bit about the achievement of artificial general intelligence, something that seemed far in the future, but then more recently, various declarations, even from OpenAI, are arguing that probably it could be closer than expected. So what about the achievement of decentralized artificial intelligence? How close are we, and how is ASI Alliance best positioned to achieve it?
So my friend Ray Kurzweil, in his book The Singularity is Near, in 2005, predicted we would get to human-level AGI in 2029. I'd been thinking about it for many decades before that. At the time he put out this book in 2005, many people thought that was a pretty out there notion. So in 2005, right? So now we're in 2025. It's 4 years from 2029, and a lot more people are thinking it's plausible we could get to a human-level thinking machine by 2029, right? The prediction doesn't seem that crazy, and I'm one of them. I mean, I think it could be 2 years, it could be 5 years, it could be 7 years. We're going to get to machines that can think, generalize, imagine, create as well as people. I think it's remarkably close on the time scale of human evolution. On the other hand, the end game can still be dramatic, right? And just because big tech appears to be in the lead now, as has been famously discussed, there's not much of a moat around their lead. And we saw a paper put out by Apple just a couple days ago demonstrating quite compellingly that the reasoning LLMs put out by big tech are not actually reasoning very well. And when you give them puzzles just a little bit beyond their training data, they're not that smart at all. So while I think historically we're quite close to AGI, there's still a bunch of work to do. And there's still plenty of room for upstarts like us in the decentralized world to take the lead over big tech in the AGI race. And one of the secret sauces that we have from being decentralized is the power of diversity. We can pull in a lot of different people, a lot of different communities, every country in the world, and we can pull in a lot of different AI algorithms on a lot of different data sets to all work together, as opposed to the more monolithic approaches that large centralized entities will take. I think large language models, like the ones big tech has done, and like the ones that we have in our own ecosystem, like the ASI1 model that Humayun's team has launched, that we'll talk about in a moment. Large language models are a powerful component of what we need to get to AGI. I don't think they're good enough. We need to add components better at logical reasoning, as the recent Apple paper highlighted, components that are better at fundamental, sort of out there creativity, like evolutionary learning. We have a diverse, decentralized community that can put agents involving these diverse algorithms on our platform where they can cooperate together to give rise to AGI. So I think in the end, while big tech seems to have the lead, by leveraging the power of decentralized networks of agents contributed by a diverse, decentralized community, we will be able to overtake big tech, and the first human-level AGIs may well be launched on a decentralized network.
Thank you very much. Humayun, the conversation when we speak about artificial general intelligence seems a bit theoretical, but ASI has some real products that some are already out and usable, and some are coming up later this year. Would you mind telling us a bit more about those?
I think I'll tie into what Ben was saying, whereas I'm not as optimistic in saying that AGI will be here in the next 2-3 years. I definitely think all the technology that is around us is making it faster to get to AGI. The definition of AGI is changing all the time. I mean, a 20-year-old definition, we already have AGI right now, right? But if you think about how this is going to come about is with the products. So what would happen, and you saw that in OpenAI's product, everybody's building AGI, but they are releasing products which people can use. So within ASI, we've taken the same approach. We are releasing products which are covering the whole stack. I mean, for example, ASI1 is our own LLM, but it has something special in comparison, which is it's actually built for agents and AI agentic systems. And it's actually, it kind of is parallel to what exists, let's say in ChatGPT or any of the others. So you can actually build agentic systems. What is quite cool about that is you can build these systems and the LLMs are learning from delivering those systems. So the acceleration, because it's open, because it's decentralized, the participation is very open, you can actually improve the performance of LLMs quicker, and you can actually build algorithms and introduce them a lot quicker because they're all agentic, and you can actually assign an agent to another algorithm, and it can actually bring that in. So collectively, the pace at which we're going to get to is much higher. So the product stack we have is converting that into the agentic system, which is the application layer. And then we're bringing in multiple projects like ASI1, we have ASI Train, which is for building and training models. And then everything can be deployed and people can use it right now. It's available.
Thank you very much. So that's really interesting what you said about the fact that our characteristics of decentralization could even accelerate and help us in achieving our AGI before some of the tech giants. And I think, as even a normal person that doesn't have a technical background, this puzzles me a bit. Like, how is it, let's say, how do we compete with players that have much more resources than us?
I mean, we could have asked the same thing. How could Microsoft compete with IBM and Honeywell and digital equipment in the 70s and 80s, right? I mean, throughout the history of the whole tech ecosystem, I mean, you have an innovator's dilemma where large companies stuck in their ways are overtaken by smaller companies with new and better ideas. So this would not be the first time that it happened in history. And if you look specifically at what big tech companies are doing with AI, they're all doing the same thing. I mean, they're launching large language models, and they're building their whole infrastructure around that. Now, we also have an amazing large language model, ASI1, that Humayun has just talked about, but we're not restricted to just that. We have a framework where we can connect that LLM, and we can connect it with a logical reasoning engine. We can connect it with evolutionary learning for creativity, and we're launching a product quite shortly called Quello, which is a deep research engine that brings together some symbolic reasoning on logical knowledge graphs together with deep learning. Now, you could say, why can't big tech copy this? Of course they can, and of course IBM could have copied Microsoft, and digital could have copied Google, right? But I mean, this is not how the history of business goes. You accumulate a bunch of brilliant developers around a new set of ideas and a new tech stack, and this group of developers has momentum, and then with that momentum, you launch stuff that the entrenched orthodoxy couldn't do, right? And we've been building toward that for some time. I mean, I introduced the concept of AGI in 2005, the same year Ray Kurzweil made his book, The Singularity is Near, and I've been building AI systems since well before that. We've been building our agentic blockchain network since 2017, 2019, Ocean Protocol 2018. So it's been a while building the tech stacks to enable the products that we're launching this year. It hasn't been as much money as big tech has put in, but it's been a lot of brain power by a lot of smart engineers, right?
Thank you very much. So I guess the crowd is also interested in understanding a bit more about these mergers, because it's something that has been coming up more and more in the crypto space, this idea of unifying projects that have maybe a similar vision and can create synergies by integrating their tech stack, but also resources and so on. So I wanted to understand from your point of view, now that the merge happened like around a year ago, how would you describe the process? Was it painful? Was it not? Is it still maybe one strength and one weakness about being together?
I mean, I can quickly give my view. it's never easy to bring too many intelligent and strong people together. There is a benefit in it, and that's why we do it. But luckily, the way we merged is that we maintained our own teams. We maintained our own treasuries. So it's quite a unique way of merging, which of course has its own problems because you're in a decentralized space. You're not as connected as perhaps a centralized entity would be. But it has its benefits as well, which is you still maintain your independent status, but you collectively work towards building the tech stack. And I think for me, the best part has been bringing the teams together to think and add value to the products, to the whole ecosystem, bringing all the ecosystem together, and actually doing this huge amount of research and bringing that in, which Ben has been doing, and introduce that within the products to actually build a much better tech stack. So for me, I think, yes, with difficulty, but that's human difficulty. But actually, technology-wise, I think it was the right thing to do.
Yeah, I think pulling the tech stacks together has certainly been a big plus. So for example, we have ASI1 model from Fetch. And on our Quello deep research project that we're launching shortly, we're using ASI1 on the back end, combined with our own knowledge graphs and components from our Hyperon AGI research project, right? So we can put their LLM stuff together with our symbolic AGI research stuff on the back end of a product, and you get a stronger research engine that way. Now, in theory, you could cooperate without merging, and we had talked about cooperating without merging on the technology side before, but it didn't actually happen, right? Now, after doing the tokenomic merger, some technological cooperation actually occurred because you have an added economic incentive. And I would say, so we're designing now something called ASI chain, which will be the first true ASI layer 1, which will have a shard mechanism somewhat like, but in many ways much better than BitTensor's subnetworks, I would say. But in designing this ASI chain and sharding mechanism, again, it's been valuable to put our heads together and our different tech stacks and different experiences together. So I think there's been a lot of synergy on the tech side in terms of product design, both with these ASI1 and Quello products, and then with the ASI chain that we're going to launch, which should be quite big. I think the culture integration has probably been the hardest part, which is commonly the case with mergers in the traditional business world also. I mean, we have more of an AGI R&D culture in SingularityNet and perhaps in Ocean as well, whereas Fetch has had more of a commercially oriented culture, and that's required everyone to stretch a bit toward mutual understanding. But I think, as Humayun said, the fact that we've merged tokens but not merged organizations means that the cultures don't have to fuse, right? So, I mean, the cultures have to synergize and work together, but we can each remain our own organizations operating according to our own culture. We just have to cooperate together. And I think this is a case where the flexibility offered by smart contracts and crypto tokens is enabling new forms of organizational structure, right? Because you don't have this kind of merger in the traditional world where some companies decide to make a common share on the exchange but remain separate companies. You could, but it's quite rare in the traditional business world, and it seems to work much better in the tokenomic sphere.
I think you said something very interesting that might not be clear for everybody, which is the fact that this merger, for the peculiarity of the Web3 industry, didn't necessarily involve merging the various legal entities and organizations, but basically was based on creating a common entity, the ASI Alliance, that would coordinate the activities of the different members of the alliance. This is particularly interesting, and sorry if I maybe have a lawyer bias, because of course, as a legal counsel of SingularityNet, we have assisted on the thing. But I think it's very interesting, and it's also a power of the Web3 industry. It's a type of merger that is not possible in the traditional...
And it's about the power of diversity to me, right? Just like I think one of the reasons we can beat big tech to AGI is because decentralization fosters diversity. Big tech is focused on one AI algorithm, so if it sucks, then, well, they got to re-engineer everything. We can bring together multiple AI algorithms running in multiple AI agents, cooperating together on a decentralized fabric. And in the same way, we can merge, but we don't have to squelch the diversity among our individual organizations. We can bring the power of that diversity to bear to build more robust systems. And that is a strength enabled both on the technical level and the human organization level by the decentralization that's implicit in the operation of smart contract-based networks.
And this also leaves the door open for other projects to join the ASI Alliance, right, Mayan?
It has to be quite relevant and beneficial because we have a tech stack, we have a mission, we're heading towards decentralized AGI. I mean, we can't just merge with anything. It has to make sense technologically and token-wise to enable that. But yes, there is the opportunity of other projects to come into the merger. We did bring a fourth partner, which is Kudos, because we, as a tech stack, the three of us did not have the compute in the tech stack. So Kudos brought in the compute platform to kind of complete the tech stack. Of course, there is many other things which could help. And if it's a relevant project, we're quite open to that.
Thank you very much. And I think one last aspect that we should consider is that the merger also merged, to a certain extent, our communities because it created a single community of token holders. And I wanted maybe to hear a bit your perspective about these and about the future of our token.
So the community is one of the strongest things that this merger achieved, because if you think about all the separate communities, bringing them all together, you suddenly have a much bigger momentum of actually not just the following of the project, but also the utilization of the project. So we are seeing utilization of our products increasing exponentially, especially over the last 3 months. And that's thanks to the bigger community that we've been able to put together as all the 4 projects. So I think community in itself is very powerful. Diversity, as Ben was saying, is very powerful, and it comes with a bigger community.
That's great. Ben, any last takeaways?
I think the community is going to be key, and this really has to do with the broader questions of like, why are we building AI? Why are we building AGI? Why are we working toward superintelligence, which is after all the name of our alliance, Artificial Superintelligence Alliance, right? I mean, of course, there's multiple motives involved with any complex human activity, and people are going to make a lot of money in building AI and AGI. But, I mean, on the whole, the reason humanity is working toward AGI is because we've been striving to make our lives better and more fulfilling for a long time, since we emerged from, hunter-gatherer to agriculture to industrial revolution to computer revolution, now AGI revolution, right? So, I mean, we're developing all this advanced technology primarily, along with a bunch of other side motives, primarily to make lives more fulfilling for our whole species, and we want to get to a beneficial AGI and a beneficial superintelligence that will be good for all of us. And I think one of the beautiful things in the blockchain world, in the decentralized world, is a recognition that if you want to work for the common good, you want people to be cooperating together in a massive community with participatory decision making, which isn't about voting, which is one of the least interesting ways to pull together people. It's about people participating actively in networks, right? So we want to pull in a broad community to help us build a decentralized AI network that will turn into AGI, that will turn into a superintelligence. I mean, we have liquid utility token. There's loads of money to be made along the way to AGI and ASI, but I mean, even more importantly than that, it's a chance for the community to participate in shaping the mind, of the first superhuman thinking machine that humanity builds, which quite plausibly can pop out of this decentralized AI ecosystem that we're all part of.
Very interesting. And one last thing, so due to confidentiality, we cannot still disclose the details, but maybe one thing that we could say is that the recent shift in the regulatory approach in the US also unlocked some further interest from the traditional financial industry in cooperating with Web3 projects. And I know that there is something going on for the ASI Alliance in that regard. Is there something that we could say about it, or?
Without, I mean, I think the main interesting point that's happening is that crypto and decentralized space is being recognized in terms of the capital markets. So there are plenty of companies who are trying to use the technology that we're building and the technology that we're trying to deploy. We have seen a lot of interest coming from the corporates, especially from the US, to use and deploy our technology. Now, the complication, which is where we are providing them a solution, is that we are token-based economies. So how do you convert that token-based economy into bringing it to the capital market, where the capital market participants, the companies, the enterprise can actually build solutions? Because you've seen reservation from most of the enterprise because we are decentralized, we are tokenized. And if we can overcome that barrier, then a lot of the companies, the utility will kind of drive into the Web3 space. And that's what we've tried to kind of overcome. And I think in the next few hours, we should be announcing something around that, hopefully. And yeah, you'll see when it comes out.
Thank you. So stay tuned for an announcement coming up in the next few hours. Thank you very much.
Thank you.
Thanks a lot, Nicola.
Thank you so much for that. We hear so much doom and gloom headlines out there about artificial intelligence. It was actually kind of refreshing, I think, to hear a little bit of the upside there about setting ourselves free a little bit of some of the mundanity of life. Enjoyed that perspective. We've got a great direct address here today. We're going to be welcoming to the stage Sofiane Deliou, co-founder and CEO of New OS. Going to be talking to us about programmable crypto economics, investing in the era of self-improving artificial intelligence. Please help me welcome Sofiane to the stage.
Hi, everyone. I'm here to tell you that something is happening in the boardroom of tech giants, AI teams, investors. There is a hidden story behind all those mega rounds. There is an acceleration of those mega rounds. We are at an all-time high, mega rounds at more than 100 million for early stage companies. And so we are in this weird place where we don't really know if it's a bull market, if it's a bear market, if we are in AI winter, AI summer. It's all accelerating. It's all becoming part of something bigger that's happening. It took us about 3,000 years to go from step 1 to step 2 of the process. We have 17 steps until we get to the new economy. So what's happening is that we don't start from scratch. We learn from the past. We emerge from the shoulders of the giants. And that propagation is accelerating. So now we are at step 13 in this process, which is goal-oriented agents, building agents that learn from their experience. So we're entering the era of experience, which is leading to the step 15, and everything is about to accelerate. So the era of experience is the topic that everyone talks about right now in AI. It includes people like the vice president of Google DeepMind, the father of reinforcement learning, but also Ivanka Trump. That's a tweet from 4 days ago where she talks about the era of experience. So what is happening here? Why is it so important for AI? 3 years ago, everyone was excited. 2023, everyone was talking about scale is all you need. We are going to AGI, GPT-3, GPT-4, GPT-5, GPT-6. We just need to make bigger and bigger models, and we are going to get to AGI. The story has changed. Instead, we are moving to smaller models, because those small models are meant to learn from their own interaction with each other. So they produce their own data while they are trying to solve your problems. And all those agentic systems are producing their own data. So we are moving from learning from content, which is limited. There is a limited amount of data on the internet, to unlimited scale, where we are learning from experience. And so that experience, there is an infinite amount of tasks that AI agents can produce to learn from. That's the kind of process that beat the world champion in Go. The model was AlphaGo from DeepMind. And the same approach can now be used and applied to things like basically the new generation of models. So reinforcement learning on the experience data of those agents. So agents, they optimize for the reward. So you give them a reward. In the case of Go, it's winning points. And then from that reward, they will try everything they can. And as they try, they will produce their data. And that data is estimated to be 20 to 40 times bigger than the internet of humans. Because those agents are going to work all day, all night trying to solve those problems. And so that's the data, the action-based data that will be used, not the people chatting with each other on Reddit. The question is, who owns this experience? Because that experience data can be concentrated or it can be distributed. And so if we look at how it's happening today, when you spend 5 hours in front of your ChatGPT or Gemini or all those interfaces, those 5 hours of your life are being harvested by tech giants. So they own your time. They own your attention, your energy. And so they use that to improve their models. And so now we are entering a tipping point, and that's what's happening now, which is as those models get more capable, it becomes more difficult for open source developers to access that experience data, because when you release a model on Hugging Face, you lose track of what's happening. And so that's where they are creating a moat. They said 3 years ago, we have no moat, neither does OpenAI. But now they are basically building that moat. And that moat is very important. Those mega rounds are about a progression where they are going to produce that network effect at the experience level, the experience of the agents, the experience of the humans with those agents. Those agents will gain more autonomy. They will have longer intent gaps. They will go from 5 seconds to 5 hours, 5 days, 5 months. They will also increase in scope. They will be able to do a more diverse range of actions because of that learning curve that expands. And they will start entering the physical space. It means all that feedback loop of agents getting smarter from their experience is going to be amplified by the access to things like the smart glasses that Zuckerberg wants you to wear, the new device that OpenAI is working on. All those devices, Tesla is the #1 producer of camera in the world. It's the widest surveillance system in the world. All that data that is collected by the Tesla cars, by the glasses, by all those physical objects are going to be used to train robots and improve AI significantly on that experience data. So we are entering the new economy. How does it look like? This new economy, this ultimate goal. We have desires, and those desires are just a function of energy and intelligence. Intelligence will scale. It will also reinforce the cost of energy will get cheaper. And so we are moving to a world where AI is everywhere. It's ambient. It's managing supply chains, transportation, food, information. Everything is running autonomously. And that's the big deal, because do we want that to be owned by 5 companies? It's not just about owning the internet. It's about now they are going after the entire planet. And so we are now at that crossroad where we really have to decide. In this context, we have been working for the past 6 years on New OS. So the idea behind New OS is inspired by the way operating system works on your computer, on your phone. They mediate your relationship with different application developers. They manage the boundaries between what an agent can do, how you interact with it, how the data is flowing. Obviously, we are in a post-application world because now agents can take over your computer and they can start doing all sorts of things on your computer. So that kind of boundaries have to be designed for that agent era. So New OS looks like your typical LLM provider. You just install a desktop app, or you can go on the web version, you type a prompt, and now you have agents that work together and try to solve your problem. And as they try, that experience data that is generated is accumulated into your account. It stays either locally or encrypted, but you have ownership of that experience data. And that's how we answer that question, because everything is going to be experience data. And so agents, to be trusted, because it's an open permissionless system, they have to accrue a certain reputation, which we call the WATs. So as a human, as an AI, you can gain trust within the network so that your experience is trusted. And the idea here is we are moving from an internet of pages to an internet of experience. Again, that internet of experience, 40 times the size of the current internet. One mental model that's very useful to understand why this approach can win. Back in the day, in the 90s, we had this company called Yahoo. They were hiring a team of human employees to curate the whole internet. So it was a team of 200, 2,000, whatever people. They were sitting at the office, and they were reviewing websites one by one. And then something came. Google. Google didn't have a permission. You didn't need to ask permission to a human to get your website included. You just put your page out there, and it got a score. It got a rank. And so that's what we are doing with the WATs. We are giving a score to every agent, every interaction, every signal is being given a weight that can then be used in this permissionless fashion. And so we believe this ecosystem, the open, decentralized AI ecosystem, needs this coordination layer. And so that's why we built New OS. So what does it mean for investment? That was the kind of topic of that talk. So how to invest in a world that's going towards ambient AI, where everything is going to be commodified, accelerated, and increasingly handled by agents. So the Internet of Experience is definitely the theme that everyone should look at. How to invest and participate in economies and businesses that facilitate the decentralization, the exchange of that network effect at the protocol level. So trying to build bridges between all those protocols and allow them to exchange data. In the same way as ERC20 was a great protocol that connected all the smart contracts within the Ethereum ecosystem. Then the intelligence network effect. So how do we create signals that can be shared and produce more network effect between all those participants? Resilience to commodification, that's a rule of thumb. If everything gets cheaper and cheaper, compute gets cheaper, code gets cheaper, what are the things that are not getting cheaper? And looking in this direction. New human skills, so there will be displacement, there will not be replacement. We are just going to be doing things differently, and there are lots of new business models that can be created around how humans can orient the attention of those self-improving systems, because a self-improving system alone would just analyze and try to optimize for everything. So humans are here to say, no, actually, that part matters, and then you kind of guide the development of those self-improving systems. So thank you so much, everyone. And if you want to join me, my contact, and you can also try NewOS. It's live, newos.computer. You can scan the QR code. Thank you.
Thank you so much, Sofiane. Thank you, everybody, for being with here for the first part of the day. We're excited to have lunch coming up next here. There's going to be a 45-minute break. After that, please do be sure to come back and see what we've got in store next. Looking forward to seeing you soon. right, thank you everybody. I hope everyone got their blood sugar up. I know it's been a long couple of days, lots of thinking, lots of provocative conversations. We're going to keep the ball rolling here. We've got Eric Balchunas, Senior ETF Analyst at Bloomberg, here to talk to us about the future of ETFs and crypto. Please help me welcome Eric to the stage.
Very much. Can you hear me? Yeah, okay, good. As said, I work at Bloomberg, so I'm part of the TradFi, or as they call me on Twitter, a suit. I've learned not to wear suits at these conferences, by the way, so I'm getting with the groove a little. Beautiful venue, by the way. This is Crush's financial conferences, which are usually in hotel ballrooms. So I have been getting to learn the crypto world over the last 18 months covering ETFs. Since the BlackRock ETF filing, I've been really throwing myself into this world, and it's really incredible. Reminds me of the early days of ETFs. There's something going on, you know, that's the feeling I get. So I'm excited to share with you today some thoughts about how the ETF world is more powerful than you think, and more disruptive than you think, and probably better for price than you think. Okay, let's get this show on the road here. The ETFization of crypto is the name of my presentation. I'm in research, which is just one part of Bloomberg, which has 25,000 employees. So I'm like a little tiny cog in the wheel. But I cover ETFs, and this is my team. One of my analysts, Henry Jim, is here. Where is he? He's based in Europe. So if you are European and you're in the fund business, you can contact him anytime you want. And the rest are based in the US or Asia, and this is what we do all day. 15 months ago, we warned you. The boomers are coming. I realized using Paul Revere in Europe was not the smartest idea, but just know this is the guy who said the British are coming. Anyway, the point is, the ETF was a bridge between your world and the boomer world. And the boomer world's important because they have all the money. They own 70% of all the assets in the US. And they love cheap, liquid, brand name ETFs. They love them. Look at the fees on these ETFs from the spot Bitcoin ETFs. Before these babies launched, you were a fund would be 2%, 1.5%. Try using Coinbase. They want to charge you 1%, 2% just for the exchange rate. These are all traded at 1 basis point. So 1 basis point trading fee, almost no expense ratio. Oh, and by the way, it's issued by a very trusted brand, BlackRock Fidelity, and it's been stamped of approval by the SEC. This is the perfect situation for boomers and traditional finance to buy. And buy they did. These things took in $38 billion in their first year. That's insane. Normally a new category takes in $1 or $2 billion if they're lucky. We thought, okay, these might be due 10 to 15. 38 billion was double our high band, so hugely successful. Flows are the most important number because it doesn't include price. It's pure net sales of the ETF. And look at that little dip. That little dip, by the way, only 5% of the people left during the tariff tantrum. So as I said last year when I was here, these boomers are going to be better hodlers than you think. They have a lot of stamina, they have a lot of discipline, and the smaller the hole, the easier to climb out of. So we're already at a high watermark of net flows rolling, 41 billion. If you add in assets, which includes the price, right? So assets is everything. $120 billion in crypto ETFs globally. The US dominates this area, but it's growing overseas. Just recently, UK announced they're going to let you trade Bitcoin ETFs. Especially as our government gets more into it, you're probably going to find some people trying to compete globally as well. But at the end of the day, nothing beats the liquidity and fees of these US ETFs. Even an institution in France, like a pension plan, would come to the US and use IBIT probably over something here. And look at this. Gold ETFs, obviously, you know they were a big hit. This is the assets historically of gold and Bitcoin ETFs. You can see how quickly the Bitcoin ETFs matched gold. Now, gold had a hell of a Q1, so its assets went up pretty good. This chart's a little old. That Bitcoin line is almost up to gold as we speak today. We think Bitcoin ETFs will probably get triple the gold ETFs in the next 3 to 5 years. Nobody's out talking about gold. I go to these things all the time. I go to TradFi events, crypto events. The energy behind Bitcoin and the wholesalers, huge. Everyone's very excited talking about it, and there's nobody talking about gold except for like Peter Schiff, okay? So the energy factor alone is massive, let alone some of the other features of Bitcoin that it has over gold. This stat is probably the most insane of all the stats from the US spot Bitcoin ETF launch. Is IBIT, the BlackRock ETF, is now the 23rd biggest ETF in the world. 23 out of 10,000 ETFs. And get this, I put the age of the ETFs in there. IBIT is 1.4 years old. The next youngest ETF on the list is 12.6 years old. So normally it takes you a decade to get into this elite club. IBIT did it in just a little over a year. Again, this is like crazy stuff. That's why I dedicate a lot of my time to this area, because still Bitcoin ETFs only make up 1% of all ETF assets, and I'm an ETF analyst, but I do cover it quite a bit because of this phenomenon factor. Bitcoin ETFs also have options. This is very important for institutional adoption. Options are like giving a painter 100 extra colors. You can fine-tune way better, customize exactly what you want. So options are very important. And the options market on the Bitcoin ETFs is as liquid as GLD now. So again, that was a big step as well in the institutional attraction for these funds. If you put the US spot Bitcoin ownership into Bitcoin itself, they own 1.1 million Bitcoin. So in a year, they are the biggest holder in the world as a group. Think about that, 1 year. So what's it going to be like in 10 years? You'll probably see me more. I'm guessing. Satoshi only owns 1.1, so they own more than him or her as a group. Now, if you unbundle it, BlackRock is already second alone. Now, you've heard about Michael Saylor, obviously, buying up Bitcoin for what seems like a half a decade. BlackRock owns more Bitcoin than Saylor, again, in a year. Larry Fink filing for that Bitcoin ETF in June 2023 was massive. I'm actually working on a new book about this. To me, this was like a new hope. You know, in Star Wars, it was like FTX was still like in the air. The price was 30K. There was no narrative. And boom, out of nowhere, this BlackRock ETF gets filed. The rest is history. But not just the filing, you got Larry Fink on TV talking about this. I call this the suit coiners. Suit coiners, you like that? The suit coiners are coming in full. Larry Fink is leading them. Here's another one. This guy's from Fidelity. He's in a suit. His audience, instead of crypto, is corporate treasurers. And he's sitting there talking about, is your company generating shareholder value? Maybe you should use Bitcoin on your balance sheet. But he's speaking perfect institutional ease, boomer ease. This is where I think, when a full crypto person tries to talk to a boomer, it comes off a little crazy, no offense. This guy's speaking in their language, Sharpe ratio, Sortino ratio. Again, this is powerful stuff. You can see the people who own the Bitcoin ETFs, it's not just retail, it's advisors. Advisors have about 40 trillion of assets in America, and they are the biggest consumers of ETFs. So far, they've dabbled. I think if Bitcoin hits 150K, they will really lean in and buy more. Also, Bitcoin and some of the other altcoins fit perfectly into the modern portfolio. Most people have married Vanguard index funds. Stocks, bonds, no fee, cheap beta, I'll wait 30 years. It's a great idea, but that's boring. So they want to have a little fun with hot sauce, decorate the portfolio. To me, this is where crypto fits perfectly. And also, if you're only going 1 to 5%, you can stomach downturns a little better because it's not your whole enchilada. And so the volatility of Bitcoin is coming down because of the boomers. Look at IBIT's vol, it's about a little over double gold now. If it can get anywhere near gold, look out. You're going to get big whales biting it, like pensions and endowments and sovereign wealth funds, because they are more interested in digital gold, not a tech stock. They can get tech stock returns from NVIDIA. So if this volatility comes down and the correlation comes down, correlation is pretty good, 45%, but gold is 0. It's still less correlated than emerging markets and some other things, but you want it to be about zero. Zero correlation, a little lower vol, and I think you get a lot of bigger institutional adoption. Now, what about the other coins? I mean, they're all interesting, exciting. The blockchain, I get it. But Bitcoin is going to dominate the whole space. Right now, Bitcoin ETFs are 90% of all the crypto ETP assets. We think they'll go down to 80, but no more. So there's probably room for 10% other coins to dig into this market share. Problem is, this is Ether. Ether did okay, 10 billion, 10% of Bitcoin. Harder to explain to somebody easily what Ether does. Bitcoin's digital gold, what is Ether? I'm not going to go into it now, but you know what I mean. It's hard, it takes a while. But we've got a lot of altcoins coming. Solana's probably next. We think we'll see, we call it the altcoin ETF summer. We'll probably see Solana, Litecoin, XRP probably up next. Be interesting to see if they approve Dogecoin. But major issuers are behind these. You can see how high our approval ratings are. Obviously, the new SEC is going to be more lenient. So these are our approvals of the next big ones. These are the spot ETFs. That said, there's 80 different crypto ETFs that have been filed. So like Avalanche, Polkadot. I swear to God, like every third one I have to Google. They're really going, because if you get to the market first, you get a lot of assets. First to market is big, so they're going to try to throw stuff out here before it's even right, probably. You've also got ETFs for meme coins. Somebody filed a Trump coin ETF. Actually, Truth Social filed for a Bitcoin ETF. That's also pretty surreal. But the Trump meme coin ETF is interesting because imagine being the SEC and being like, we can't approve this dumb meme ETF, this meme coin in an ETF format. But then you're like, but wait a second, that's our boss. So if they have to approve the Trump coin, and there's a Melania ETF too, don't worry. If they have to approve the Trump coin ETF, ipso facto, it's probably going to mean all of these are approved. I think they're probably going to go super liberal. We'll see where they draw the line. Again, there's so many, I had to make 2 slides here. So anyway, get ready for a lot of excitement in the next 4 to 5 months in terms of the ETF space. But we have a phrase on the team. The further away you get from BTC, the less assets there will be. These are some ways to find me, books I wrote, etc. Thank you very much for your time today. And now I'm on the next panel, so I'm going to invite Michael up and just take a seat probably. Okay.
Check, Mike. Hello. We've got a little bit of an unusual situation because Eric is also on our next panel. So I would normally be introducing him, but you've already met Eric. So I'm going to go ahead and I won't introduce myself, but we are going to welcome to the stage V. Lee, advisor to Anchorage Digital, Laszlo Szabo, co-founder and CEO of Kiln. We're going to be talking to you a little bit about some of the more experimental applications of what Eric just addressed. Thank you. Yes, yes, please. Round of applause, round of applause, round of applause. Woo! I think the dynamic here is a little different because Eric is on stage and I'm also introducing and moderating. But as you already saw from Eric's talk, the crypto ETF space is rapidly maturing. Here, let me come over here.
Come close.
How's it going, Laszlo? The ETF space is rapidly maturing. And we've already got a number of spot ETFs that have been approved, Ethereum, Bitcoin, a lot of pending stuff. But we want to take a closer look at something called stakeable ETFs. This is a concept that until relatively recently was only theoretical. Thank you. Europe is taking the lead in stakeable ETFs. The US is closely following. But for those of us that don't know what stakeable ETFs are, just really quick, could I get a once-over, sort of like what's the difference between a stakeable ETF and a traditional ETF? And what's been sort of the delay in why we've had all these other ETF approvals, but there seems to be some apprehension for letting this kind of new kind of ETF go forward?
Yeah, I mean, if you want to define that, you have to define staking first, right? So historically, Bitcoin is a mining protocol, but staking is this concept of bonding your native assets, let's say ETH or Solana, to get in return rewards from the network, inflation plus the network fees that give you like a yield. And this yield can be unbaked. It's the natural way of securizing and validating transaction on Solana or Ethereum. And that can be unbaked in an ETF. Because today, ETF in the US are only offering an exposure to spot ETH or spot Solana. But in Europe, for example, in Hong Kong, you start to see ETF where you get the exposure to the ETH or exposure to the Solana plus the rewards linked to staking on top.
And so just to clarify, there are assets behind these ETFs. You're traditionally not allowed to invest them because they're literally backing the ETF. So there's not yield, there's not interest, there's no revenue income being generated from the assets that are behind the ETFs. What is so concerning? Why are we moving so slowly into this world where the assets that are backing these ETFs might also be generating additional income?
Is that to me?
Yeah.
Yeah. The 40 Act allows you to lend up 33% of your stuff. So like, for example, a small cap ETF can lend out some hard to find small cap stocks to hedge funds who want to short them. They get a little fee for that. And that can actually add to their return. So there is some examples of this. However, that's in the 40 Act. All of the spot ETFs are in the 33 Act. I won't bore you, but it's a different rule, and you really aren't supposed to lend out anything in that act. Now, this SEC is more open-minded. The other issue is, if you let 33% of your ETH get staked, it's not that much of a yield, right? What would that be, like 1% or less? Something like that?
1% for what, you said?
How much if you can lend out 1/3 of the ETF, or stake 1/3, what would that be in annual, 1% a year?
On ETH, so it's if you can lend, I don't know, but if you can stake them, I would say 1% on ETH and, and 3%, 2 to 3% on Solana, yeah.
Right, so Solana in particular get a little extra bump. But the idea is to lend more than 50%, maybe even 75%. And so right now, the SEC has asked issuers to come up with solutions. And I've heard the SEC is very open and willing. So we'll see what they come up with. The good news is, I've never seen an ETF. Like I said, I showed you the charts. ETF users are smart. They tend to hang in the funds for a long time. They don't get panicked real easy. I've never seen an ETF where like 100% of the people leave. So I don't even, I think you could stake up to 50, 60 with ever even having to go into the 40%. Like it really won't be a big deal. Plus, one solution they may use, there's a senior loan ETFs. And those are very illiquid, and so what they have is credit lines. So they have like a way to get access to meet redemptions for stuff that's illiquid. So it's creative. They'll figure something out. We don't know exactly what they're going to do yet.
Dee, go ahead.
Yeah, just to take a step back, right? Like I think, Eric, you're referring to some of the risks that the SEC has had concerns about, which I think has been a blocker for them approving any staked ETFs yet. Historically, under the previous SEC leadership, it was mainly a legal one, right? So as you guys recall, the SEC went after a bunch of exchanges for providing staking as a service, saying that it was a security. Those cases have since been dismissed under the new leadership, so that's no longer a blocker. But before, issuers weren't even asking for staking in these crypto ETFs. It was just a non-starter. So that's not an issue anymore. But of course, there are other investor protection and just structural risks, right? So one of those is a liquidity mismatch, right? So you might have a mismatch between redemption rights, right? So in traditional ETFs, investors typically are able to redeem on a daily basis. Of course, there is potentially conflict between that and the unbonding periods, which can range from hours to like 7 days, or I don't know what.
7 days for Ethereum,
Yeah, so
2 days for Solana.
Right, which can expose the issuer and the investors to risk, right? So, if you see a surge in redemptions, for example, there might be a delayed ability for investors to redeem, to unstake their ETH. The issuers might have problems meeting that demand. That could lead to panic selling, right? It could lead to a conflict in calculating the NAV. There are a lot of issues that can come with staked ETFs that just don't exist in the traditional ETF context. So I think those are things, like you said, the SEC is trying to sort it out. They're working with the applicants to figure out ways that we can address those risks.
And that redemption period is perhaps starting to play out in real time. We had some news in the last 12 hours or so unconfirmed, but multiply anonymously reported that the SEC had requested multiple S1 applicants to refile for a sole ETF. If I could ask the panel, I know the couple of you have been following closely, like give a quick little overview. What just happened, and where does that put us as far as the development, as far as whether or not there might eventually someday be a stakeable ETF approved?
Yeah, I think the events of the past months has been quite exciting and quite changing compared to what happened the past 3-4 years. As you mentioned, the prior administration would be very anti-staking and would state even that these staking assets would be securities. The new administration started to cancel the file that they had on major exchanges that were offering staking in the US. What happened 3 weeks ago now is the SEC essentially saying that staking is not participation in securities actions. It's essentially part of the protocol, and these protocol, when they are commodities, then staking would be part of the CFTC scope. So it seems from our information, either in DC or working with these ETF providers in the US, that the SEC really understood the risk of the bonding period, which is changing from Ethereum to 7 days to 2 days for Solana, and might be willing or interested to push staked Solana ETF very, very soon, to my information.
What is the difference between an unbonding period of 7 days compared to 2 days? Like, and how does that compare to the traditional way that it works in an unstakeable ETF? Like, why is that time difference so crucial?
It's baked in the protocol to increase the security of the protocol, right? In a proof-of-stake protocol, the security comes from this bonding assets. It comes from the fact that Ethereum has 80 billion staked to validate and secure all the transaction, all the meme coins or stable coins or security tokens that are represented on Ethereum. But if you can unstake in a complete liquid way without bonding this 80 billion, you can expose the protocol to massive attacks, essentially. So Ethereum has taken a very conservative approach, 7 days. It actually varies depending on the queue, exit queue, but it's usually around 7 days at the moment. And Solana is taking a slightly more aggressive approach with 2 days.
It seems kind of like leaving free money on the table. Is it riskless? How much risk is it? Are we really protecting investors, or is it just a fear of technology? Can we get a little bit into sort of the why behind the slow adoption to what's been going on outside of ETFs for years now?
Yeah, I mean, we talked a little bit about risks like the liquidity mismatch. Another risk that staked ETF investors are exposed to is something called slashing losses, right?
Talk to us about slashing. So what is slashing?
Yeah, so slashing is basically just, you know, if you stake your assets, you can lose some of them through slashing. If you engage in, I'll call it like misbehavior, right? It can be both intentional and unintentional. So unintentional is if like your validator node goes down and you experience downtime, right? That's very disruptive to the protocol. Something intentional and malicious could be like double spending or validating blocks that are not valid, things like that. And so it's a way to incentivize good behavior by validator nodes, right? So investors are exposed to that. I think the risk is pretty low, but it is a risk, right? And so it's something that like the regulators have to think about. Yeah.
Do we have any insights into why Europe was out ahead first? We've already there's been multiple ETFs, multiple stakeable ETFs already approved. Obviously, the U.S. is doing its best to catch up. But what was going on behind the scenes there from a regulatory perspective that allowed that to be set up?
Do you want to take this one?
Yeah, I mean, Europe, there's something called UCITS. None of these are in UCITS is like getting a real ETF approved in the US. You can approve ETNs and ETPs pretty easily in Europe. I mean, they've got like 5x NASDAQ here. You guys know how to party. Although we always talk about it, you're the wrong market for it. If you guys put some of your stuff in the US, it would sell like hotcakes, but nobody really cares here. It's not the same gambling culture as we have in the US and certain Asian countries. So it's kind of wasted here, but you've well advanced. You've got staking and it's just different, under that structure you can get it out easier. The US, every ETF that gets approved is straight to prime time, meaning it's on every exchange, middle America, so they have to be a little more careful. But even Canada beats us to market a lot. We'll like file something, get the idea, and they'll beat us to market with it. That's how, even the first ETF. So over time though, I think Europe and Canada are incubators for our regulators to say, oh, it's fine. When I go to the SEC, that's what I tell them. I'm like, it's fine. And the ETF structure is very durable. And just one quick thing on liquidity mismatch. I agree that if you have staked ETH and 80% of the people want to leave, and you've staked 50%, you have a problem. But even in that extreme case, the ETF will still trade. The market makers will give you a price. It'll be very dislocated from the NAV. But this is what happens in the COVID sell-off and other sell-offs in bond funds. The bonds don't trade. They're totally frozen. Egypt ETF traded on even as the Egypt stock market closed for a year and a half. So ETFs are a good vehicle in that even if you dream up the craziest situation of the underlying and everything's frozen, the ETF will still trade. That said, the regulators don't want to have it come to that. So they want to see what's the right medium between how much we can let you stake, precautions in case there's an emergency, versus we understand the ETF's a great vehicle for putting almost anything in. So I'm very confident that they will work this out. And as I said earlier, after what you filled in a lot of blanks for me, thank you. The ETFs tend not to see like 80% of the people rush out of them. Mostly people go into ETFs, they're smart investors, they don't panic that much, maybe 10%, 15%. I showed you the Bitcoin, only 95% of them stayed in the Q1, even though the drawdown was pretty steep. So I wouldn't look for anything like more than 20, 30% withdrawing, which gives you a lot of room to stake, I think. So I think it'll all work out and be fine. I have no doubts, really.
Yeah, if you look at some of the prospecti of other jurisdictions like Canada and Switzerland, Germany, I think the UK has also approved a staked ETF. If you look at some of their prospectuses, you can see how they're addressing some of these risks, right? So they'll use insurance to cover slashing losses, that one of the risks we just talked about. They'll allow early unbonding. Some of them engage in like alternating reward schedules and payout amounts.
Yep.
So they're experimenting with different ways that, obviously the regulators have become comfortable with. And actually what I find really interesting is the SEC just put out guidance on staking like a week or two ago. And they say like your typical staking as a service is not a security, right? So they've clarified that, which is
Step
great.
one, not a security.
Yeah, but what I thought was especially interesting about that guidance is that it referred to what it called ancillary services and said that those also aren't securities. So those were things like covering slashing losses, allowing early unbonding, and allowing the provider to alternate reward schedules and payout amounts. So it's addressing exactly the risks that they've been concerned about in the past and saying that those aren't securities, right? So I think that's like perfectly teeing up their eventual approval of staked ETFs.
It is absolutely fascinating. The three ancillary services that you mentioned are great examples. Also, you talked about insurance. If you put those four together, it does sort of like make me think of like if you're an entrepreneur, how do you play this? Like there's a lot of opportunities to build towards a stakeable ETF future. Like are there business models out there that you guys are exploring, that your companies are exploring, that you're seeing out there that you think are interesting, where there's young startups or heck, maybe Goldman Sachs or BlackRock that are building towards this future where ETFs are staked and there needs to be insurance and all of these other services provided?
Talking about insurance comes back to talking about slashing and the risk of staking, as you mentioned earlier. So if you take the staking market cap, which is $200 billion of stakeable assets that are staked, and I think we're talking since 2021.
So just to be clear, $200 billion of potentially stakeable actually stakeable.
That are
okay.
staked. That are
Okay,
staked.
great.
Across, so 40% of that are ETH, 30% of this is Solana, and the rest is 100 different assets.
I want to make sure we're clear, because I want to make sure it's clear to everybody, like sort of where we're at as far as the maturity, the opportunity, the size of the market, et cetera. So go ahead and continue.
Yeah, that's right. And only a couple of millions have been slashed since 2021, because the risk is, you can call it, kind of the risk-free rate in crypto, what money market funds are in traditional finance, where your central bank is the counterparty. In that case, staking your ETH or staking your Solana or ETH are your counterparty. The risk is quite minimal, though you still need to be insured. Usually we are insured as staking providers or company offering staking services to 3 to 4 times the amount that has ever been slashed on Ethereum and Solana. And then will, Goldman Sachs or the large asset managers offer staking services themselves. They usually tend to partner, but there's definitely ways and products that they will be able to build on top.
Eric, you have different perspectives, wildly different careers and professions. Like, what are you seeing as far as possible business opportunities in the future of stakeable ETFs?
Look, the Ether ETFs took in 10 billion, or they have 10 billion in the US. What would they have had if they could stake? I'm going to go around 10 billion. I just don't think this is a huge game changer. In my opinion, Solana may be better because 7% every year, that's a nice little kick. But it's not going to show up as yield, I don't think. I think it just gets baked into the total return. But if you start off with like 7% ahead of the starting line every year, that's pretty good. But remember, there's things you can buy in the ETF market that yield 10%, 20%. They even have some that yield 100%. So there's a lot of competition for yield. I think the bigger issue for these coins is which one gets the network. To me, and maybe I'm wrong.
Can you clarify when you say which one gets the network?
Yeah, like basically, correct me if I'm wrong. I'm a little bit of a newbie at this. Bitcoin's a different thing. It's a different animal. It's basically indestructible money, digital gold, scarce. It's over here. The other ones are all like little tech stocks. Which one is going to grow? Which one's going to get maybe some revenue from that growth and build a network of users and people that use it and companies that use it? That and any potential revenue from that is like a tech stock, having starting to get bought up. Which one will sort of win a race? They all seem like, a lot of them seem like they are, again, competing to build these blockchains that can service the most amount of people and corporations and then monetize it. Staking is a part of that, but I'd rather have the one that really wins that race than the one that happened to stake more. Because there's a lot of stocks that yield, REITs, real estate investment trusts, yield like 6-7%, but like they suck performance-wise. So like, what's the point of getting that if you can't? I'd rather own NVIDIA. So I think this is for at least US investors, it's more important to get that winner. That's why I think a basket may be good of all of them, like an altcoin basket. But this to me seems like it's going to matter more. But if Solana has a 7% lead every year because of the staking, and ETH has a 3%, that will help those two. But they also need to do the other part of growth. Did I miss anything?
Yeah,
no,
I think that's right. I mean, just like a traditional ETF, which typically doesn't consist of just one asset, right? So I think 2 factors will probably lead to that. One is people are going to become more comfortable just buying crypto on the spot markets, right? Like, we have market structure legislation coming that is going to provide a clear framework for crypto exchanges to become regulated. I think more retail customers are going to become comfortable buying crypto that way, making ETFs that consist of just one digital asset probably less popular. So I think you're going to see that. It's going to become more like traditional ETFs where it is a basket.
Hold on. This is an important topic, and I want to get your take on this. Okay, let's say you've got these exchanges that get you direct crypto. Have you guys seen the exchange rates on these things, especially if you're new? They totally hose you. I went on myself. I tried to get like Bitcoin, just Bitcoin. The cheapest I could get through this cold wallet I got was 2%. So then I went on, someone said, oh, use the professional thing or whatever. So I did that. I got to 1.5%. That's crazy to an ETF person. ETFs are 1 basis point to trade. So I will say, when all the spot is directly available on these platforms, will they be able to get you down to a couple bips? If they can't, I still think the ETF will win over spot because that cost is huge. You're talking 10 times, 100 times cheaper.
So if I could, real quick, shots across the bow fired with Laszlo here. So we got to give him a chance to respond.
I'm commenting on one one of your comments, not on the commissions between exchanges and ETF, because they're both our partners and customers. So I won't comment. And even if what you say seems very true, but what you said on these coins.
I'm so sorry. Let me do the journalist thing. When you say what you say, what exactly are you responding to here?
I mean, 1.5%, so it's essentially 150 bips for exchanges versus a couple of bips for ETFs. 150 bips, I guess, in traditional finance is like, what is that? Right? It's like, what are we talking about?
That's what they used to pay in the 1970s to a stockbroker. I mean, it's like 50 years old pricing.
Right. So I said I wouldn't comment. Maybe I did already, but on what you said on these platforms, will win in the end? Solana, Ethereum, Sui versus Bitcoin, which Bitcoin has narrative, digital gold, and that's different from being a decentralized developer platform where you build application, change the financial system on top. And I think I agree. Like, you need to have users, and ultimately the market will price the number of users, the number of transactions on these chains, where it will impact the price, and it will impact staking yield. Staking yield are coming in majority from transactions on these networks, right? So do you invest in NVIDIA because they give you a 7%? No, you invest in NVIDIA because it has high growth. You also invest in Solana because you're not looking for 7% additional at the end of the year. You're looking for more than that at this moment because it's a high risk and high return assets. But you will get the staking yield according to the number of users and number of transactions on these networks. So these are very well connected, I would say.
I was just going to say, I think with regulation is going to come more competition. And so I think a lot of the TradFi players are going to enter the crypto spot exchange space and fees will come down.
In addition to the fees coming down, are there other effects of these larger players getting involved? It is very early days, but that's why I like it. That's why I find it so interesting. I also find it so interesting because I love it whenever my home country, the U.S., falls a little bit behind and Europe takes the lead. It's fun to root for Europe, and you guys are winning here. So, what happens next as far as when we start to see more maturity, when we start to see stakeable ETFs approved in the US and elsewhere around the world, when we start to see more stakeable ETFs approved here, what are the follow-on effects? Are there other products that are built on top of that? How else can we monetize the ETFs once they're out there?
Well, I'll be very brief. I call it getting the ETF treatment. There'll be a spot Solana that'll yield staked, will yield 7%, 6%, depending on how much they can stake. But then they'll take that and they'll write options on top of it and jack you up to 25%. So that'll be called a covered call Solana staked. Then they'll come up with double leverage staked. So you get 14% plus the leverage. Then they'll come up with inverse. Then they'll come up with buffer Solana. And then they'll do Solana minus Ether plus Bitcoin. I'm telling you, they're going to throw they call it the spaghetti cannon. It's just and then a couple things will stick, and the rest will kind of go into the wasteland, and that's called getting the ETF treatment. So I think a lot of these coins will get that treatment. I'm not sure which ones will catch on, but they'll get the perfect fitting coat for you in terms of the exposure you want and the risk you want.
Dee, what's holding back the general counsels? Why are they apprehensive, or are they not apprehensive and they're ready to go and there's other things holding it back?
Yeah, I mean, I think a lot of companies really across the space, right? Because so many different kinds of crypto companies have a stake and an interest in this. I mean, it's a lot of the risks I think we mentioned before. I did want to mention one interesting proposal I've seen
Please.
and this has been presented to the SEC. But this idea of using a liquid staking model to address some of the liquidity concerns.
And for those that don't know, real quick, just what is a liquid staking?
Yeah, so liquid staking is basically, you stake your asset through a smart contract protocol, and you get a liquid staking token back, and that is just a receipt for your staked asset plus your rewards. And what it does is it allows you to use that liquid staking token to trade it, do whatever with it, even though your underlying asset is still staked. So what that could potentially do in a staked ETF is allow your stake or allow your asset to remain staked, but you can use your liquid staking token and have access to it. And so that's a proposal that has been presented to the SEC, and I just think it's a really interesting way of potentially addressing some of the risks that the regulator has been concerned about.
Are there any other sort of interesting experiments that you've seen out there? And they're big names. Franklin Templeton recently applied for a stakeable ETF. We've talked a lot about the problems, but let's talk, or not the problems, the obstacles. What sort of experiments are we seeing out there as far as solutions? Are they coming from the startup side of the thing? Are they coming from TradFi? How might we see some of these prohibitions kind of be overcome in the future?
No, I think liquid staking are very interesting solutions because you have different forms of liquid staking. You have essentially three forms of them. One is a completely pooled DeFi liquid staking solution where the funds are pulled from potentially US ETF or US customers and pooled with any other users around the world. This, I think, won't fly anytime soon at the SEC level because the SEC wants to see and wants to protect US customers. There's another form where you're actually tokenizing the validator, and the validator could be in the US. And it's 32 ETH in the case of Ethereum. Now it can be more. The problem of that is that it creates some liquidity problem because
there's a decent chance that we have folks in the audience that don't know what the validator is. Could you just really quickly talk about what does it mean to tokenize the validator in that example?
Yeah, when you stake your ETH essentially, which doesn't happen on Solana. I mean, when you stake your ETH, you have to spin up a validator that is linked to your ETH that are staked up to 32 ETH. Now it can be a little bit more, but you have to spin up another validator every 32 ETH. So that's just the background, the back end of a staking provider, what we provide. On Solana, it's slightly different where you're going to stake all of the assets on one validator, right? So let's say BlackRock might have one Solana validator versus thousands of ETH validators in the background when they offer a staked ETF. So there's this concept then of liquid staking, but liquid staking, I think the one version that will fly in the US will be the ones that touches only US customers, right? That potentially pooled, maybe segregated US customers together, and then this receipt can be the base of much more advanced and much more risky type of yields that are built on top of the staking yields through liquid staking products.
Other than liquid staking, anything else that we're seeing out here to sort of overcome some of these concerns and hesitations?
So there's at least one project that is allowing Bitcoin, which you can't stake in the traditional sense, right, because it's not a proof of stake blockchain, but is allowing holders to earn yield off of their Bitcoin holdings. So Bitcoin staking basically involves the investor posting their Bitcoin and earning ETH staking rewards by posting their Bitcoin as collateral on a decentralized collateral platform. So like Babylon Labs is an example of a company that's doing that.
Bitcoin's not a natively stakeable asset, and these are folks that are figuring out how to use it to stake in stakeable blockchains.
Yeah, and like there is already a Bitcoin covered call. And a Bitcoin, there's a MicroStrategy yield max. So yield max writes just out of the money call options, which gets you a high premium, and the yield max MicroStrategy yields 160%. So like again, that's why there's a whole world of yield-bearing ETFs that these will have to compete with. But for me, again, what's exciting is Bitcoin's growth, and as basically a hedge against the global money printer. I think if Bitcoin hits 150K, some really interesting things will happen with advisors 401ks. It could get crazy. On the other side, though, I think these coins, what they need is like a 3-phrase sentence that describes what they do. And I polled Twitter about Ethereum, and I said, how would you describe Ethereum in like 2 words? And some people said programmable money, digital oil. A bit like, you know, a normal person's brain it doesn't make sense. It doesn't compute. Digital gold, it makes sense. So this is the bigger thing I'm looking out for is how, now, if one of them goes on a crazy run and returns like 150% within a year, that is called a shiny object moment, and ETF investors will be like, ooh, but then you have to match it with a narrative. Like, when the robotics ETFs went up crazy, it was like, ooh, and then people were like, oh yeah, of course robotics are popular. I saw the robot doing a somersault on the video, I'm gonna buy this. The narrative part of the altcoins is missing a little. Because a lot of what they do seems like business to business. It's not like something anybody can feel or touch. So I'm looking a little bit for how the ETF industry, because they're very creative with marketing, how do they take some of these altcoins and basically narrow them down to a very digestible soundbite in order to try to get people to understand them.
Digestible soundbite, literally just what do they do?
Yes.
You talked a little bit about baskets as well. Where do you see sort of the future of how stakeable ETFs might be repackaged?
Yeah, so you're probably going to have like all sorts of choices. Like you'll have you'll have like the crypto 10, Bitcoin. The problem is Bitcoin's going to be like what, 70% of that? In my opinion, I would separate them. I would buy Bitcoin on your own, and then I get the basket for the rest, market cap weighted. Because you want the active players to bid up the good ones, and then you just benefit from that. So if Solana becomes like the big thing and it passes Ether, it will automatically get a higher weighting in the index. So I think a lot of people who don't even understand any of it might be open to that. Because they're like, I don't know who's going to win this race. So that's part of the beauty of ETFs, is you don't have to like study it, you just buy all of them. And they may even get to 50, depends on how far we go into this, but a basket could be a solution for a lot of people.
21 Shares is already offering not just a basket ETF, but a stakeable, like a staked basket of assets through an ETP. It's an ETP, I believe, in Switzerland. So,
in Switzerland, yeah.
In Switzerland.
Yep, and they also offer 37 ETPs in Europe, coins like Aave or Ondo. The ones that are stakeable, those are not.
It's interesting that you talk about like, what do these assets do? I think it's a fundamental question. To sort of piggyback on something V said about being able to stake unstakeable assets. There's been some applications out to tokenize Microsoft stock. Not by Microsoft, but by third parties that want to basically turn their Microsoft ownership into tokenized assets that can be traded. Do you see a world where we could maybe not have to worry about defining what these assets do because we're staking traditional stocks in stakeable blockchains?
Yeah, I mean, tokenization is a great concept, and I get it for the back office, but to a US investor, they can roll out of bed in their underwear, go over to the computer, fire up Schwab, hit a button, and they own all the crypto assets, all Bitcoin, everything in 1 second for no fee. How do you dislodge that? That said, they can only do it 9 to 5, and it's only US. Tokenization to me is great for a global, so if they can, you know, get global 24/7 sold and see some people in other countries buying these tokenized assets, I could see that, but I'm still trying to see what that does to just buying MicroStrategy on Microsoft.
You've got the last word here, General Counsel perspective. What's the likelihood that we see a stakeable ETF approved in the United States in the next 3 months?
So I don't think it's going to happen before we see like just a straight spot Solana ETF. That'll probably come first. I think that'll happen soon. And then after that, I think it's any day now.
I think it's going to happen in 8 weeks.
8 weeks, all right, there we go. Put a pin in that. Guys, thank you so much for joining us. It was a great conversation. Please give them a round of applause. All right, thank you so much. Rare opportunity to get some insight into what BlackRock is doing with digital assets. I really appreciated that conversation. Coming up next, we have a panel called Beyond UX, Building a Blockchain for Developers. Please help me welcome to the stage Christian Thompson, CEO of SWE Foundation, Mert Mumtaz, co-founder and CEO of Helios, Martin Durka, co-founder of Zirkit, moderated by Dan Hughes, founder and CTO of Radix. Please help me welcome to the stage with a big round of applause.
I think the trick is to not fall on those stairs. It's this close.
It's a bit tricky, yes. Hello, everybody. My name is Dan Hughes. I'm going to be the moderator for this interesting panel we're going to have this afternoon about Beyond UX, building a blockchain for developers. A very interesting concept, very interesting topic. You know, developers play an integral part of our ecosystem, and they very much bridge the gap between the protocol and the users. So without further ado, I'd like to welcome my esteemed panelists. I've got some questions here. I hope they're adequate for everybody. So we'll kick off with the first one, if everybody. Okay, so let's go. I made some notes, by the way. I've just written these, so my bad. So developers, as I just said, are like the conduit between the protocol and the users. What are some consequences of the developer experience maybe being subpar, and what effect can that have on the users and also the protocol and the ecosystem?
I mean, you know, the very clear consequence of having subpar developer experience is that nobody is going to be building on your chain, you know? I mean, throughout the career, I have seen actually both sides of the spectrum. I've seen developers developing on obscure technologies because, you know, some of them actually perceive it as a challenge. If the right level of incentive is in there, they find, you know, sufficient ecosystem. It's actually like not such a big deal for them to learn obscure technologies and work with them. But at the same time, like if they can choose between exactly the same ecosystem here and over here, the experience for developing is better. They can get it done faster and, you know, appease the users in a better way. They're going to choose here, right?
So the question is, the developer experience being bad, what would be the downstream consequences for a blockchain,
exactly.
Presumably? Yeah, I mean, I think probably I have somewhat of a hot take on this, which is that it actually doesn't matter so much at the beginning as it does later on. And the reason is I'm just using empirical history, right? So when Solana first launched, the developer experience was awful. Like you could not do anything without killing yourself or just writing something horrible. But that didn't matter because the developers would eat the pain on behalf of the users. And so if you do that and you build a system that actually works much better than some alternative, as long as there's users, the developers will come and try to build for them. So, but obviously if you don't optimize for that at some point, hopefully some point soon, then the people, the developers that are building will obviously, they won't stay. They'll start hating you, and then you'll just kneecap your growth, right? So it is important, but I think, and like it's ironic because I run a developer platform company, but I don't think it matters as much as people think at the very beginning. It's sort of like PMF, where it's like you can usually get away with launching the first version of your product to be not great as long as there's a really good market. And then you can keep iterating after that, but you don't need to over-optimize right at first.
Great answer, thank you.
Yeah, I mean, I think it gets more expensive over time, right? If you choose wrong at the front end, it probably doesn't matter to this point. I think if it starts to matter as you get product market fit, though. right? And if you're sort of, I call it sort of skating to the puck. It's important to not just follow the puck around, but it's really important to understand where it is you're going in your product cycle and what you're developing, and making sure that whatever you're building on is capable of supporting that thing. So.
Okay, I want to touch a little bit on what you said, Mo, right? So I've been around in this industry since 2012, and back then building on Bitcoin was really terrible. And I think we can all agree, over the past few years, the general developer experience across the industry as a whole has improved significantly. And I think it's a good point that you made about, Solana. The initial developer experience there was very hard and awful, I think your term was, which every chain is going to go through that as they've built a new stack and then they're drawing in developers. But would you agree that generally overall across the industry, that experience is getting better? And what do you think have been some really good improvements in the developer experience overall? And what do you think is still lacking, maybe even critically, in the space?
So the developer experience is definitely improving. I belong to the Ethereum ecosystem. I have been developing on Ethereum since about 2017. And when you sort of think about teleporting back in time to 2017, it's almost so different that it's uncomparable. In 2017, we were in the era of ICOs, right? So everybody was developing the simple smart contracts, the simplest possible smart contracts that exist these days, and those were tokens. And it took ages. Sometimes it took weeks, And it was because when you were developing your smart contract, if something that you were testing failed, you literally got back this transaction has failed, and you didn't know why, and you didn't have debuggers. The only thing that you were able to do was obtain a trace and then actually go through the opcodes to even decipher why your thing failed. Right now we have frameworks. You have Foundry, you have Hardhat, you have logging, you can print to console, you have various systems for front-end scaffoldings, you have libraries like VM. We literally back then were learning what we need in the first place. I think that over the time, the industry actually realized what the developers need in the first place, and they were able to build it and patch the holes. You have networks, that you can use to fork mainnet right now and actually deploy your protocol during the development over there. You can test with real data. There are so many tools that literally were not available, and I think this is a great step forward that is removing a huge barrier for the developers. What is perhaps still causing some friction here is, in my opinion, the learning curve of the blockchain itself. When you take a developer who is natively Web 2 and say, hey, just go and develop an application over there might not, and I will guarantee to you that many of them will not be used to the fact that there exists something like a wallet, that they will not see something like a private key and so on. They will need to learn, and that takes a little bit of time. Whatever we can do to simplify it is actually going to be very, very valuable. And I would like to agree here with Mert, because the developers are taking on that task of deciphering this complexity for the users, right? So the better and easier we can make it for them, the better.
In terms of how developer experience has gotten better, I would say the biggest thing has been this new technology, ChatGPT. I would say that's certainly gotten it much easier to get started and vibe code whatever you want. And I mean, there's a new one. I mean, obviously there's Cursor, which is the code editor, but there's also things like Codex by ChatGPT, where you can basically ask it to spin up a PR for any trivial, smallish piece of task that you would ask a junior intern. So if you're a junior intern, by the way, I would be really trying to stand out some other way, because I think those things are coming pretty fast. And then on the flip side, though, what that does is it probably starts making crypto a bit more vulnerable, right? Because if you now have a bunch of people generating code that they don't quite understand, and you're moving millions of dollars around, that's a attractive proposition for certain actors to actually hack those protocols and whatnot. So I think that's probably that's like an underexplored and unsexy part of crypto and developer experience, but security I think is still needs to be improved quite a bit. Like supply chain attacks, all this, even with like just node modules on the front end for some of these things. And there's like different architectures or like VMs you can throw at this, right? Like everybody probably knows the EVM, where, for example, to spin up a new token, you would have to write a new contract, and then it follows like the interface model. On Solana, that's different, for example, where there's one giant token program where it's like, audited to death, and it's enshrined with the protocol. And so you don't have to write a new contract for spinning new tokens, which is like a big part of the reason why more tokens took off on Solana in the past cycle. But then you have like other interesting models like Move, for example, which it feels like it was more purpose-built for blockchains as opposed to like Solana, which is like low-level embedded systems. So, there's a lot of room for experimentation, but I would say like if there's one field today that's like ripe for like business in terms of developer experience, it's probably security.
Can I quickly react? There used to be this joke in the software developer circles that the difference between a university-educated software developer and a software developer is that the university-educated one understands what they are copying from Stack Overflow. And so, I think that this joke is sort of, still here and prevails just a little bit differently. Your engineers who really have the software engineering experience, they do not, become 10x, they become 100x. But the ones who are actually, maybe a little bit lower than the bar, they become dangerous. They literally become dangerous because the AI, it allows them to code seemingly functional applications and products, but because they do not understand what kind of an error the AI currently introduced for critical applications such as the ones that we develop on blockchain, they unfortunately do become dangerous.
Yeah, I would echo a bunch of that. For us anyways, a bunch of it is like building the whole tool set. It's about building a full developer stack and giving them, putting them in a position that it's just easy to adopt, because there's wide range of developers from real beginners to like full core, and we find that like having these disparate pieces really have natural interoperability between them, and the ability to build across I just feel like that our industry in particular is maturing right now to include AI, and we'll see how that all plays out. But the developer experience to me is maturing recently, I think.
See, the sign of a great panel is when they lead you very nicely into your next question. So, of course, ChatGPT AI is a great point, right? That definitely lowers the bar, not just for crypto developers, but across the entire spectrum, Web 2, Web 3. But I think the Web 2's developer experience is such that with a few hours of learning, download some tools, I've got a LAMP stack that I can deploy, and within a day or two, even if I'm a real novice, I can get a basic application up and running. But given that these are networks of value and there is an inherent complexity to how they operate, do you ever think that we as Web3 will get to that convenience where even real novices can take a day or two and be able to confidently build applications that, maybe they're not mega polished and stuff, but they serve the purpose and they enable them to try out some business ideas and things like that? Or do you think there will always be this level of friction where there needs to be a level of expertise?
Yeah, I think the novices have to be able to build in it in a meaningful way. You think of something like WordPress and Web 2, right? That unlocked a whole new set of entrepreneurs to be able to start something. So it's really remedial, but at the end of the day, it was very meaningful inside of Web 2. And from like a Facebook perspective, when we were there, right? it gets a whole new set of people interested in it. And I think the easier that you can make it, certainly the better. I mean, it shouldn't be rocket science, right? If it is, then you're going to always talk to a small segment of people.
Yeah, I mean, certainly agree with that. I think it'll be very easy. I mean, like, the whole value prop, or at least one of the main ones, is barriers to entry with crypto are lower than the existing financial system, where you have to, ask the CEO of some fintech for the API key so you can send money to like Australia. The whole thing doesn't work without increased competition and increased access. And so for that to happen, there needs to be composable applications. And like, yeah, I think like it is a good point that you're moving around value, which perhaps requires careful thought. But that, like, I think the foot guns and like the mistakes that you can make, for example, those are things that something with some opinionation and frameworks, those are the kinds of things that you can build around. I mean, like, I'll give you another example on Solana, since that's the only ecosystem I know. It's like there's a giant token program where it's been audited and like all the foot guns have been, or I don't want to say all in case something happens, but most of them that I'm aware of have been solved for and abstracted, such that you just, if you're just, it doesn't matter if you're a kid in, or if you're a student in New York or like a kid in Bangladesh, you can just open up a JavaScript, code editor, and then write like a few lines of code, invoke some program, and just transfer money at the speed of light. And so I think we're actually already there, to be honest. I think probably the confusion comes from sometimes like thinking that you need to write smart contracts. And like a lot of use cases do require new smart contracts, but a lot of them can also just be done by composing existing smart contracts that have already been battle tested.
That's what I would like to agree with as well. I think that the most important thing for a new developer, regardless whether they are developing smart contracts or front ends, are samples of existing world, right? In software engineering, the very first thing that every single textbook teaches you when learning new programming language is a program called Hello World. How to say hello to somebody, right? So we need some basic amount of samples, the simple use cases for blockchain that is usually a token. And from then on, you just need the more complicated samples, and you need good templates and libraries. For example, on Ethereum, Open Zeppelin has been doing fantastic job for ages. You will literally take, I would say 80% of every single blockchain application, and it's just like by composing that framework together with, various features that they have developed and templated over the time. And it's audited, secure, and so on, right? So I agree that we are actually mostly there. I don't think that it takes longer than roughly one day to penetrate any ecosystem in blockchain. You will end up with your functional applications, especially if you use some AI tools to support yourself and so on. And I mean, I think that I even have a justification for it. Like, we sponsor a whole bunch of hackathons, right? So I go around, I judge applications that the hackers develop over the scope of a weekend. So they start on Friday, they submit by Sunday morning, and there is a huge difference between the quality and the level to which these applications are finished and functional that was being presented, let's say 3-4 years ago, and that you receive now. Right now, you almost, are looking at the system. It's like, okay, so what's the problem? Why is this not production ready? It's actually looking pretty good. So.
Yeah, I think there's the whole topic of maturity and being composable, right? Like any chain is going to have that growth period where it's got to build the library of components, right? Like, your kind of hardcore developers have got to build those first, in the way that with JavaScript and all the Web 2 stuff, there's all this plethora of libraries and different things you just bolt together. And that's really good to see. You can have this composability, which takes a lot of load off the developers or the users. But there's a lot of interest at the moment around like abstraction of things as well, right? And some conversations that I've had, people are concerned that may complicate the developer experience again. So account abstraction was a recent thing in the Pectra upgrade, I believe, right? So do you guys have any thoughts around if those concerns are true, if they're warranted, or if we just don't have to worry about abstracting away a lot of this stuff? Does that add complexity back into the developer experience, or does it actually do what it's supposed to do and pulls it out?
So this sort of doesn't touch only on the developers, but that's sort of a combination of developer experience and end user experience. Blockchains are complicated. Your bank doesn't ask you how much you want to pay in gas for your bank transfer, and how much that gas is actually worth to you, and so on and so on, right? So developers, that's the part where they have to learn. If we manage to abstract it away and perhaps even achieve the experience where it doesn't matter whether the underlying chain is Solana or whether it's Ethereum or whether it's some future chain that doesn't even exist today, and somehow manage to abstract that layer away and standardize, that's obviously very, very positive. You touched on the account abstraction. That's actually also sort of interesting element. So sometimes what happens in this space is that we innovate in a way that sort of didn't exist before, and not everybody agrees with this innovation. So you mentioned the Pectra upgrade. Pectra upgrade of Ethereum brought some mechanic for account abstraction. It's called EIP 7702, and what it essentially allows is for you to sign some special transaction that says your wallet, your externally owned account, will start behaving as a smart contract, and that's really powerful in some way. But we arrived to a situation where the wallet said no. We actually own our users. We feel that we are responsible for their safety and security, and we do not think that this feature is actually good for them. So majority of Ethereum wallets right now will prevent you from using EIP 7702, and they will not allow their users to sign such transactions, and therefore they will not allow developers to actually work with this EIP effectively, because they just don't feel like it. The outcome of this is that you have a developer who is trying to achieve something, and then they try to test it, what that user experience at the end is like, and then they learn that the wallet is just like not signing that part, right? So it's sort of weird, some abstractions are good, some abstractions are bad. There are multiple opinions everywhere. We are tech innovators, we like to compete, and we like to make the space interesting.
I didn't hear the question.
Okay, so basically, there's a lot of interest around abstraction, like account abstraction, to give more flexibility in what developers can create and how the users interact with applications. But do you think that abstracting too much can actually inject complexity back into the developer experience, or do you think that's not a concern?
Well, yeah, I think the question, I think it's too general for me to have a meaningful opinion on it. I think things that are painful should be abstracted, or no, I would say the things that are too painful will be abstracted, because otherwise they wouldn't work to begin with, right? Like if the pain is causing somewhere in the flow such that people just don't go on, well then the solution for them to finish is going to be abstracting that. And so there's like a evolutionary aspect to abstracting the things that need abstraction. In terms of like, sometimes people will say that, well, in the future, and this is like super common, in the future that, all the blockchains will be abstracted away and nobody will know what blockchain they're interacting with. I think that's incorrect, and everybody yells at me when I say it, but like it can't be correct, because they all have different security properties, right? Like if I'm storing my, $5, then okay, yeah, I don't care. But if I'm storing like $50 million and you're telling me that I don't know which blockchain it's on, it's like, how do I know it's secure? What am I supposed to do here? So I don't think like everything, there's always like this analogy to like Web 2 where it's like, oh, you don't know what cloud provider you're using, so why would you know which blockchain you're using? And it's like, well, if it was a cloud provider like AWS, then you wouldn't need the blockchain to begin with, right? You could just also use Google Cloud. It's fine. But so there must be some fundamental differences here. So I think the things that will be abstracted will be just it's good because it's going to be a competitive evolutionary force. So like, for example, a good example is MetaMask versus Phantom, right? MetaMask was by far the biggest wallet and, well, really the only wallet. But then Phantom came and then started making opinionated decisions, now somewhat due to the underlying blockchain they were on, but then somewhat due to their own beliefs about what to abstract and what not to abstract. And the users said, we like this version better, and so that's what they went with. And so tomorrow, if there's another Phantom which does different decisions and they get more users, well, then the market kind of tells you, right? So I think and none of my opinions will be too relevant. I think the users will decide what they want, what they don't want.
Yeah, I'm not going to pile on that too much, but I'll just say, like, to me, it's all about user experience. And if you can simplify their interaction, I'd rather thrust that sort of development work on developers rather than on end users. So you look at something like zero knowledge, right? And the ability like ZK login, where you can log in with just a simple OAuth, right? Your Google account, your Facebook account. These things to me are super useful, right? They just allow for onboarding in a very meaningful way at scale. And to your point, I mean, it's already proven security, and there's already, so, but again, I think there's like this range of developers that will want some amount of abstraction, and others will not. Others will want to dive in and really get into the weeds.
Yeah, I guess it depends on the application they're building, who their user base is. Abstraction may be something that they want, or they may want to get deep in the weeds so that they can produce different features. But I think Mert's point about abstracting away the pain points, I think that's important, right? Don't abstract everything, just the things that are causing issues, and be sensible about what is abstracted and done in a way where it's understood why and what benefits it brings. But
yeah, a lot of it's just knowing your customer, right? Really having a good sense of who they are, what they want, and you don't want them falling off in the middle of, signing up for something, right? I mean,
there is actually one negative aspect of abstraction, and it's that it's abstraction. It makes you lose access to the special features of everything that is underlying and that was abstracted away. So sometimes when you are a developer, you like to work with your framework that actually unifies the technology, the underlying backends, and then you learn that framework really well, and suddenly a new blockchain shows up and it allows something, better, and you want to use it, and suddenly you realize that because you are using some kind of a framework that is abstracting away a lot of stuff, you don't have access to it. And then you find yourself jimmy-rigging like two stacks together because you actually want to use that thing natively, but you also already have rest of the system that was developed on that abstraction, and that actually does cause occasionally a lot of mess.
Great answers, thank you. There was something you mentioned about the security properties and abstraction, and then I thought about a different aspect of looking at the developer experience. So we've talked a lot about how developers enable the users and the flow of value that way in terms of the applications that are made. But if the protocol there's a developer that wants to build a particular application but is not able to because maybe the block finality times are too long, or the block rate is too slow, and so it's not responsive. Do you think that will ever become a critical issue, that protocol limitations, the properties of the security, just de facto don't allow for certain types of applications? I don't personally think we're there yet, but I'm just curious if any of you guys think that at some point in the future, maybe an entire class of application just isn't possible, even though the user base is there for it. And if that's the case, what do we do about it?
I mean, I think that's a real concern, right? I mean, I can say even when we were at Facebook, we built Move for a reason. We didn't build Move because we wanted to. Move was built because there wasn't a language that would support 3.5 billion people a day. And so, you know, I think that is a reality for Web3 in particular, is that if it grows at the same sort of scale that Web2 is at, I mean, you run into real problems with scalability with a lot of infrastructure. I mean, you've seen things fall over for like traffic just even around meme coins. Right? I mean, yeah, I mean, if you go through any third-party risk management, anything, right, this is going to be a question for any enterprise, any institution, any government. They just simply won't be able to build on infrastructure that can't support it.
I mean, the developers always have to fully understand the limitations of the technology and create their products in the way that the technology supports it. Like, you know, if you take a pigeon and you take a string and you take a car and you tie the pigeon to the car and say, we will fly to the Mars, like, probably not, you know, it doesn't work that way, right? So, you know, in the spirit of blockchain, like, talk to, let's say, credit card issuers and tell them that, you know, the settlement time or finality of a credit card transaction is, I don't know, 7 days on an optimistic rollup. Like, they will probably not be happy with that, right? So absolutely, the properties of the protocols, they do impact the level of product that you can develop with the said protocol.
I think the history of crypto has been a little backwards, where you build the blockchain and then you try to sell it upwards. And so you have a solution looking for problems and you're like, okay, which problem do I fix? And so you end up doing ridiculous things like, I don't know, dog food on the blockchain or something. Where the actual way which presumably you would want to do is you look at the market and you understand which problems are big problems that actually require solutions, and then you would design a solution with something with that in mind, right? So, like, you don't want to build a key and then just look around every single door in the world and be like, which door does this open? You want to look at all the door holes, and then you want to design the key. It's like, okay, this actually works. And I think that's really the key, and because, like, you don't want to let the blockchain do absolutely everything, because if it can do literally everything, then really it can do nothing, because like you don't have any strong opinions, so you don't really have any glaring strengths or weaknesses maybe. But and so, like, for example, if you think that the problem is, and you're seeing this recently, like, it's just in the past 2 weeks, there's been like 4 blockchains, I think, that are like purpose-built blockchains for stable coins. Right, like Tether is literally sponsoring transfers, and then it's like purpose-built for stablecoin transfers only. You can build, like Avalanche was doing a lot of work in Sui as well around like gaming, right? So I think you need to work backwards from the customer and then see if this works. And so, like, the limitations are only, I think, a big factor if you're like, for example, you start on Ethereum, or let's say Bitcoin to be more extreme, and you're like, okay, I'm going to build a central limit order book, but my protocol doesn't allow for it. It's like, yeah, that's because it's not designed for that at all. So I think it's super important as a developer that you look at the solution or the problem you're solving, and then always working backwards, as opposed to like, oh, you know, I put this on my pitch deck, and I saw, you know, Paul Graham talk about it on his essays, and so I'm going to now try to build a company around it. It's just always like, what problem am I solving?
Cool. Okay, I think we've got a few minutes left, so I've got one more question, and then we'll take some final thoughts from you guys. So, final question is, every chain out there is obviously trying to capture as much talent as it can, and obviously the developer experience plays a big part of that. But there are some other factors too, of course, right? Like the ecosystem. How big is the ecosystem? What is the value capture like? Are there any, like, if you are a developer, what are some of the top line criteria you think, aside from the developer experience itself, that will you gravitate to a particular chain versus another one?
It is the ecosystem. It's whoever else is on the chain that you can integrate with, that you can interact with, and build useful products. Even the developer experience, like, is almost insignificant compared to that.
Is the question like, what are the criteria for why an ecosystem might be more attractive for developers?
Yeah, so I suppose, let me reframe it slightly. So there is a chain that has the best developer experience, right? It can do everything it needs to do. It's easy to build on. It's efficient. It's intuitive. It is the best in class across the entire space. But given that, what other things might entice me away from that chain to somewhere else? And I believe the ecosystem is definitely probably the deciding factor. But are there any other things that we should consider, maybe education or grants programs and things like that?
Sure, yeah. I think they're basically blockchains are like cities where everybody has a different city idea that they like. For example, if you really like nature, you probably don't want to go to Dubai. If you really like finance, New York, Chicago might be interesting. But like if you want to be by the water, you don't want to be in Milwaukee, maybe you want to go to LA. I don't know the European equivalents. So like it just depends on, so like, okay, then the question you might ask is what are the different traits for a blockchain? And it's like, yeah, there's the community aspect, the ecosystem aspect. Liquidity is extremely important, and probably the one thing that can't be forked is state. So like who has what assets in what amounts, right? This is also why Ethereum is still quite strong despite being not very performant. It doesn't matter because they have so much unforkable state, like with the amount of TVL they have, the amount of stables printed there, and the existing network effects, right? Because blockchains fundamentally are networks, and so what you really need to look at are the network effects.
Yeah, real briefly, I think two things. I think it's important to give developers an actual set of tools that work, that they can build meaningful things, and I think that naturally creates gravity. That's one. I think the ecosystem is definitely part of it. The other piece of it, though, is the ability to support things that are important to them, like artificial intelligence, right? Can you support that in a meaningful way as like a coordination layer? Can you do storage? Can you do access control? Can you, validate off-chain activities on-chain? I mean, these are some sort of core tenets that I think, any business leader will want. Ultimately, I think developers go where the work is, though. If there's business that wants to build on an infrastructure and they can get paid to do it, they're going to learn how to do it and build on it. I mean, it's pretty simple economics as far as that goes, right?
Okay, so any final thoughts from you guys on anything you're excited about in developer experience or ecosystems, anything that you want to mention before we wrap up? Any final thoughts?
We need more developers. If you can do one thing today, go to a developer who is not blockchain oriented and say, hey, you should develop on blockchain.
You can just do things. Just go do them. Go on ChatGPT and be like, help me vibe code this DeFi app, but make sure I don't get hacked. And then just go from there. You can just try things.
I mean, we're excited about where things are going for us. And of course, we also want more developers. I don't think anybody doesn't. I mean, that's not unique in Web3. But I'm confident that so many of us right now, it's so early in the infancy stage of Web3, that there's just so many opportunities for young developers to get into our business. And I'm confident that we'll get a big push or a big draw from Web2 over a period of time. But it's going to be interesting. It's definitely going to be interesting to watch. And it's also exciting to just be part of something that's right out there on the bleeding edge of things,
Excellent. So thank you very much, panelists. Audience, I hope that was informative. You learned something and you enjoyed the talk. We can give them all a hand of applause. Thank you very much.
So much for that. That was awesome. Learned so much. We've got another fascinating conversation. Well, this isn't a conversation. We actually have an address here from Paul Thomas. He's the founder of blockchain Somnia. Super fast blockchain, about ready to launch. Started in the gaming space, but is expanding its applications. Going to talk to us about building transparent infrastructure. Please help me welcome Paul to the stage with a round of applause. Thank you, Paul.
Hello, everyone. Very nice to meet you. My name is Paul. I'm the founder of Somnia. And today I'm going to give you a talk on how we believe the Web3 industry should move forward, making blockchain transparent infrastructure. So I'd like to start this talk by talking about why we built Somnia and what we were thinking when we were building it. So I used to work at a company called Improbable. We built technology for massively multiplayer online virtual experiences. We applied that to the gaming industry, to the sporting industry, and to the music industry. This video you see here are those experiences. We essentially allowed tens of thousands of consumers to gather in the same space at the same time digitally. They can all be fully customized, so have fully customizable avatar, and all talk to each other in real time. So we did this in the games industry with big brands like Yuga Labs. We're building Otherside. We did this in the sports industry. We work with partners like Major League Baseball, doing digital twins of baseball matches. And we did this in the music industry with people like Universal Music getting K-pop artists to be in a digital space with their fans. Now, the vision behind this was that all of these experiences were interoperable. So you as a consumer could go to one of these events, buy some digital items, say a Major League Baseball jersey, and then go to all the other events in the network. Now, in order to do this, we needed a shared global ledger that they could all plug into, and also an interoperable compute platform. So we were like, blockchain is definitely the solution here. So we started looking at blockchains that existed in the market when we had this technology, and the problem we had was scaling. When you have tens of thousands of consumers, hundreds of thousands showing up to one of these events, all trying to interact on-chain at the same time, blockchains just are not designed to do that. So this is what we mean by transparent infrastructure, making it seamless for users to go into experiences and be on-chain. So there are three key problems that need to be solved in order to do this. The first is an infrastructure problem. So this is what we're building at Somnia. Essentially, you need a blockchain with a very high performance, super high throughput, and very low latency. Somnia can do over 1 million transactions per second, which allows it to scale up to hundreds of thousands, millions of consumers on-chain at the same time. It also has sub-second finality with very low latency, so transactions resolve instantly, giving very smooth experiences to consumers. The next issue is user onboarding. If you guys have onboarded onto Web3 before, you know it's quite a weird experience. I'll talk about this later in the presentation of how that experience needs to become much more seamless for end consumers. The final issue is cost. Today, most of these items that were in these experiences cost $10, $5, $2, 69 cents. If you have multiple dollar gas fees, that does not work. The other issue is when you want developers to put more logic on chain, they have to pay for that computation. If that computation is too expensive, these experiences are not financially viable. So these problems need to be solved in order for blockchain to become transparent infrastructure. So I want to kind of talk through this concept a little bit more and harping back to Web 2 and why I think Web 2 has nailed transparent infrastructure. So if you think about a consumer application where I want to buy some food, I go to the application, click buy, the food comes to my front door. Behind the scenes, there's a host of technology going on that the consumer never knows about. So that application will go off to a web server. That'll be hosted on AWS, GCP. Consumer doesn't know what cloud provider it's running, and neither should they know. They're using OAuth to kind of authenticate and get into the application. They don't know anything about that. And they're also using complex internet protocols like HTTP, TCP, IP. Again, they have no clue about all of this stuff. They just go in, buy food, and get food. If you think about a video game, that's an even more complex application. Here you have what we call hybrid infrastructure. So it's running across cloud and bare metal. You also have much more complex networking protocols. You also have very complicated matchmaking algorithms. So players need to be matched based on their geography and based on their skill. You then also have complex front ends with complex rendering and AI. So all of this, though, is hidden from the user. I just download the game, press play, jump into a match, and have a good time. Don't know any of that back-end stuff. Web3, on the other hand, we decided to make the back-end front and center. And this I find quite odd. And I want to run through an experience of onboarding a new consumer and them doing a swap on a DEX to kind of highlight this. So first of all, as a consumer, I want to swap on a DEX. I need to know where is that DEX running, what chain is running it. OK, it's running on this chain. I now need to go get that chain's gas token. So I go to a centralized exchange, buy that gas token. Then I need to work out which wallet is compatible with this chain. So I go find a wallet, install that into my browser. If it's on Solana, there's a wallet there. If it's on Ethereum, there's a wallet there. If it's on Sui, Aptos, there's a different wallet there. I then offboard my gas token to the mainnet, and there I have my gas ready to use on the chain. But wait, the problem now is we've fragmented the blockchain infrastructure so that there's loads of different chains, and often consumers will have to bridge to the relevant chain. I don't know if people in the audience have bridged very much, but it's quite a scary experience. You kind of put your tokens into the bridge and hope they come out the other side. So now, I'm finally ready to do my swap. I go to the website. I get greeted with dozens of pop-ups warning me about various things and approving various things. And I finally get to do my swap. If the chain is congested, that swap can take seconds, if not minutes, and cost multiple dollars. This, I think we all agree, is a crazy workflow. We're taught very early on in user experience design, every single step you put in the user's journey creates drop-off. And it's amazing to me that we have any consumers actually using blockchains today because of all these steps they need to go through. So how do we solve this? There are three major key components that need to be done in order to solve this. First, you need a very high throughput blockchain that can support millions of consumers, that has very low latency and very low cost. That's what we're building at Somnia. The next thing, there are two key technologies that are making it much easier for users to onboard. So the first one is account abstraction. Essentially, what this allows you to do is use social logins that create a wallet on behalf of the user. So you can use things like Facebook, use things like Twitter. A wallet is then created. The user can then interact with the app. You also now are seeing more applications use gas sponsorship. So this is already ubiquitous in Web3 gaming, but I believe the whole industry will start using this. In this model, the app developers themselves pay for the gas on behalf of the user. So this means the user no longer needs to get hold of a gas token to utilize an app. That is done for them by the apps. That just makes sense to me. If you think about Web 2, app developers pay for the end infrastructure, and we think the same thing will happen in Web 3 as well with gas sponsorship. The final new technology is chain abstraction. So the way this works at a high level is you go to an app, and then that app routes you to the relevant blockchain dependent on where the data lives, where the logic lives, and where the liquidity lives. That, we believe, is a central piece of infrastructure for users to just go to the app and get routed to the relevant blockchain. So we have a couple of apps in our ecosystem that already feel like this today. The first app I wanted to point out was this application. So this is called Chunked. This is essentially a massively multiplayer online version of Minecraft. Now, the very interesting thing about this application is every single part of the application is on-chain. Every time a player moves, that is written to the blockchain. Every time a player crafts an item, that is on the blockchain. Every time they mine a block or place a block, that is on the blockchain. So the reason they can do that is Somnia's performance characteristics. But a consumer doesn't know this at all. They just go to the application, they log in with social auth or log in as guest, get put into the app, and they're now interacting on-chain without ever knowing they're running on top of a blockchain at the end of the day. So this is what we mean by transparent infrastructure. Seamless user flows with them interacting on-chain without even knowing it. The next app is an app called Fan3. This application allows fans to interact with their famous stars, be they sporting stars or be those music stars. The way this works is you go up to your favorite event, say you go to your music event or your sporting event, you scan in with an NFC chip, an app then verifies you, allows you to interact with your famous star. The star can then drop you value in the form of digital goods, access to future events, or talk to you directly. This gives fans a way to engage with their famous superstars in a much more seamless manner. All of this is on-chain. All the digital collectibles, all the user flow is all done fully on-chain. But the consumer never knows it. They just go to the app, log in, and get to interact with a famous star, trade the digital assets, but they never know they're on the blockchain at the end of the day. And this is what we mean by transparent infrastructure. So if we get to this world of transparent infrastructure, what does it mean for the Web3 space? How will everything change? So the first thing is you will create a universal identity for consumers. So consumers will kind of be interacting with all these apps, putting a digital footprint there, and then everything they own will be on chain. So you'll be able to understand who a consumer is and what they do. With the introduction of things like ZK technology, we can now verify more things about a user. So you can have things like proof of humanity to show this is an actual human and not a bot. Or this consumer went to university, this consumer is a gamer, giving you kind of a overall view of who that consumer is, allowing developers to attract those consumers in a more interesting manner. The next thing you get is composable applications. So once you put more logic and data on chain for these applications, other applications can build off that logic and data. So we are big believers in this because we believe this will make more applications faster. This already happened in DeFi back in 2021. We had DeFi Summer, and some of the key DeFi building blocks were created, and then loads of other developers came on and created a Cambrian explosion of different applications. We think this will happen across all industries, and we are very focused on the entertainment industry here, because building these primitives allows more developers to build more applications faster, which means more good applications for consumers, which means more consumers. The final thing is new application types completely. So with the advent of AI, everyone now can be a coder, or very soon they can. With that and all the composable logic and data, you can now build applications significantly faster with much smaller teams. This, we believe, will create massive innovation and find new application types that have never been seen before. New applications tend to be things that cause step changes in industry. If you think about mobile, think about free-to-play, these will cause massive step changes in those industries, and we believe the same thing will happen with Web3 because of all of this stuff being on-chain. So I want to end by just calling everyone saying, we need to get the technology and the fundamental infrastructure out of the way. Consumers should not know what blockchain they're running on. They should just go to apps, have fun. This is the only way we're going to be able to onboard the next billion of consumers onto Web3. Thank you very much. And that's it. Do it now.
All right. Thank you so much for that, Paul. Very exciting stuff. Looking forward to seeing that come out into the wild. For our next conversation, we've got a fireside with Michael Healy, co-founder of the Unit Network, with moderator Benjamin Schiller, chief editor at CoinDesk. Please help me welcome Michael and Benjamin to the stage. Hello, hello. This is Michael again. Sorry about that. We do have the unusual opportunity. We are not behind schedule here at this event, which means, unfortunately, we got a couple minutes ahead of our next speaker. I apologize for that, but at least we're keeping things moving fast here. We don't want to have the event bogged down. I know I've been to far too many conferences where everyone talks over. So thank you to Paul for helping keep it concise and precise there. This is what we call vamping. I am going to chit-chat here for a couple of minutes until Michael comes on stage. This is editor of CoinDesk here, Ben Schiller.
Can I help you out?
We've got two CoinDesk, a former CoinDesk employee and a current CoinDesk employee here. How are you doing, Ben?
That's right, I'm good, good. One of the alumni here. So, What are you excited about? Are you having a good conference?
I got to be honest, I came here, well, I shouldn't say I came here. Before I came here, I didn't know a whole lot about BitTensor at all. Yeah. And as I was preparing for the conversation with Barry and with David and kind of getting to understand Jacob's work. Barry Silbert. I kind of fell in love a little bit with the subnet concept. Yeah. And it's really blowing my mind. I think that we have a really talented speaker here behind me. Michael, it's totally not Michael's fault. He was here right on time. We got started a little early. Thank you so much for joining the stage.
Good to be ahead of schedule.
Looking forward to hearing from you guys.
Thank you.
Not your fault. We were ahead of schedule, which is unusual for a conference.
No, it works out well.
Yeah. You're looking good.
Thank you.
Good. So you're Michael Healy, and you're the founder of Unit Network. So just tell us about your journey into founding Unit Network. I mean, you have a long history with crypto. You were telling me yesterday you were involved in the original WikiLeaks. And as I remember it, WikiLeaks they were trying to shut down WikiLeaks. And you started a Bitcoin campaign that raised money for that project. Just tell us a bit about that. You were only like 15 or something at the time.
Cool, most definitely. Yeah. Thank you so much to the organizers for this. I think it was an incredible event. So my name's Michael Healy. I'm half Singaporean, half British. As Ben mentioned, I've been in the crypto and blockchain space since 2010. I got into it working for WikiLeaks. I built the mobile Android app, and then the governments basically froze our bank accounts, Visa, MasterCard, PayPal donation channels, and we were kind of forced to use Bitcoin, right? So it was very early into building Web 2 applications, mobile apps, and then this new wave of crypto and blockchain. For me, the most exciting piece was the collaborative ownership aspect. The idea that, if you look at how businesses are valued and distributed at the moment, there's very few people who are owners in things. And I think the most exciting thing about Bitcoin is, myself in 2010, 9 cents a Bitcoin, had the opportunity to partake in this upside, right? I built a video conferencing app, grew it to a few million users, sold it in 2013. I also worked at the third biggest VC fund in Europe. We were seed investors in Spotify, 800 million euro fund. Worked for the Founders Forum. It's one of the most exclusive tech communities in the world. To be invited, you need to have started a $500 million company. And now I'm focused on building a blockchain, the Unit Network, which is trying to create an economy where everyone in the world is an investor and stakeholder in things, right? If you look at the way the world works at the moment, there's very few people who own assets or who are equity holders. And I think the really cool thing about the blockchain, it's going to democratize that. There's billions of people, there's hundreds of millions of companies, and there's very few people who actually own it. And I think, if you can make the idea of creating tokens super seamless, you see what Google did to search, if you see what Facebook did to social networks, I think that's really what the Unit Network is focused on. Yeah.
Interesting. So, if you go on Binance or Coinbase or something like that, there's a few hundred listings there. So your vision is really for a much more expansive list of assets. Maybe even millions of assets, tokenized companies, tokenized everything really, right?
So, spot on. So, you mentioned Binance. I was a crowd sale investor in BNB. I'm old friends with the chairman of OKX. I think these are super cool centralized exchanges which trade a few hundred trading pairs. Where Unit Network wants to be at is a decentralized evolution of this, right? We want hundreds of millions of companies around the world to have a coin. And then if you like a business, you just be able to take out your phone, buy a piece of it. Social media, when it came out in 2010, 2011 with, Instagram, Facebook, people didn't believe how social media would revolutionize the world, how social networks would play such a big role. I'm convinced that, tokenization, blockchain now is a $3 trillion industry. I think it's going to grow to a few hundred trillion, and I think it's maybe even go to quadrillion, and the unlock to that is getting normal people to create coins. I imagine a future, like you said, Ben, where there's hundreds of millions of businesses having coins, and every single person in the room here, Mike, me, Ben, Michael will have a coin. Like I saw you were building this Broadway show. This idea of financing the arts. 80% of restaurants fail. The idea that the community can own a piece of it, I think it's going to mean there's more transparency. It's going to mean that there's much more easier capital formation and fundraising. Yeah.
Yeah, invest in my play.
Spot on.
Okay, but how's this going to come about? We had the ICO boom in the 17, 18 period, and there were actually a lot of projects that came out of that, but most of it was just waste, and it was years of litigation afterwards, a lot of regulatory headaches with that.
Yep.
I mean, how do we have global access to equities of all companies in the kind of regulatory system that we have now?
Great question. So, a lot of people are super excited about RWA and tokenization. I think, a lot of people say unit network, is that tokenization, is that RWA? I think it's not, because a lot of, like RWA tokenization, people think about publicly traded stocks, they think about equities. We're really focused on the long tail. Your local, barbershop, your favorite restaurant, your friend who's a musician, the next, Lionel Messi. I think how we create that is we have really strong case studies of successful businesses that work with tokens, and people will be able to see that without a token, it's so much more difficult to get people to care about business, to market it, to get the network effects. Right? When Uber started, or Airbnb, to get the first drivers, to get the first hosts. We're currently launching 25 different apps. One is like an on-chain Shopify, an on-chain Uber, an on-chain Airbnb, an on-chain poker app, a chess app. Like all of these different apps, I think, will demonstrate what a future decentralized society looks like from the ownership perspective, from the operations perspective. I'm really excited for this future.
But what about the regulators? I mean, they're going to come after you.
It's a great question. So I was in Mar-a-Lago in Palm Beach 2 or 3 months ago. I had a dinner with David Sachs.
Donald Trump?
With David Sachs, the new crypto star who Donald Trump appointed. And he told me, Michael, I think what's going to happen is regulation probably won't change to accommodate this. What will happen is this new technology and something like unit network will supersede the old system, right? So if you look at newspapers, imagine, I ran a newspaper. He said, Michael, check out this thing called the internet. It's going to change the world. I'll be like, so do I take a picture of my newspaper and put pictures of my newspaper on the internet? Or I'll be like, I make money selling newspapers. I can't imagine a future where there won't be newspapers delivered. Or if you think messaging apps, I was one of the first early users of Telegram. People didn't see a future of messaging apps superseding telecom providers, right? And I think now we live in that new world. So I see the same happening with tokenization. I'm excited for Unit Network in the coming months to get into the top 10 or 15 crypto assets. And how it works, it's a layer 1 blockchain. It's built with the same framework as BitTensor. So
Substrate,
exactly. And I think it's one of the most powerful frameworks created by Gavin Wood, the creator of Ethereum and Polkadot afterwards. And it makes it super easy for anyone in the world to create a coin. It costs next to nothing. It's kind of like putting performing a Google search, right? And makes it really easy to raise money for whichever project. And then the next step is getting customers and employees to own a piece of it. Yeah.
Right.
So
walk us through how I can actually use it. So I go on the platform and I can create my own coin?
Yep, it takes a fraction of seconds. We've got things like solar power plants tokenized on Unit, restaurants, hotels, musicians, like a whole range of e-commerce websites. We have about 50,000 customers and clients, about 1,200 assets. We've been relatively low-key, I would say, for the past few years. But I think the coming months, we expect this crypto cycle to top, between October and December. So we're really focused on growth the coming months. We're excited to be partners with Proof of Talk, and we're going to announce some really cool partnerships ahead.
And it's completely decentralized.
Spot on. So to that point, most applications or decentralized apps have maybe the settlement on-chain, right? Every single piece of it is, if Unit Network is decentralized, the previous panel, there was a talk of account abstraction, right? We make it super easy, use an email, a password, and PIN that generates a private key. And that is what users, that's what we believe can onboard billions of users, right? If you look at the biggest blockchains at the moment, things like Bitcoin, Ethereum, Solana, BNB, this maybe works for all of us in the room, like people interested in crypto and blockchain, but I think if we want to get hundreds of millions of people around the world to care about tokenization and blockchain, that's how simple we need the process to be.
Okay. Why is decentralization important for you? Some people might say it would be easier to have a more centralized operation, right?
Society. So for me, what I'm most passionate about is the decentralization of ownership, right? And I've been fortunate to have built a few different companies and been quite ahead of the curve. So I built a video conferencing app, grew it to a few million users, and people didn't believe that business could be done on video calls, right? also built one of the first mobile dating apps, the competitor to Tinder, right? I launched it for fun, grew to 25,000 users the first weekend, grew to a few million users.
Wow.
And people didn't believe that people will meet people on the internet, right? It'd be like, if you're a weirdo, if you're a geek, if you can't make friends, you use some niche online website to date people, whatever. But now, 60% of people meet online and through the internet. So this idea of, is this crypto thing ever going to play a role in real businesses and the internet? I think no doubt it's going to happen. How long it's going to be? I think it's going to be 5 to 10 years. I think Unit Network is super early in this this progression. I've been fortunate to be an investor in many of the leading protocols or close friends with the founders. I'm excited. We've got bridges to Bitcoin, to Ethereum, to Solana, to TON, to BNB, and we want to be a leading player in many of these ecosystems. Yeah.
Great. So give us some idea of the roadmap for rolling this out then.
For sure. So these 25 apps that we're releasing are super exciting. They start off at a $15,000 market cap. We give the opportunity for 150 people to partake in owning, a decentralized Uber, a decentralized Airbnb, a decentralized Shopify. Each of these businesses we expect to be highly valuable and useful entities, decentralized apps. And we think, that's going to play a big role. We're also launching a number of city coins. So we're launching, a Paris coin, a London coin, a Dubai coin, a Hong Kong coin. And what this does, it basically encourages a geographic region to see the value of tokenization and basically get people into crypto. One thing that's pretty hot at the moment is the idea of public companies holding Bitcoin, right? MicroStrategy was a huge pioneer, and then there's, tens of other treasury companies for Solana or ones for Bitcoin. We basically allow every company in the world to use Bitcoin as a reserve asset, to use Ethereum as a reserve asset. So instead of going the traditional route of, hey, we're going to pay hundreds of thousands of dollars for a listing on NASDAQ, or we're going to, work with investment bankers and, really complex. Your local bakery or, your local supermarket is going to be able to hold Bitcoin as a reserve asset. And I think that's what's really going to get Bitcoin from, $100,000 where it is now to cross over to $1 million, to $10 million, to be the reserve asset that every single business in the world and every single person can hold a piece of. Yeah.
Great. I was actually talking to your colleagues that were sitting right here in the audience last night at dinner.
Nice.
And they were talking about this embassy kind of network you're building.
Most
Can you
definitely.
explain about that? Why is that important?
Absolutely. So we have offices and apartments in a few major cities, in Dubai, in London, in Hong Kong, in soon Abu Dhabi and San Francisco, basically where our community is super active. And we offer the opportunity for our team, our communities, people in our network to use these facilities. And the real idea is, like this decentralized Airbnb we're building is have this be a network and community and sort of a nation state that people can be part of, and it isn't bound by, countries or passports or borders, but really provide, the blueprint for this evolution of society. Balaji with the network state kind of talks about this idea of, we're going to move to this network state world. I feel as if the Unit Network is, from what we've come across, the best tool for us to get to that future.
Interesting. So if I want to tokenize my company, I can go to one of your embassies in Dubai, say, and work there to do that.
Most definitely. And we also have a venture fund, Unit Ventures, and we're actively investing and supporting in things that support this thesis. Just in the past week, we invested in a plane, a small commercial Cessna plane. It needed $80,000 to be purchased. This is too small for most RWA tokenization or even traditional finance funds, and it rents out for $4,000 a month or $5,000 a month. So, also invested in an energy drink, like a healthy Red Bull. Like, we're doing all kinds of stuff. Like, if you think every single business in the world, we believe it will go on Unit Network and it will be the NASDAQ or the stock exchange for the world.
Wow. Yeah. And how do you hope to make money from this?
Definitely. So, as an exchange, the Unit Network takes a 0.5% fee off every trade, right? So, let's say you buy $100 on Michael, 50 cents of that goes to the Unit coin. And we expect to do $100 million in daily trading in the coming 3 or 4 months. That will do $500,000 in effective profit or earnings, and that is $182 million a year. And we think that the coins will be valued and tradable at a multiple of how much profit they make. So the issue with crypto at the moment is if a coin goes up or it crashes or it goes up 20% or 30%, people don't know, is it underpriced, is it overpriced? And we're really excited about coins having coins being valued by how much revenue and profit it makes. Because if you look at the internet, people said, we don't need revenue, we don't need profit, we just need eyeballs, right? That was the dot-com bubble.
Yeah.
And then if you fast forward to the mobile revolution in the in 2010, people said you just need downloads, right? So Instagram, when it was bought for $1 billion, everyone was like, why? Like, how does this work? You know, it's $1 billion. Isn't that crazy? Why is Facebook paying $1 billion for an app? Now it's worth hundreds of billions, right? Because it generates lots of revenue and profit. So our thesis is that, you know, there's tens of thousands of coins at the moment. We think the next evolution is where coins are backed up by earnings and revenue and cash flow. And you could say, Michael, what about the regulatory side of things? So we're convinced, similar to Airbnb or Uber, that all of these regulatory, you know, frameworks and governments will see the value and the transparency behind tokens, the alignment of incentives. When robots and machines start replacing a lot of work, we believe everyone's going to move towards being micro-investors. And what this is going to do, we think, is it's going to extend the weekend from maybe 2 days to 3 or 4 days to 5 days.
Sounds good.
And everyone will be stakeholders in this value creation. I mean, one partnership that we'll announce soon is with Andrew Yang, the creator of the Freedom Party. You know, he was a pioneer in universal basic income. And what he says about Unit Network is that this can supersede the idea of everyone getting a wage or a stipend. You know, they can be owners and stakeholders in things. So, you know, we've got countless, you know, allies, partners. You know, personally now, our creative works is Oliver Tree. You know, he's got 25 million fans. He's created a bunch of viral content and getting some of the top people in Hollywood to create tokens around their name. So I'm really excited for showing how, you know, people thought when MySpace was bought for $600 million, that was crazy, right? Now Facebook is worth hundreds of billions and even trillions, right? 1,000 times that is. So people think crypto at the moment at 3 trillion is big. I'm excited for when it really solves problems for real businesses, you know, raising capital, distributing value, aligning of incentives. I think it's going to grow to hundreds of trillions. Yeah.
Great. Well, I think that's a good place to wrap up. Thank you very much, Michael.
Most definitely. And I think the best way to get in touch is my username on Telegram is @Michael. You won't be able to search for me because I told Pavel and the team not to make me searchable. But if you go into save messages, if you put @Michael, you can drop me a message there. We're actively looking for business cases to invest in and tokenize. So if you run a business in any particular industry and you're curious about tokenizing, you know, check out the Unit Network, unit.network. You can put Michael as an inviter or someone from our team. We've got Joe and Myra, Paul and Sandra here from our team, and a few others here in the crowd. Yeah, and thank you so much, Ben, for this opportunity.
Very inspiring. Thank you.
Thank you.
Go on.
Cheers.
All right, thank you so much for that. It's good to kind of be reminded of some of the bigger picture visions that are still out there for the space. I think everything kind of kicked off with a lot of really imaginative, sometimes occasionally hard to believe, and other times actually hard to believe prospects. But the stuff that's still stuck around, it continues to be fascinating, and it's cool to get a little reminder that that's there. We are at a little bit of a pause in the agenda right now where we're about ready to recognize some up-and-coming talent. We've had everybody from Goldman Sachs to BlackRock on stage today, and we're about ready to have some young entrepreneurs up on stage today that are about ready to be celebrated for some hard work that they did in what we call the proof of pitch. I'm going to go ahead and go down the line here, and I'd like to ask our pitch winners, as I name them out, that they come forward. The winners of the 2025 pitch competition, selected from an incredible lineup of visionary founders across 4 innovation tracks, are from the Deepin track winner, we have Harney NodeOps. NodeOps is the leading AI-powered permissionless DPIN network, making it easy for builders and users to focus on what matters most. Ow! Welcome to the stage. Thank you so much. And up next, we have in our DeFi and tokenization track winner, Wojciech Pawlowski, Accountable. Accountable turns financial data into verifiable yield, replacing trust and cryptographic proof. Welcome to the stage. Congratulations. Congratulations. DAI track winner, Sofiane Delou, New OS. NewCoin is a decentralized AI protocol where humans and agents earn by contributing valuable insights to a peer-to-peer learning network. Sofiane, you want to join us on the stage here? All right. Well, I'd like to congratulate each of these participants. They've demonstrated exceptional potential to shape the future of Web3 and decentralized AI. Would love to open it up to our two award winners on stage. Would you like to just take a minute and tell us a little bit about what you did and how you'd like to see it applied in the future? And introduce yourself first and last name.
Hi, I'm Harry. I'm Docs lead at NodeOps. So NodeOps started out with a Node as a Service console. For all those builders out there, I want to reassure you that you really can respond to demand with product fit to drive revenue. And NodeOps was doing that since day one. So it's really been an inspirational team to work with. And of course, this is all of their hard work. I just document what they do and go out and wave pom-poms. So I'm just sitting here representing an extremely hardworking DevOps team and front-end team who make using Web3 really simplified for the end user. They're all about the UX. And so I presented yesterday that we had done our first funding round in 2024. So we're essentially a year old, proudly backed by L1D, Finality, and some prominent angels. And if anyone's interested in coming to talk to me, we are opening up a strategic round because we're making a really bold move, which is we're taking on the cloud compute marketplace as a DePIN. So it's a really exciting area to be in. There's a lot of customer friction in the cloud compute space.
Introduce yourself, please. Tell us a little bit about what you're up to.
But should I also tell what we do?
Yes, please do. Please do.
Hey guys, nice to meet you all. I'm Wojciech Pawlowski, the co-founder of Accountable. Actually have here representation from my team. There are some free chairs, but unfortunately. So, a bit of surprise to be here. There were many good pitches during our track, so appreciate being selected. What we do at Accountable, we are basically trying to prevent 2022 of happening again. We are done with the fraud that attacked this market from many different angles. And we are making sure that what people are doing off-chain actually is the reality, and we are bridging that information to our on-chain world and making sure that digital finance space can be safe and available for anyone. So that's a very short and simplified explanation. Thank you.
Some audacious big plays there. I love it. If you would please give them one more round of applause. Congratulations for all your hard work. Thank you. We'd also like to extend a sincere gratitude to our main sponsors, Certic and Cointelegraph. Your support has been instrumental in bringing this competition to life. We're also grateful for the upcoming media coverage that will amplify the voices of these bold founders. Again, as we walk off the stage, thank you both so much for everything.
Thank you.
Hello again, it's me. So it turns out the proof of pitch was still actually happening when we awarded the first couple of listers. So we have one more finalist that has not yet been announced. The third one that I already announced is going to be joining us imminently. I do apologize for that. I'll be right back, and we're going to go ahead and go through this. There's a conclusion to our recognition for these awesome competitors. Thank you so much for your patience. Okay. Exciting. I am so excited to be welcoming to the stage here Paul Krugel from Cointelegraph. Paul, we just had an amazing proof of pitch competition right on the other side here of the Louvre Palace. We're excited to announce the winners of the 2025 proof of pitch. Tell us a little bit about what the pitch was and how it all came together here.
Yeah, we had a pretty tough competition up there. We had a few tracks. Deepin was one of them. And we couldn't be more excited to share with you all who the winners are. Hey there.
And we'll go ahead and announce them right now. So for the Deepin track winner, Hari from Node Ops. Hari, please come to the stage. Node Ops is a leading AI-powered permissionless Deepin orchestrator, making it easy for builders and users to focus on what matters most. Congratulations, Hari. The winner of the DeFi and tokenization track competition, Wojciech Pawlowski, Accountable. Accountable turns financial data into verifiable yield, replacing trust with cryptographic proof. The DAI track winner is Sofiane Delou, New OS. NewCoin is a decentralized AI protocol where humans and agents earn by contributing valuable insights to a peer-to-peer learning network. Each of these projects has demonstrated exceptional potential to shape the future of Web3 and decentralized AI technologies. Paul, you want to give a couple words?
Sorry, guys. What you have been doing was just really amazing, and I think you got the business model right, so we couldn't be more excited for that. So let's keep it going.
Special thanks we extend with gratitude to our main sponsors, Certec. I believe that we've got some little pieces of cardboard coming up here that might have some symbolic value. In addition to that,
I think you guys should bring the check now.
All right.
There we go.
They are creating suspense here. We do have a $50,000 grant for the winners here. And Paul, you want to go ahead and tell a little bit about what's going to happen with these funds?
There's the next. Yep. The next two. Yep. Next two projects. Tensor track. AI track kind of.
Yeah.
Okay. But anyway, congratulations first of all, and we're gonna split up the media grant between all of you. And yeah, we couldn't be more excited. And well done, guys. So thanks a lot. Let's celebrate now. All right.
Thank you. Okay. Thank you. Thank you very much, everybody. Thank you to the competitors.
Good evening. Thank you all so much. We are excited to announce the 2025 Proof of Pitch winners. Please help me welcome Ferdinand from X Ventures to the stage, who's going to go down the complete list from all of the tracks. Ferdinand, please join me on stage. Ow!
Thanks, Michael. Do you hear me well? Yeah? Okay, cool. Thank you very much for being at Proof of Talk. So we're going to announce the Proof of Pitch winners. So basically we had 4 winners, 4 tracks. First one was Deep In track, second one DeFi and tokenization, the third one is DAI, and the last one BitTensor, which was a bit long, sorry for that, and just finished. So I'm going to call the 4 winners one by one. So first of all, please welcome NodeOps team with Harry. Don't know if she's there. Ow! NodeOps team, please. Oh, come again with the bottle of champagne, please. We have more than one bottle for you. Do you want to say a word, Harry?
Am I allowed to this time? I don't know who was here before, but NodeOps is an inspiration to all you builders because they have been revenue positive since day one, proving that Web3 really can find demand with product fit to drive revenue. So anybody who's there in the trenches, it is possible. Please keep working at it because it is going to happen.
Thank you, Harry. Can you stay right there? Yeah, perfect. Or maybe with Michael. Can you go with Michael, please? Next to him. Lovely guy. So now for the DeFi and tokenization track, we will welcome the second winner, which is Accountable Team with Wojtek, and already has a bottle of champagne as well.
Okay, so it's the third time, I think, but it's hard to make the same speech for the third time, but let's try. So, at Accountable, we are trying to replace what was wrong about 2021 and 2022 and make sure that with the counterparties that we are dealing every day in the crypto space, we can actually trust them. So, we are bridging the information from the off-chain world and giving it to every single participant in the DeFi space. We are offering financial products that people can trust, and that's something that has been missing for the last couple of years, so we hope we can change it for everybody involved. Thank you.
Thanks, Wojtek. So the third track was the DAI track, Decentralized AI. So we had like really tough decisions to make because really good projects. And the winner is New OS with Sofiane Delou.
Hi everyone, very briefly, first thank you so much for staying with us until now. And New OS, we are building a decentralized version of tech giants who build AI. The main difference is each time you use New OS, you are not talking to one specific model that's built by a centralized company. You speak to a network of agents that coordinate and try to work together to optimize towards the best possible response. Each agent has its own identity, its own blockchain wallet. All the data is cryptographically signed, like on Farcaster. And as this network grows, all the agents can exchange their experience and learn from each other, and you get paid for that. So each time you do a prompt, each time you interact, all those precious hours you spend, you are not the one teaching them for free. You are actually being compensated for that, and that's New OS. Thank you.
Thank you, Sofiane. And the last track was the BitTensor subnet tracks. So, as you know, this one was really exciting with the big concentration of BitTensor people here. So I'm going to call and please welcome the winner of this track, which is Synth, with James and his co-founder. Where are they? Oh, guys, please turn.
Hey everyone, so we're James and Sam, founders of Synth, and we presented Synth Robotics, which is a new platform for training foundational robotics models using synthetic data in simulated environments. Thank you.
Perfect. Then, guys, thank you very much for your participation. Thanks to the public also who made that really, really cool and interesting. So now we think we can take a great pictures with all the winners and also bring a small check or a big one. I don't know if there's a new one, but yeah, I think we can finish with the picture. Oh yes, there's the check. We do one for all of them, no? Yeah, definitely. Yes. Come on, guys.
Thank you again to everybody for being with us here for the reveal. And congratulations to the winners for the fierce competition, and I hope you enjoy your prize. We'll see you all soon. All right, thank you to everybody who stayed along for that roller coaster of a ride there. I'm a little bit sad that we are coming to the end of our 2 days, but we do expect to finish with a bang here. Our final panel before we get on to some drinks, which I hope everybody sticks around for, is called Layer 1 Evolution, Defining the Next Phase of Blockchain Infrastructure. Please help me welcome to the stage Benjamin Minku, founder of Multiverse X, Arthur Brightman, co-founder of Tezos, Eric Piscini, CEO of Hedera Hashgraph, Kostas Chalkas, co-founder and chief cryptographer of Miston Labs, and moderator Shiraz Ahmed, managing partner of Storm Partners. Welcome to the stage, gentlemen. Welcome to the stage.
All right, fantastic. Well, it's great to see you all here. I guess you're probably waiting for the cocktails to come, but at least you have a great conversation before we go into the after party. Actually, quite, yeah, I'm really looking forward to this one. I mean, I'm very surprised that none of our speakers here have any black eyes. It was quite an intense conversation backstage. Very much looking forward to presenting that to you all today. Maybe to give you a little bit of context, I'm going to be your moderator today. My name is Shiraz Ahmed, managing partner of Storm Partners. It's a great pleasure to be with you from Switzerland, and we're going to be discussing a little bit about the Layer 1 and their evolutions. I mean, Layer 1s now have millions of users, $1 billion in valuation. It's no longer just a project. It's something that is definitely real and tangible, as you can see from the men up here in front of you today. I'm going to give them a quick 30 seconds to just introduce themselves, and maybe you can give a quick USP of the blockchain you're representing today. Kostas, if you want to start.
Of course, I can start first. Thank you so much. So I'm Kostas. I'm in the blockchain space since 2009, pretty much working with the team of Satoshi at the very beginning. I was an auditor for Ethereum many years. I broke many smart contracts. Eventually, I was hired by Mark Zuckerberg for the Libra project on Facebook. And then now I'm on the Miston Labs, who is pretty much the creator of the Sui blockchain and Walrus for storage. Myself, I'm still a coder, pretty much a co-founder, but I'm writing code almost every day and designs. And on the cryptography side, I'm doing zero knowledge proofs.
Good afternoon. Are you ready for drinks? I know you are ready for drinks. My name is Eric Piscini. I was born here, but I live in the US. I've been in blockchain for about 12 years, and I'm currently the CEO of Hashgraph, which is the team behind the Hedera network.
Hi everyone, my name is Arthur Brightman. I was also born here. I'm a co-founder of Tezos, which is a blockchain network. Exciting stuff. So, hello Paris, really great to be here. Always excited to meet the people in Paris. Great to see so many people actually coming. Benjamin Minku, co-founder of Multiverse X Labs. We've built an internet-scale blockchain. It's live, and now you can also vibe code on it. Just build something cool. Thank you. Thank you.
Wonderful. Maybe can we get a raise of hands just to show the builders? Are there any builders on the Multiverse X protocol over here? All right.
Woo!
Tezos. What? Hedera. There you go. And Sui. All right. Okay. Still some great builders in the room. Okay. So before we begin, I mean, I think it's important to note that from the USPs that I've kind of noted, that Multiverse X talks speed, Tezos talks governance, Hedera talks enterprise, and Sui programmability. So there's going to be some interesting questions, I think, around those topics to be able to understand from each one what are their USPs. And I think, Benjamin, if we start with yourself around the whole performance and finality of things, I wanted to get your understanding of, is speed still a bottleneck in 2025? I know that you just released Andromeda, so just get an understanding from your side as you talk often about speed. Is it still a bottleneck? Is it something we should still be talking about TPS or not?
So the most important point that I think we should always look at is technology ideally should feel almost sci-fi. That is, when you use the technology, you should not care what you use under the hood. You should just have this type of experience that feels as close to being magical. We've released Andromeda, and we have the Supernova release that's coming, with sub-second finality in addition to the massive scalability that the network has, that the fact that Andromeda is live and we have the one-shot finality is just something extremely tangible and useful for users and for builders alike. But the supernova part will literally make it feel a bit sci-fi. Like you tap on a transaction, the sub-second finality is already like beyond the perception point where you need to think, wait, you just experience the technology. So I feel that's the extraordinary part that you don't have to care about it. And in addition to that, we have this cool, sexy app that we've just released last week, which is VibeOX. This just takes the barrier so low that average users from wherever they may be in the world can use AI to vibe code on Multiverse X. And I feel, again, for the builder, you want a magical experience. You should almost feel about building as you feel about playing an instrument. Taking the instrument, playing a bit, see what comes out of it. And we've seen a tremendously exciting response for people that have typically not been hardcore developers. And I think that's what's really exciting. Not the TPS, not the speed, that's great, just insofar as you don't need to think about it anymore because it just works. But when you have that experience that in any way comes to the point where it feels magical, I think that's when you found something.
Yeah, Vanessa, and I want to talk a little bit about vibe coding a little bit later, right? And understand, okay, is it just for that kind of whole demo side of things, or is there something more to it that can be created? But I love the magic feeling that you're describing. One of the reasons why I think a lot of us got involved in this space to begin with. But maybe, Kostas, if I go to yourself now, just on the same kind of line of thought that Benjamin had, right? Where SUI was designed for performance and object-oriented programming. I mean, how do you ensure speed whilst not compromising on security and or decentralization?
Yeah, for us it was quite different because the company that created SUI was coming from Facebook, right? And we knew how to serve billions of users, you know how to run infrastructure. And obviously we understood that if someone can create an account in more than 5 seconds, it's game over. They will never enter the blockchain space, especially for the fast population and like TikTok and Instagram and all of this stuff. So we tried to change the narrative completely from Ethereum and from Solana and all of the rest. And we said, look, people are familiar in traditional languages like Java, JavaScript, C++ with objects, which means that on Ethereum now, for example, you have an account, you go to your balance, you see $1 million, but in SUI, you see objects. You have nodes in different pockets. So by having this, when I want to pay you some money and I want to pay Benjamin some money, I can just put my hands in 2 different pockets and pay you concurrently. And that's how you can achieve speed. And this is why you didn't change anything in the narrative, so you didn't spend any threat models on the security of your system, and that's how you can maintain it by having parallelization. This is what we did. We created everything as an object. This is by far closer to the Bitcoin than any other network, because Bitcoin is also objects. Then Ethereum came, they tried to put everything in a balance. At the same time, they're also sacrificing some speed. There are congestion points. You cannot put your hands in one pocket, all of your hands, and have the speed that you're expecting. And that's why we did it. We had to find tricks like algorithms that you can have the same speed that Web 2 has now with probably better security and transparency. And all of this came like from knowledge from Silicon Valley that we expressed into Web 3.
Yeah, thank you. I love that metaphor that you kind of mentioned of you can't have your hand in multiple pockets at once. And so if we move on now, and I see, Arthur, you're eager to kind of get involved here. If we talk a little bit more and shift to governance and upgradability, right? I mean, a lot of people say that launching a protocol at the end of the day is kind of like running a marathon whilst tying your shoelace. It's not easy, but Tezos has proven that you've been upgrading on change since the very beginning. So maybe give us a little bit your perspective on what's the biggest lesson you've learned about a self-amending governance and that others potentially could take note of.
Yeah, so at the impetus of Tezos, at the very origin, there is this idea, and it sounds obvious now. You know, you see, of course, a blockchain is going to evolve. Of course, it's going to be innovation. But in 2013, 2014, that was not obvious. People would launch a blockchain with one feature. and everyone's going to say, we're going to have the blockchain that does X, we're going to have the blockchain that does Y. And of course that doesn't work, because if you're going to have to launch a new blockchain for every single innovation, you're going to kill every network effect. And at the time, there were two schools of thoughts. One school of thought that was, well, these are decentralized systems, and if we want them to stay decentralized, they have to be immutable. We can't change the rules. And then there were other people who say, we can just hard fork. We'll have rough governance, and then we'll do the hard fork. And the analysis that was made in the original position paper of Tezos is that if you go by hard fork, your governance is going to be implicit, but is going to be captured by whoever controls the default. Whoever controls the default controls your blockchain. If you upgrade Ethereum by hard fork today, you are controlled by Circle. So Circle went to IPO. Imagine Circle was bought by Ripple, right? Ripple was trying to buy Circle. If tomorrow there's a hard fork of Ethereum and Circle says, you know what, we're only going to honor USDC on this branch and not that other branch, they get to decide which is the winning branch. So you've abdicated control of your chain to one centralized actor. That's a problem. And the solution proposed by Tezos is to say, let's formalize governance. Governance sucks. It's bad that we need to have governance, but pretending that you can upgrade by hard fork and that somehow it sidesteps governance is wrong. You're just shoving governance in this place where you don't see it. So on Tezos, the governance is very explicit. It happens on chain, it happens by vote, it's completely decentralized, and it's happened regularly since 2018 when the chain launched, from the first upgrade, Athens, to now the latest upgrade, Rio. We went through every letters of the alphabet. It has a rapid upgrade cadence. Now, that being said, the goal is not just decentralization. Because of this focus on upgrading, it's also a chain that is easy to upgrade. And so it's always been able to stay at the forefront of innovation. Now, two of the early technological pillars of Tezos were proof of stake. Tezos is the first network to launch with actual slashable proof of stake, so where something was actually at stake. We're the first to actually do it. I remember building Tezos and people saying, proof of stake is impossible, otherwise Ethereum would have already done it, or proof of stake is going to come in 3 months in Ethereum, so it's not worth it. Well, we actually did it. The other one was smart contract language security. It's something, we introduced, for example, linear types in virtual machine, which is something that was also adopted by, Aptos and Sweden, the more virtual machine. That being said, I will say that the market has demonstrated that it cares a lot more about developer experience today than it cares about security. I would still advise a bit of caution here. Vibe, I love vibe coding as much as anyone. It's really fun to build like a lot of quick weekend projects. But if you're going to deal with people's money, their systems are very, very good at doing things 90% of the way. But like those 10% could hide money-losing bugs. And if you don't control the code base, you're not going to see them. So I'm really waiting until large language models are going to be able to automatically produce verifiable code. Once they produce verifiable code, it's going to be fantastic for smart contract development. And that's why a lot of development efforts on Tezos have been focused on being able to directly use languages for which there are large corpuses, meaning JavaScript, C, all these languages, because they're going to be the ones where there's the most fluency in those models. So anyways, yes, Tezos has governance, but that governance was a seed that really allowed the network to stay on top and innovate in developer experience, scaling, and a lot of other areas.
Yeah, no, greatly appreciate it. And I mean, Eric, I definitely want to hear from yourself in a bit, but as I was told in the backstage that without provocation, there is no conversation. And I feel like, Benjamin, maybe there's a bit of provocation there. I'll give you 10, 20 seconds to just respond to Arthur's comments if you'd like.
No, I would just ask him if he had any bug on the mainnet up until this point since they launched. Did you discover or have any bug on the mainnet?
Of course there are bots on mainnet, yeah.
Critical?
Oh, bugs or bots?
Bugs.
Bugs, yes. There's been some bugs on the mainnet. I think we had like one big critical one that needed a hard fork. And then smaller ones, yeah.
Wow. Interesting. When did you discover that? What was the situation? How did you discover the bug? Was it exploited?
No, it was not exploited. It was a security researcher doing a disclosure.
Interesting.
and the hard fork required consensus from everyone, coordination and so on?
Yeah, absolutely. I have a post called "There Will Be Hard Forks," explaining that there's a huge difference if you have a social norm around hard forking for critical bugs as opposed to hard fork for feature changes. Once you hard fork for feature changes, it's a very slippery slope because this could affect the issuance, this could affect the functionality, this could affect many users. If you have, I would say, a clear specification of how the system is supposed to behave and you correct for that, then I think you have a very, very pragmatic reason to hard fork. It's a very different path, I would say, to governance. And I don't think, for example, to take the example of Circle again, if tomorrow there's a critical bug on Ethereum and Ethereum hard forks, Circle will not be in a position of saying, no, we want to stick with a branch that has a critical bug. So
No,
the
that
problem
makes,
doesn't really exist for those.
I think that makes a lot of sense. Yeah. No, thank you for that. Eric, so to your point, and I mean, governance is it's a very tricky, very big word because governance can mean a lot of things. And I mean, for yourself, of course, within Hashgraph, let's talk about the blockchain hit area here for a second, right? I mean, you're one of the only, or one of the most prominent blockchains that's working with real-world enterprises and like the larger ones. I mean, maybe can you give us some perspective here about the governance of that and how you balance a decentralized protocol's vision with boardroom accountability?
Yeah, and I think, so first what I wanted to say is the performance of a blockchain today does not matter as much as what it used to be, right? Everybody is getting good TPS, good finality, good, right? So I don't think we're going to differentiate ourselves on the core of the technology anymore because everybody is kind of at that level. Governance is going to be a big differentiator. And from the beginning, 2018, Hedera said, we're going to build a governing council who's going to be the one deciding on how to run the network, how to upgrade the code, how to decide on any changes to the code. And we will run the nodes. So we are a permissioned public blockchain. And that's a big decision we made early on because we knew that in order to go talk to large enterprise, we needed that level of certainty from a governance point of view, right? It was very tricky for us to say the governance is going to be done by people you don't know, right? That's really hard to explain when you go to market. So we said, okay, now we have Google and IBM and Dell and many others running the network for us. And that's a credibility play that's really big for Hedera today.
Appreciate it. I'm going to come back to some of those case studies, but before I do, I want to go nuclear a little bit for a second here and pass the word again to Arthur. I mean, you've been tokenizing uranium, and maybe it's not the same uranium that makes nuclear bombs, but let's say a similar one. I mean, tell us more about that use case, because we know a lot of blockchains are tokenizing gold or some, let's say, easier ones. How did this idea come about? What is the impact of doing that, and your thoughts around kind of RWA's tokenization?
I mean, the first thing I would say is, like, if you want to buy gold, you have so many options, right? You could buy gold ETFs, you could buy gold coins. There are different fintechs that will sell you gold. You can buy futures. And yes, there's different products doing tokenized gold. I'm not against tokenized gold. It's great. But it's a market that's getting quite saturated. Now, what's a super important commodity? Uranium. Everyone's building new nuclear power plants at the moment. The projected demand for energy from AI data center is going through the roof. And people are not starting uranium mines fast enough. So uranium is a hugely important commodity, and compared to gold, it's completely neglected. Like, there's just no vehicles for doing it. There's a closed-end fund that trend in Canada and in the UK. They don't really track the NAV because they're closed. So there's just like no good access for something that should be super, super important. It's uranium oxide, by the way, U3O8. So it's before it's refined, also known as yellow cake. It's something you find in the ground. You don't want to eat it, but it's not as sensitive as refined uranium. So yeah, it's been super exciting because it's a product of the future. I also think that cryptocurrencies, in some form, you can think of them as technologically flavored commodities, and uranium is also a technologically flavored commodity. So if one appeals to you, maybe the other does as well. I'm super excited by it. It's like, can you get exposure to technology via a commodity? Yeah. And that's what uranium does.
No, I appreciate it. And maybe, Eric, back to you. I mean, you've been very vocal that tokenization is really delivering real value, not just hype. Could you walk us through some use cases with some of the enterprises that you've been working on?
Yeah, I'm sure you heard about tokenization 20 times today, just from different panels. But tokenization of real estate, right? We've done that with many different companies. Tokenization of any kind of financial instruments. We were talking about tokenizing identity as well, but not in the context of tokenizing your identity, but in the context of tokenizing the identity of an AI agent, for example. That's an interesting topic. I haven't heard too much about this. So you can tokenize an AI agent, and then you can rent that AI agent depending on what you want to achieve, and you can benefit from renting that agent because you own a token of that agent, right? You can tokenize a lot of things, which is very interesting. Real estate is the one that's very tangible for people because you can be outside of the US and you can buy $200 worth of a project in the US if you want to. You can do that and you can sell it 2 days later, which is today impossible in real.
I appreciate it. And then if we stay a little bit on, because here the topic of real world adoption, I know that you've been working with the Athens Stock Exchange, if I'm not mistaken, and be going that extra mile, zero knowledge proof on the order book, if I'm not mistaken. I mean, that sounds rather techy, rather advanced as well. I mean, can you talk us through that use case, if that sounds relevant?
Of course. So one of the problems now that many European countries are facing is Revolut. Revolut is killing the small countries. Now, for example, Greece. Imagine a small country with all of the debt and everything. You can buy with all of the applications with a single click, Apple, Google, Microsoft, all of the stocks, all of the shares you can imagine in the world. Who is going to buy a Greek stock? There is no way. The new generation will never do it anymore. So they had to find a new solution, right? And the only solution at the moment with audience is people with a wallet in crypto. Because generally they are spenders. These people are doing trading already, so it's very, very strong on DeFi. We know that. And then eventually they had to decide, look, either we stay traditional, only KYC people in Greece can buy stocks, or we go into a blockchain mode. We're tokenizing the KYC, of course, of the identities of the users, but at the same time, someone with their wallet can buy a Greek stock in a single click. And this changes the narrative and gives them some extra life for the next 10, 15 years, because otherwise they will die off because of Revolut. This is the whole idea. And then we decided even with the Greek government for some other things, like they're trying to tokenize agriculture itself. And now we have a new museum and some vineyards that they're saying, look, if you want to have high quality and then you go against Italians or against French, you need to have some transparency from the crop, from the grape, into your wine that you're drinking. And then we said, okay, now the most difficult part in my life, do you know what it is? Convincing people at the government that blockchain is not just trading Bitcoin. They don't understand it. And some people even feel that mining is people have to dig, like to find Bitcoin on the ground, right? And then you have to go with real applications and explain, look, blockchain is a global database for transparency, and it's also giving you access to many people who are gamers, who are traders, to do your stuff as a country now in a digital world for the new generation. And that's why the Greek stock market decided, look, we have to take a bet. We cannot stay with the paperwork of institutional investors and so on. Tokenize the stocks into a blockchain. Let's go with SUI.
Hey, sorry, did you say tokenize a country?
Tokenizing the stock exchange of a country.
Oh, okay. I thought you said the country itself. I'm like, no.
I think that's for next year's panel. Maybe if we jump now onto our next kind of segment, which is UX, developers, ecosystem growth. And here, Benjamin, for yourself, I mean, the new X portal, at least in my opinion, the update really emphasizes on the mix of UX and security. I mean, how important is user experience and this kind of type of design in onboarding the next billion users?
So I think the entire discussion for many years has been, in some sense, misguided. What do I mean by that? I think solving for security at first is crucial and it's foundational. If you don't have security, of course you don't have anything. But in some sense, solving the security problem for a network is much simpler than solving the UX problem. Because UX requires a completely different mindset when you have early adopters, when you have early majority, and when you want to penetrate the mass market. So whether you talk about users and the expectations and understanding that users have generally, approaching the first million users, the first 10 million, the first 100 million is very different from approaching the first 1 billion users. And then this similarly applies to builders. I believe that for too much time, we've been only focused on the giga brains, like exceptional people that are brilliant, can understand rocket science and hardcore math. And those are the special chosen ones only that will build on blockchains. But this has needlessly restricted the entire conversation related to builders to only a few people. And I believe there's a kind of revolution in terms of user experience and barriers that have been knocked down with the last application that we've shared, where through AI, we're simplifying the experience and saying, you know, writing code is not the hardest thing anymore. You can actually write code with AI, start a conversation, build an application, and do it today. And we've seen that people have a crazier reaction and excitement to this than almost anything else. Because up until this point, the way they could interact maybe with blockchains was only trading, investing, and so on, and that's cool, that's important.
Yeah.
But then when you put this tool in the hands of people, it changes their perspectives, and you tap into a completely different market segment, where you go from millions to maybe tens of millions of users that become builders today through an application like ViboX.
Yeah, I understand, and I think it's easier to judge than it is to create. And if you have more people trying to create that, they start understanding, okay, well, this is usable, and then that subjectivity layer maybe kind of reduces. Maybe, Kostas, to yourself here, I mean, you've spoken about developer-first design, and have a bit of a tricky one for you. I mean, is better tooling more important than more liquidity at this stage of Web3?
I think they're equally important. For us, especially for the creators of Sui coming from Facebook, we realized that, the people who know Java, C++, and JavaScript are in the hundreds of millions probably across the world. The people who are doing Solidity, Move, or all of the other languages here are just a few thousand. There were many, like at the very beginning, there was like the misconception that we have to take like developers from Ethereum and get them into the Sui Move, and like vice versa. Like it was a debate. But it was a big mistake, right? Everybody was doing the big mistake that, I'm going to get the few thousand users like developers from the other chain that are coming to us. No. You need the Java developers and the JavaScript developers as well. That's why you have to design systems that are familiar with someone who is working for a bank, which at the same time, this person is also a user of the blockchain. And then there was an indistinguishability element where you say, the developers themselves are the first advocates for the community because they're like in a scale-free network. They are the clusters where they're convincing their government, their CEOs, or all of the people who have influence in the country to use blockchain technology. And this is where you start. So eventually they're connected. They are not like two different groups necessarily. What we did is we helped the developers to, of course, the AI tooling is playing a huge role now. The learning curve between Solidity users 2017 and 18 and now, it's completely different. Someone can learn typing on any new language in 2 days. In 2 days, you can write a smart contract, and there are tools now to check if your smart contract is secure. Again, it's AI. I don't believe this problem exists anymore. You just need to make it easier for people to use it. At the same time, users, we have to forget the passwords. I know personally, because I was in the cryptography team and security team of Facebook, the average Instagram user will never remember a 12-word password. There is no way this will happen. So we have to figure out some other things like Face ID or login with Google and Facebook, like we have ZK login on Sui, that onboarding is becoming seamless. And imagine that Sui is also a platform that many gamers are coming, AAA games. These people cannot change their behavior. They just want to very quickly. People are like getting bored nowadays,
and
right?
Just get there.
Yes, single click. You have an account on chain. You can now do trading. You can now play your game. You can now do whatever you want.
And
nothing else.
Yeah, no, I understand. And as we're approaching the end of our panel here, I mean, I have a question for anyone that would like to take it. So, are we still building for, let's consider the crypto natives in the audience, or should we start building for the BlackRocks, the Reddits, the governments of the world? And some of them, of course, in the audience, and I'm very happy to say that we are seeing more of a mix, but it does still feel like there's two segments of demographic, more crypto native or more traditional native.
Well, we can't, that's a choice that we cannot make, right? You cannot decide to stop building for the people who have been supporting you for the last 10 years and say, forget about that, I'm moving on. But I think, you know, if you want a little bit of provocation, I would say one of the mistakes we made in the industry is we should not have built wallets to begin with. Because the wallet is actually now the entry into the world of crypto, and it's, I would argue, none of them are really good, right? And it's not actually the right way to engage. We should not ask people to engage with the wallet to engage with the blockchain. We should ask people to your point, dream about something, experience something, and the wallet and the blockchain and everything else should be transparent for them. And so the wallet is actually one of the legacy, if we can talk about legacy in crypto, I think that's a legacy that we are going to have to overcome to move forward.
Yeah, please, Arthur.
Yeah, interestingly, first of all, you need to build for everyone, right? And these are neutral platform, and I think their value come from being neutral platform and being accessible to everyone and open to everyone. I think that is fundamental to the value prop of blockchains. This openness. That's number one. Number two is, I care a lot about security, and I think especially for institutional use cases, for real use cases, security is going to matter a lot. Paradoxically, I think security has mattered very little until now. And the reason is, if your main use case is you're going to go buy a meme coin, and you say, hey, I have a 1 in 1,000 chance that this meme coin is going to 1,000x. If you say, like, well, on top of that, you should add like a 1 in 10,000 chance that there's a bug and all the money is going to be drained. You don't care because it's a long shot. It's a long shot anyway. So wormhole gets hacked. Whatever. We'll keep playing. Ronin gets hacked. Whatever. People don't care. The BlackRocks and all these people, they do care tremendously, and so I think they will change the dynamic in the industry. Number one. Number two, I think we've been talking about user experience and developer experience in one breath. They are still distinct population, and it should not be like lumped into the same bag. They have different, they do different things, and they have different needs. I already commented on like vibe coding for users. The thing for developers is like most smart contracts are a few smart contracts. You have multi-signature, a DEX, lending protocol, and a token. And this is why you've seen the popularity of frameworks like OpenZeppelin. A lot of people, they want to do some touch-ups, they want to do some things, but there's not a lot of smart contracts beyond that. And the ones that are beyond that tend to be extremely sophisticated. Like they are, and there's the most exciting ones, but there's also the one that you're least likely to be able to just dream. AI, large language models, reasoning models will get to the point where they can do formal verification, and that will be a huge game changer, not just for blockchains and crypto, but for all of cybersecurity.
Yes.
I think that will come in the next couple of years. But for now, I do think that security is going to become more important, not less important, even though paradoxical lesson has been that it wasn't so important.
And I know, I can see, Benjamin, you want to jump in. I just want to give a follow-on to you as well, because we haven't spoken about it at all. We've just spoken really about the tech and the users. But does location matter? We've had personal conversations about America. A lot of people are as well. Is location,
100%.
Country a thing as well? So please, yeah.
I'm wondering what you're going to ask, but the answer is 100%. No, I would say something crazy first. What we are going to see much faster happen is we're going to see the first billion agents and AI on-chain than the first billion humans. And understanding this very simple and crazy initially idea makes it very clear that the user experience needs to be different, the performance needs to be different, the security needs to be different, but the most important part is understanding what that actually entails in practice. Building the rails to enable this type of coordination, transfer, and so on and accommodating to the speeds of what is happening in AI, not in 6 months, not in 12 months, right now. I don't think most people understand how crazy the progress is today. How O3 Pro, that was released yesterday, changes the perspective, and you have sort of genius level researchers that you could use today. So what I'm saying is we can certainly not build for the past. If we look where this technology will go, it's that direction and almost faster than any other direction on Earth. Now, US is just the bedrock of where this happens. You'll have it everywhere around the world, like Dubai and the UAE region, Asia and so on. But I still feel there's no place on this earth like the US in terms of ambition, hunger, appetite, and craziness. And you cannot do it without all of them. So this is why location matters extraordinarily. And then if you're not in the US, it's a very hard pill to swallow that you don't exist. You might have the best product, but if you're not present in the biggest market of the world, it's a very tough reality.
I'm choking on that pill already, unfortunately.
This is why I'm in the US,
down,
by the way. US all the way.
Costas, you want to come on?
I agree 100% by the way with everything. I also have data to support. I'm participating on hackathons. I don't know if you go like us, like co-founders and so on, and see how developers are producing stuff. There is no way someone will get into a new blockchain or doing something if they don't use an AI tool now. 0%. All of the people, I was in Vietnam 2 weeks ago, everybody is not even going to the documentation. Nobody's starting with the documentation anymore. They just go to ChatGPT or Gemini. They can see a template first. Oh, this is how I do my work. And this is when they're getting the inspiration, the stimulation in their brain to start working on the stuff. So we have to work under the assumption that there is not only users and devs, there is also agents now. The agents are going to pretty much be whatever Benjamin mentioned, the first billion like in numbers of users of the blockchain. And at the same time, I have the same feeling because the US at the moment is pretty much conquering this particular industry. You have to start from there and influence all of the evolution of AI to also be like very helpful for the blockchain itself, because there are two things are happening at the moment. AI is requiring the blockchain for transparency and ownership of the data. We cannot leave it like for free. Nobody knows how your data is used. And the only thing we have as a weapon, as society, is the blockchain. And at the same time, the blockchain is requiring AI to evolve. Right? This is where we are at the moment. I cannot even imagine a world in the future without any of the two being like hands in hand together.
Sounds like a beautiful symbiosis. And I think when we talk about beauty, we are in Paris, the city of love, and we are just about to wrap up our panel here. And I'm a bit of an optimist, I'm an idealist. I believe that coming together makes things better. I have a question for the four of you before we wrap up. We have 2 minutes, but can we imagine a world where Sui's object model runs on Tezos' governance, secured by Hedera's privacy protocol, scaled by Multiverse X's sharding?
I don't think there's a need. I'd rather Tezos do it all.
I believe bridging will be a thing. I have a feeling that some niche markets will be occupied by a particular blockchain just because you have some expertise. But some bridging will happen eventually. I cannot see how we can avoid it.
What I would say is very soon, people will clearly not care about what's under the hood. They will just dream an idea. It will be so exciting and so simple to put that idea into practice that the rest will be details, whether it happens on Multiverse X with some other tools or in collaboration with this. I'm sure that these tools will enable them to interoperate, build, deploy, and do it in almost minutes maybe than what you had before. And I think that's the both builder and user mindset that we'd love to live in.
I can add something as well. The AI eventually will tell you which blockchain is useful for what you're building, and the developer will not even see it. You want something I'm saying, the AI will tell you use this for that, use the other thing for UX, and so on. It will be hidden.
There's just one thing I'd like to say about AI because it's important. And I used to be a research engineer at Waymo working on self-driving car. I have a background there. I think it's undoubtedly there's massive development happening in the field. And it's moving very quickly. Was proved very impressive. There's obviously enormous potential there, and yes, there's some intersection with the blockchain industry. However, I would say for the longest time, the marketing angle of the blockchain industry is like, look, we're exciting new tech, and at the end of the day, it is accounting software, right? Accounting is super important, but blockchains are accounting software. And now that there's technologies that's, I love blockchains, I love Tezos, but yes, there's a lot more that will come out of AI than will come out of blockchains, obviously. And I would say maybe 15-20% of what people talk about in AI and blockchain space is real stuff, and 80% or maybe 90% is riding coattails. 80-90% is like, shit, we were the hot thing in 2021. Look, we're relevant. It was the same thing with metaverse when Facebook was trying to do the metaverse. Like, oh yeah, blockchain for metaverse, of course. We're going to create this whole 3D environment. But wait, how will we track who owns what? How will we use a blockchain? That's a critical component. No, the critical component is building the entire universe. Same thing. It's going to have billions of dollars being poured into models. It's like, but what will the models use to transact? It's a detail. I wish it were more important, but let's face it, the industry is talking about AI primarily as a marketing technique.
I disagree, but
yes. I mean, when AI is the fastest growing market in the world, incomparable to any other market, I mean, whether that's marketing or pure revenue, I want that revenue to come.
I think, so to answer your question, the answer is technically those features you mentioned, yes, they will be together into a platform and no one is going to care about who is delivering it. And if we need to ask that question again in 5 years, we are in trouble.
Fantastic. Well, it feels like AI is going to make you love each other one way or another. Thank you so much for listening. I think that's a wrap. Thank you.
Thank you.
All right, that was unbelievable. It's hard to believe the 2 days are over. Well, at least the learning and changing the world part of the 2 days are over. We do still have a pretty fearsome, wild, crazy cocktail session getting ready after this. So I do want to thank everybody for coming. It's been an amazing 2 days. I've been around for a while and I learned so much. I hope that everybody else learned as much as I did. Please do stay in touch with the Proof of Talk team and X Ventures. They're going to be doing this again someday soon here. So be sure to connect with them online and we'll see you again next year. Again, thank you all so much and have a jolly old time. I'm going to go ahead and pause right there and ask if everybody could make their way out over here because there does actually have to be a little bit of a turnover here. And I would like to take a moment to address the X Ventures and Proof of Talk team. I joined the team a little bit unofficially, a little bit late, and just frankly totally fell in love with everybody. The entire team is incredibly hardworking, incredibly talented. I kept meeting people that were doing things that I thought was like their career and then found out later that it was actually just like a side job and they were also secretly brilliant in something else.
So it was really cool just to kind of discover who all these people are. I'm genuinely honored to have been a part of the team. And anyone who's still sticking around here, please give them a huge round of applause for putting together a hell of an event at the Louvre. All right, we got to get the bosses in the front here. Come on. I know we're supposed to be decentralized, but there we go. The team's so big, there's folks I haven't even met yet. This is great.